Check, check, check. Hello, my dear sensible investors. We'll go live in 5 minutes. Check, check, check. Check. Hello, my dear sensible investors. Can you hear me? Am I audible? Please let me know in the chat box. Please type yes in the chat box if you can hear me. Am I audible? Okay, chalo. Thank you so much. Good morning, everyone. Hope you are excited. And I'm super duper excited right now. So, chalo, I can see people typing in yes. So, chalo, since I am audible, without any further ado, let's start the webinar. So, chalo. Now, as you already know, like I was waiting for the last 5 minutes for people to join in. So I'm assuming everyone joined. So chalo. Full day workshop. So I mean, I'm sure you guys might be thinking like what I'm going to cover in today's session. So pretty much everything. So by the end of today's session, you will get a logical conclusion on how to invest your money and make money in the stock market. So each and every topic related to investing will be covered in today's session. So balance sheet analysis, income statement analysis, financial health analysis, growth analysis, cash flow statement analysis, profitability analysis, industry analysis, moat analysis, management analysis. So most of that, even valuation will also be covered, so that you will understand going forward. But I want to cover one of the most important aspects before we start the webinar. So around in, I mean, 8 or 9 years back, I was a beginner. And, more than 99% of people who actually enroll with our golden offer, who attend our webinars, are out and out complete beginners. So when I was a beginner, few years back, I was absolutely clueless, I mean, I'm not sure what to do and all, how to analyze a company or how to value a stock. I was not really sure of how to, invest and all. But eventually I learned valuation. And even after learning valuation, for example, if I look at a company and I am pretty sure that it is undervalued, but still I was not able to place that buy order. That conviction part, the confidence part was missing in me. Even when I knew that a particular stock is undervalued, still I was not able to buy it. So I was, I mean, how you will invest? Like when you don't have the confidence or when you don't have enough conviction, it's very difficult for you to invest. So all of a sudden, I happened, I like watching TED Talks. So I happened to watch this video, just a 4 minutes or 5 minutes, what I'm going to play. So before we start our session, I will start with this video because this is a video that helped me not just as an investor, but in life in general also. It helped me a lot. So this video has brought a different kind of perspective into investing as well as life. So if you can understand this, you can apply it anywhere, any aspect. It can be investing, it can be your career, professional as well. So let's start the webinar by this video.
And it's probably the
And one more thing, I'll just make
world's
sure whether you can
simplest
hear or not. So is it audible?
idea.
Raise your hand.
I call it the golden circle.
Please raise your hands if it is audible. So I'll play it again.
And it's probably probably the world's simplest idea. I call it the golden circle. Why, how, what? This little idea explains why some organizations and some leaders are able to inspire where others aren't. Let me define the terms really quickly. Every single person, every single organization on the planet knows what they do 100%. Some know how they do it, whether you call it your differentiating value proposition or your proprietary process or your USP. But very, very few people or organizations know why they do what they do. And by why, I don't mean to make a profit. That's a result. It's always a result. By why, I mean what's your purpose? What's your cause? What's your belief? Why does your organization exist? Why do you get out of bed in the morning? And why should anyone care? Well, as a result, the way we think, the way we act, the way we communicate is from the outside in. It's obvious. We go from the clearest thing to the fuzziest thing. But the inspired leaders and the inspired organizations, regardless of their size, regardless of their industry, all think, act, and communicate from the inside out. Let me give you an example. I use Apple because they're easy to understand and everybody gets it. If Apple were like everyone else, a marketing message from them might sound like this. We make great computers. They're beautifully designed, simple to use, and user-friendly. Want to buy one? Meh. And that's how most of us communicate. That's how most marketing is done, that's how most sales is done, and that's how most of us communicate interpersonally. We say what we do, we say how we're different or how we're better, and we expect some sort of behavior, a purchase, a vote, something like that. Here's our new law firm. We have the best lawyers with the biggest clients. We have, we always perform for our clients, do business with us. Here's our new car. It gets great gas mileage. It has, leather seats. Buy our car. But it's uninspiring. Here's how Apple actually communicates. Everything we do, we believe in challenging the status quo. We believe in thinking differently. The way we challenge the status quo is by making our products beautifully designed, simple to use, and user-friendly. We just happen to make great computers. Want to buy one? Totally different, right? You're ready to buy a computer from me. All I did was reverse the order of the information. What it proves to us is that people don't buy what you do, people buy why you do it. People don't buy what you do, they buy why you do it. This explains why every single person in this room is perfectly comfortable buying a computer from Apple. But we're also perfectly comfortable buying an MP3 player from Apple, or a phone from Apple, or a DVR from Apple. But as I said before, Apple's just a computer company. There's nothing that distinguishes them structurally from any of their competitors. Their competitors are all equally qualified to make all of these products. In fact, they tried. A few years ago, Gateway came out with flat-screen TVs. They're eminently qualified to make flat-screen TVs. They've been making flat-screen monitors for years. Nobody bought one. And Dell came out with MP3 players and PDAs. And they make great quality products, and they can make perfectly well-designed products, and nobody bought one. In fact, talking about it now, we can't even imagine buying an MP3 player from Dell. Why would you buy an MP3 player from a computer company? But we do it every day. People don't buy what you do, they buy why you do it. The goal is not to do business with everybody who needs what you have. The goal is to do business with people who believe what you believe.
So guys, as you have seen, why plays a very important role, not just in investing, but any aspect of life. So I started to know why. So why we have to read the balance sheet of a company, why we have to analyze the income statement or cash flow statement, valuation. So I started with this perspective of why. And that's when the entire, the investing, process changed. So that is the reason I wanted to show you that. That is what I want to started with, why. Knowing why is very important. So once I understood why I was analyzing balance sheet, income statement, cash flow statement, I mean, lot of clarity. I got a lot of clarity on the subject, and I understood like where I should look for, because till that point, I have no clarity. So obviously, let's start with the balance sheet analysis. Then we will, continue with income statement, cash flow statement and all. So first is balance sheet. So as you can see in the balance sheet, you will find on one side, you will find assets. On the other side, you will find the liabilities and the owner's equity. Owner's equity is nothing but the shareholders' equity. So let's start with the balance sheet analysis, like how to analyze. Now, this is where most people actually focus on how to analyze the balance sheet of a company. You know, they are obsessed with how, but the point is whether you know why or not. Why we have to read the balance sheet of a company is what we'll start with. So basically, a balance sheet is the representation of a company's financial health. So we are analyzing a balance sheet to understand its financial health, whether the financial health is strong, average, or weak. That is what we want to know by analyzing the balance sheet of a company. Now it's like a company's credit report, because balance sheet will tell you how much the company owns, that is its assets, relative to what it owes, that is its liabilities, at a specific point in time. So basically, a balance sheet will give you the list of all the assets and all the liabilities that the company has. So, and the difference between these assets and liabilities is the shareholders' equity. So this is what balance sheet is all about. So balance sheet tells about majorly two things. First is the liquidity position of the company, that is the company's ability to meet its current or short-term obligations. Now, what is current or short-term? You have to remember this. Anything less than 1 year or 12 months, anything less than 1 year is short-term or current. Anything more than 1 year, it can be asset, it can be liability, is considered to be long-term or non-current asset or non-current liability. Below 1 year current, above 1 year non-current or long-term. First, we need to know the liquidity, that is whether the company can meet its obligations in the short term or not within 1 year. Financial health is nothing but the company's ability to meet its obligations over the long term. Now, this financial health, the concept is similar to liquidity. The only difference is the time. In liquidity, we are looking for less than 1 year, whereas in financial health, we look for long term, long term perspective. Now, why it is important, why financial health is important, or why we have to analyze it? Because the financial strength reflects the company's ability to secure adequate resources to finance its future, for expansion purpose, maintain and expand efficient operations, properly support marketing efforts, use technology for profitable advantage. And last but not the least, if the balance sheet is strong, then it can successfully compete with its rivals. It can play a very major role in the industry, because given two companies, company with strong balance sheet always has an advantage in that industry compared with a company where the balance sheet is not that strong. So this is the reason the financial strength is very important, or financial health is very important. And along with financial health, balance sheet also helps us to measure the profitability of the company. If you can remember, we check return on equity, return on assets, return on capital employed and all to analyze the data. So balance sheet data is very important to basically compute all these ratios. Without balance sheet data, we cannot measure or evaluate the profitability of the company. So that is where balance sheet also helps us. Analyzing the data of the balance sheet also helps us to understand company's asset management performance, that is inventory turnover, total asset turnover, receivable days, days payable. So all of these things, cash conversion cycle. So all of this, company's asset management performance, that is how well the company or how efficiently the company is utilizing its assets. That data also you will find in the balance sheet only. So first, let's look at a sample balance sheet. So here you can see on one side we have the sources of funds, on the other side we have applications of funds. Sources is nothing but the liabilities, application is nothing but the assets of the company. So first, let's look at the liability, that is the source side. So balance sheet contains the source of a company and applications of that company. And as you can see here, the balance sheet, as the name says, since the balance sheet has to balance, you can see 250 on both sides. Now that is what balance sheet is all about. The assets and the liabilities should be balanced. They have to be equal at the end of the day. That is the reason it is called as balance sheet. So first, let's look at the equity or the liability side of the equation. That is the source of funds. Now, any company on this planet only has two sources of funds. One is owner's funds and the other is borrowed funds. Now, owner's funds is also known as equity capital. Borrowed funds is also known as debt capital. Now, what is equity capital and what is debt capital? First, let's understand the equity capital. Equity capital or owner's capital is nothing but the money which the promoters or the founders bring into the business when it is launched. It can be anything. It can be a restaurant, it can be a bakery, it can be a a finance company, it can be a bank, any business for that matter. The money bought in by the promoters when the business is launched is known as equity capital. And obviously, going forward, more owners or more partners may join. Even that capital is also known as equity capital. Now, this is the owner's investment in the business. Equity capital is nothing but the owner's investment in the business. And here you can see in this example, the equity, the owner's capital is 100 crores. Now, next is reserves and surplus. Now, what is this reserves and surplus? Let's say we have started a business with 100 crores. Now, eventually the company will start generating profits, right? So as the company makes profits, now let's assume that next year the company made, let's say, 25 crores of profit. Now that 25 crores of profit will not be given out as dividends, or some companies, a part of that is retained back in the business for reinvestment. A part of it is provided as dividends. So each company, utilizes those funds in their own, whichever is required, they use it in that format. I mean, management will decide whether to give dividends or whether to reinvest, whether to repay the debt, whether to buy back the shares. So management will decide. So as you can see, each year the company will make some profits and a part of it will be retained back in the business for expansion purpose. That is for reinvestment. Now that retained capital you will find in reserves and surplus. Now this is also the shareholders' money, which the management has to choose to keep in the company and reinvest whenever it is possible. Now, while the equity is known as owner's capital, whereas reserves and surplus is known as retained capital. Now, as you can see in this example, retained capital is 25 crores. Next, we have net worth. Net worth is nothing but equity capital plus reserves and surplus. Net worth is also called as book value, shareholders' equity, net worth and all. So whenever you find book value or shareholders' equity, or sometimes it is also known as net equity or net worth, is nothing but the addition of equity capital and reserves and surplus. So as you can see here, the net worth is 125 crores. 100 plus 25, 125 crores. That is the net worth of the company. So as you can see, net worth is pretty simple. You just add up those two things, you will get the net worth. Next is, so far we have covered the equity capital, equity side or the owner's investment, we are done. This is basically the owner's investment. Now let's look at the debt capital. And here you can see what is debt. Debt is nothing but a particular amount of money borrowed from any financial institution. It can be bank or it can be some NBFC or whatever it is. So a loan and any debt that is taken for more than 1 year is considered to be long-term debt. Whereas any debt that is taken for a period of less than 1 year is short-term debt. I've already covered that. More than 1 year is long-term, less than 1 year is short-term. So here you can see in this example, they have borrowed 100 crores in long-term. So it's a long-term debt. Now this loan may be taken in the form of financial institutions, or they may, issue some bonds, debentures, and also they can raise money. Now investors prefer companies with low liabilities. Obviously, I mean, company without debt can never go bankrupt. Remember this, a company without debt can never go bankrupt. So whenever we are investing in a stock or in a company for that matter, we make sure that the company has very little debt burden, because, it will affect the survival of the company. If there is high debt, there is a high chance that the company may go bankrupt. So make sure that the debt is very low. Now, what is low, what is high, I will cover that going forward. Don't worry about that. So the classic examples of companies losing a lot of money and making its investors go bankrupt is a company like, Suzlon, Bhushan Steel, HCC, Kingfisher. Kingfisher Airlines, like what happened to Vijay Mallya because of high debt. Kingfisher Airlines has borrowed a lot of money that it could never repay, and eventually it went bankrupt. And Vijay Mallya had to leave the country. So long-term debt in this example is around 100 crores. Next is current liabilities. Current liabilities is within 1 year. So it can be salaries that to be paid, electricity payments, or trade payables to suppliers, working capital loans, that is short-term debt from banks and all. So these are all examples of current liabilities, which is around 25 crores. Now, if you add up all these things, what is the total liabilities? What is the total liabilities of this company? Around 250 crores. That is the sources of funds. This is where, so to start a business, any business for that matter, let's assume this is a restaurant. Now, to start this restaurant, first the owners have invested 100 crores of capital and retained 25 crores of capital into the business. Next, they have borrowed 100 crores, which is long-term debt, and they have around 25 crores of short-term, liabilities as well. So overall, the total liabilities is 250 crores, which is the sources of funds. Now let's look at the application side, that is how the money is applied. So the right side of the balance sheet is where you see the details of the asset. Now a company can have long-term assets like plant, machinery, land, building, furniture, equipment, software. It can have long-term assets or short-term assets like liquid funds, for example, investments in mutual funds, or some stocks, or FD, which they can basically break whenever they want. So there are short-term assets and long-term assets. Now first let's look at long-term assets. Fixed assets is nothing but long-term assets. Now these assets are nothing but the land, building, plant, machinery, equipment, furniture, software of the company. These are the assets that is going to help a company for a long period of time. Again, any asset that can benefit a company for more than 1 year, is known as long-term asset. For example, if you take land, the company has got a land. Now land will benefit the company for a long period of time, right? So it's a long-term asset. For example, furniture, vehicle. For example, there is a truck. It can help, the truck can be used for next 10 years. So it's a long-term asset, right? So that is fixed assets. And in this example, the fixed assets are around 200 crores. Current assets. Current assets are nothing but these are the assets that can be converted into cash within 1 year. Some examples are inventory, trade receivables, short-term loans given by the company, or advances, or cash that is in the bank. These are all current assets. The company can basically convert all these assets into cash within 1 year. And here current assets is 50 crores. Now you can see the balance sheet has balanced. On liability side, we have 250 crores. On asset side also, we have 250 crores. Now that is what balance sheet is all about. On one side, you will find the assets of the company. On the other side, you will find liabilities and owner's equity. So this is basically a 6th class equation. Assets is equal to equity plus liability. A is equal to B plus C. Now what is B minus C? It is equal to A. So it's pretty much, the simple 6th class equation. Assets minus liabilities, you get equity. Assets minus equity, you get liabilities. You basically add up liabilities and equity, you get, assets. So that is a pretty simple 6th class math. So now let's look at some real examples. But before that, you have to understand one thing. Some of you might ask me like why owner's equity is on the liability side, because like I've already mentioned, this belongs to the shareholders of the company, right? Now when it is an asset, then why it is on the liability side? Now you have to understand one thing. The balance sheet is not your balance sheet. It is the balance sheet of the company that we are analyzing. So for company, this amount, the shareholders equity or equity, belongs to us, the shareholders of the company. So it is a liability on the company's part. Company is liable to pay that amount for us going forward, eventually, whenever it is required. So for us, it might be an asset, but for company, it is a liability. Eventually, it has to pay all that amount to the shareholders, right? So that is the reason it is shown on the liability side of the balance sheet. Now let's look at the balance sheet of Hindustan Unilever. So far what I have covered is just a sample balance sheet to understand what are the line items that you will find in a balance sheet. Now let's look at the real balance sheet of Hindustan Unilever. So first you will see assets. Let's start with assets. On asset side, you will find non-current assets, current assets, and total assets. Obviously, non-current assets plus current assets will give you the total assets of the company. And here you can see total assets is 17,862 crores. Now this is the liability. So as you can see on the liability side, we have first equity. First there is equity, and then there is non-current liabilities and current liabilities. So again, you will see the total. As you can see, the balance sheet is balanced. But you have to understand one thing. There are so many line items, right? You can see there are, many line items that you will find on a balance sheet. So if you kind of go through each and every line item, it will be very difficult for you, right? Now, as you can see, that is assets. This is equity and liabilities. There are so many line items where you will focus first. Now, this is what I'll do whenever I'm analyzing a balance sheet. The first thing I want to know is the debt of the company. How much debt the company has. Because if a company has zero debt or no debt, then it cannot go bankrupt, right? So the lower the debt, the better it is. This is Hindustan Unilever. First, let's look at long-term debt. And when it comes to debt, long-term debt or short-term debt, given these two, long-term debt should be very low. Short-term debt is okay because the company can repay it within 1 year, but long-term debt is very risky. So first we have to check the long-term debt, and that you will find in the liabilities. Under non-current liabilities, you will find it. But here you can see there are other financial liabilities, non-current tax liabilities, non-current other liabilities, but there is no long-term debt, right? So there is no borrowings line item here. That means Hindustan Unilever doesn't have any long-term debt. So long-term debt is absolutely zero. Then what about short-term debt? Here you can see under current liabilities, you can see borrowings here. And in this year, borrowings is nil. So zero. And last year, there was 277 crores of short-term debt. Long-term debt was zero last year also. Short-term debt was 277 crores. But first, let's look at the current this year under consideration. It, as you can see, it is 2018. But don't worry, going forward, we will analyze the current balance sheet as well. That is 2022 balance sheet also let's analyze. But just as an example, I am showing you this. So here you can see in this year, 2018, there is no debt. There is no long-term debt. There is no short-term debt. So it's a debt-free company. And on the other side, if you look at the asset side, investments, cash and cash equivalents, bank balance. These three line items can be considered as cash. It is all cash. So just add up all these cash the company has. 2,800 crores plus 650 crores plus 2,836 crores. So it is almost around 6,000 crores. So this company has got 6,000 crores of cash. Now this is the asset that can be converted into cash within 1 year, right? So obviously cash and cash equivalents, all of this is in the bank itself. So it is readily available. Whereas this investments might be some investments in, mutual funds or some stocks, which can be liquidated very simply, like as soon as possible, it can be liquidated. So as you can see, all three line items can be considered as cash. So in 2018, Hindustan Unilever has zero borrowings and almost 6,000 crores of cash. Now tell me whether this company can meet its long-term obligations or not. I mean, what long-term obligations? There are no obligations at all. There is no obligation. Long-term obligation is zero. So this company doesn't have any long-term obligations. And whether this company can meet its short-term obligations or not, even the short-term obligations are also zero. Short-term debt is also zero. And on the top of that, it has got 6,000 crores of cash. Now tell me whether the financial health is strong, average, or weak. Absolutely, as you have already seen, zero debt, 6,000 crores of cash. So its financial health is pretty strong. Whereas if you look at the last year, now it has got long-term debt is zero, but whereas short-term debt is 277 crores. Now tell me that 277 crores is high or it is low. What do you think? It is high or it is low or it is average? What do you think? So remember this, it can be balance sheet, it can be income statement, or it can be cash flow statement, anything for that matter. Whenever you are analyzing a stock, never look at the absolute number, because you cannot analyze by looking at the absolute number. Don't look at the number. While analyzing, we always relate that number to another number. Only then we will understand whether it is high or whether it is low. So we use, in terms of estimating whether the company has got high debt or low debt, we compare the company's borrowings with the equity capital of the company, which is known as the debt to equity ratio. We compare debt with the equity of the company. And here, what is the debt? Short-term debt is long-term debt is zero. Short-term debt is 277 crores. But what is the equity of the company? 216 plus 22 plus 6,528 crores. So if you add up all of that, it is around, I'm giving you a rough number, it is around 6,750 crores. Now, if you compare this 277 plus 6,750 crores, it is absolutely nothing, right? So this company has got very little debt, very little, minute debt. Now, what should be the debt to equity ratio? As long as the debt to equity ratio is less than 1, sorry, this is greater than 1. So as long as the debt to equity ratio is less than 1, it is good. So in theory, Hindustan Unilever, even if it has got, like, let's say 6,500 crores of debt, even that is also okay. But how much it has got? Only 277, which is very little, right? So this company can meet its long-term obligations and short-term obligations. But whenever we are looking at the assets or the liabilities, you can see there are only 2 years of data available, right? Just by looking at 2 years of data, we cannot really get, we cannot analyze just with that 2 years of data. So we always try to check the last 5 years or 10 years of data. So this is the last 5 years of data of Hindustan Unilever. So as you can see, the shareholder funds is nothing but the equity. So as you can see, the shareholder funds are consistently increasing every year. So the company is making profits every year. So reserves and surplus are also growing. And you see the long-term borrowings, 0, 0, 0, 0. This is 7. 7 is, obviously 7 is nothing. Compared with this 4,000 crores, 7 crores is nothing, right? So long-term debt is almost zero every year. Short-term debt is also very little, 99, 0, 277, 177. Now you compare it with the shareholder funds, 0, 99, and compare this number with 7,867 crores. It's absolutely nothing, right? So as you can see, this company has always maintained almost a debt-free status. Whereas if you look at its assets, current investments, cash and cash equivalents, these two line items can be considered as cash. Now if you add up these two line items, 2,700 plus 3,700, almost 6,000. 2,800 plus 3,000, almost 6,000. So almost 5,000. 5,500, almost 5,700. So as you can see, every year the company maintains at least 5,000 to 6,000 crores of cash with almost zero debt on its balance sheet. So this company can absolutely meet its long-term and long-term as well as short-term obligations, right? Now this is the last 10 years of data. But the thing is, whenever you are looking at the numbers, absolute numbers, you cannot analyze. Let me give you an example. So whatever we have done so far, we have not analyzed anything. That is called as reading the balance sheet. So what we have done is we have read the balance sheet, but it is not analysis. These are the last 10 years of numbers. But for example, if you can see here, the inventory is 2,500 crores in 2018, and even in 2009 also it was around 2,500 crores. Now tell me whether in terms of inventory management this company improved its performance, or the performance deteriorated, or there is no change. What do you think of the inventory performance? Whether it is improved, deteriorated, or no change? If you look at the absolute number, 2,500, 2,500. So if you look at absolute numbers, you might be thinking, okay, there is no change, nothing changed. It is more or less the same. But if you analyze looking at absolute numbers, that analysis will be half-baked. We always use percentage analysis, or we call it as common form analysis. This is nothing but we basically take the total assets as 100%. And we take all the line items and we measure that particular line item with this total assets, and we convert all these components into percentages. For example, if you look at cash and cash equivalents, it is 19.6% of total assets. Short-term investments is also nothing but the cash, is 16%. So if you can closely observe, every year this company maintains, at least if you add up 19 plus 16, it is around 35. And if you look at the long-term averages, last 10-year average also, it is around 32. So this company, that is Hindustan Unilever, maintains 30 to 35% of total assets the company has is only cash. So it is having a lot of cash on its balance sheet, right? And if you look at accounts receivable, it was around 6%, 10 years back. That increased to around 7%. So, but around more or less the same, 6 to 7 is nothing. Huge significant difference is not there. More or less the performance is same. Now comes the question whether the inventory, the company started using it efficiently or not. When we were looking at the absolute numbers, there is no change. But look at the percentages. In 2009, inventory was almost 30% of total assets, whereas in 2018, that is only 14% of total assets. That means, inventory is asset, but when inventory, the cash is tied up. So the faster the inventory movement, the better it is. So in 2009, almost 30% of cash would have been tied up in inventory, but whereas in the current year, only 14% of cash is tied up. So the company's inventory performance has improved. We have understood that by only looking at the percentages. Looking at absolute numbers, you cannot understand that. So inventory performance improved. And these are the 3 or 4 things that we check in the asset side, long-term assets. This is also long-term assets only. So property less depreciation, that is nothing but the plant, machinery, plant and all equipment. So as you can see, 27% is plant, equipment, tangible assets of the company. Now here you can see Hindustan Unilever is having almost 35% of total assets as cash, but the tangible assets, that is land, building, plant, machinery, is only 27%. So this company, we call it as low capital intensive business. This company doesn't need a lot of capital or a lot of reinvestments to grow its business because it is less capital intensive. So this is what we check on the total, asset side of the balance sheet. Whereas if you look at the liability side, short-term borrowings, as you can see, it is always 0. So short-term liabilities are always 0. Whereas if you can check the long-term liabilities, even long-term borrowings are also always 0. So this company is almost a debt-free company every year. And one more thing that you have to check is whether the shareholders' equity is increasing or decreasing or no change. Shareholders' equity is nothing but the book value or the net worth. The net worth should grow every year, right? If the company is making profits, then the net worth should grow. If you look at the total shareholders' equity, from 24%, it increased to around 41%. So this company is consistently making profits. So as you can see, from 24 it increased to 41, around 41. So that is regarding Hindustan Unilever's balance sheet. Now comes the most important question. But have to know whether the company can meet its short-term obligations or not. Have to know whether it can meet its long-term obligations or not. I'll give you a shortcut. Even without doing all this, going through all these line items also, you can know whether the company can meet these obligations or not. First, let's look at the long-term obligations. Financial leverage should be less than 4. This is not percentage, that's a typo. Financial leverage should be less than 4. Should be less than 4. Debt to equity ratio should be less than 1. So here you can see financial leverage is less than 4. Debt to equity ratio is 0. So it's a debt-free company. But this is the criteria that we check for. It should be less than 4. This should be less than 1. If this is the case, then the company can meet its long-term obligations. So what do you think of Hindustan Unilever? It can meet its long-term obligations, right? What about short-term obligations? You can use current ratio, quick ratio, but in general, we never use that. We use interest coverage ratio. Interest coverage ratio, this interest coverage ratio, if it is greater than 8, then the liquidity position of the company is very strong. It can meet its short-term obligations. The higher it is, the better. Interest coverage ratio of 15 is always great. 25 is much better. Whereas if you look at Hindustan Unilever, it is 281. Now, what is this interest coverage ratio? It is nothing but a company has got, let's say, a company borrowed, let's say, 100 crores of capital. It has got, let's say, 100 crores of debt. It has to pay interest, right? For example, the rate of interest is, let's say, 10%. So every year, this company has to pay 10 crores of interest, which is mandatory. If you are borrowing money, you have to pay interest at regular intervals, which can be monthly payments, which can be yearly payments. It depends on the, how you take the loan. But the thing is, you have to make the interest payments, right? End of the day. So this 10 crore rupees is the interest payment here. And let's assume the company is generating 30 crores of operating profit. If it's a cyclical company, now 30 crores of operating profit, out of this 30 crores, 10 crores the company will pay as interest. But what if it's a cyclical company and next year, instead of generating 30 crores, this company generated only, let's say, 6 crores as operating profit. When you generated 6 crores of operating profit, how will you pay 10 crores of interest payment? Which is impossible, right? So the company might default on its interest payments. So that is the reason we keep it as minimum 8. If a company has to pay at, let's say, minimum 10 crores of interest payment, then that company should generate at least 80 crores in operating profit. Even if there is any cyclicality also, we don't want the company to default on its interest payment. That is the liquidity position, whether the company can meet its short-term obligations or not. Mostly the short-term obligation is its interest payment. So as you can see, that should be minimum 8. 10, 15, 25 is obviously better than 10, better than 8, but that is the minimum numbers we look for. So debt to equity ratio less than 1, financial leverage less than 4, interest coverage ratio greater than 8. If you find these 3 parameters in place, then that company's financial health is pretty strong. Financial leverage more than 4, debt to equity ratio more than 1, interest coverage ratio 0, negative or less than 8, let's say it is 4, then that company has got weak financial health. So as you can see, the bottom line is balance sheet is like a company's credit report, because it tells you how much the company owns, that is its assets, relative to what it owes, that is its liabilities at a specific point in time. So it tells you how strong the framework and the foundation of the business is. So that is regarding the financial health. Now let's go and check the income statement of the company, that is understanding the income statement. Again, the income statement also starts with why. Why we have to analyze the income statement of a company. These are the things that we want to know. First is, how well is the company's business performing? Or to put it simply, whether it is making money or not. Pretty simple question. Whether the company is making money or not. That is what I want to know first. And that you will learn in the income statement, or we call it as profit and loss statement. Now this P&L statement or income statement will summarize how the company's operation performed during a given period. Now that given period can be quarter, which is 3 months, half yearly, which is 6 months, or it is annual, which is 1 year. It tells you how much money a company has bought in, that is its revenues, how much it has spent, that is expenses, and the difference between sales and expenses is nothing but the net profits of the company. Now first, with this you will know what is the sales, what is the expenses, what is the net profits. But along with that, you will also know, did the company make a profit? I mean, did the company improve its operations compared with the last year? Because on the income statement, you will find the current year's data and the previous year's data as well. So you can compare the current year's data with previous year and you can see whether the business improved or not, or whether it is deteriorated. So this is pretty simple. A company should be able to bring in more money than it spends, or else it won't be in the business for very long, right? The sales should be greater than the expenses. If the sales is less than expenses, then the company will incur losses, right? So any company cannot survive for losses for a long period of time. Eventually the company should generate profit. So the sales should be greater than expenses. Only then the company will make profits. Only then the shareholders will also make money. So why we analyze the income statement? First, to know whether the company is making money or not, and to check whether it has made more money or less money compared with the previous year. And the combination of balance sheet and income statement will help you understand the profitability, that is return on equity, return on assets, all of that will be used. Along with balance sheet data, you need income statement data as well to compute the profitability ratios. Now you have to understand one more thing. We check the income statement not just to know whether it is making money or not. We analyze it to know whether the company is making money consistently or not. So consistently it is making money, and along with that, we want to know the growth of the company as well, whether it is a high growth, moderate growth, or low growth company. So how you will understand the growth of the company? With the help of income statement data. But before that, let's look at a sample income statement or sample P&L statement. It starts with the net sales of the company, or let's say the sales, revenues, turnover, whatever you may call it, the sales. And in this example here, you can see the sales is 100 crores. Now what is sales? Any company has to sell goods or services or products to its customers, and they generate revenues, right? So that revenues is nothing but net sales. Net sales is basically after GST, that is after considering the indirect tax, whatever amount is received, that is the net sales of the company. In this example, the net sales is 100 crores. Next, after net sales, we have direct cost. Now what is the direct cost? There is direct cost and there is indirect cost as well. So direct cost is nothing but the cost that can be attributed directly to the business. For example, raw material cost, or salaries, electricity cost, or transportation of raw material cost. So the cost that is directly attributed to running a business is known as direct cost. And the examples are raw materials, labor cost, plant electricity bill in the plant, or transportation cost and all of raw material. So in this example, the direct cost is 20 crores. Now, once you take out direct cost from net sales, you will end up with earnings before interest, tax, depreciation and amortization, which is called as EBITDA. EBITDA. Now, this is the difference between net sales and direct cost. Now, EBITDA is used to measure the operating efficiency of the company. We check the operating efficiency by using EBITDA. Now, it enables comparison between companies that may have different capital structures, depreciation policies, and tax rates. Now, you might be thinking like why it is very important. And one more thing, we take it as margin. We always compare with margins. For example, let's say there is a company which is generating EBITDA of, let's say, 300 crores. EBITDA of 300 crores. There is one more company in the same industry which is generating 50 crores of EBITDA. One is 300 crores of EBITDA. The other company is 50 crores of EBITDA. Now, given these two examples, which company do you think is good and which is bad, given these two? Like I said, just if you look at the absolute numbers, 300 would seem to be better than 50. But we have to check the percentage. Only when checking the EBITDA margins, we can know which is better, which is worst. For example, what if the net sales of this company is only 100 crores, whereas the net sales of this company can be, let's say, 10,000 crores. So here the company is generating 10,000 crores of sales, but only 300 crores in EBITDA, which is almost 3%, right? Only 3%. Whereas here 50% EBITDA margins. So this company is better than this company. So never look at the absolute numbers, always compare. Always convert that number into a percentage and then compare. Only then you will understand which is good, which is bad. Now, why we need to analyze the EBITDA margin is because each company, it might be in the same industry, but have different capital structures. Some company might have got high debt, some company might have got low debt. Depreciating policies might be different. They might be using different depreciation policies or tax rates. Some companies might be paying 25% tax, 30% tax, whereas some companies might be paying only 15% tax. That is, they are not paying full amount in tax. So difference of tax rates, depreciating policies, capital structure, I mean, you cannot compare it. It is not apples to apple comparison. If you compare, net profit margins of all the companies, it is not apples to apples comparison because they have different structure. So, but EBITDA margins, I mean, interest cost, depreciation, and amortization is not even in, it is not included here. So if you, I mean, it is already included there. So if you compare this, then it would be a better comparison than net profit margins. So that is the reason we use EBITDA margins, and we call it as, we check this to understand or to measure the operating efficiency of the company. Then we have depreciation and amortization. And here in this example, it is around 20 crores. Now, whenever a company purchases an asset, and if it is used for a long period of time, then it doesn't make any sense to show the entire expenditure at one cost in the P&L statement. I'll give you an example. Let's assume that the company has bought a machine. Let's say this company has bought a machinery which is, let's say, 100 crores. The cost is, let's say, 100 crores. But to purchase this machinery, this company doesn't have 100 crores. So what they did, they went to a bank and they borrowed that 100 crores. So they borrowed 100 crores, and with that 100 crores, they purchased this machine. And if the company shows this 100 crores of machinery cost on the income statement in that current year itself, then three problems will arise. Problem number one, the company immediately goes into loss. Why? because this company is generating 100 crores of sales. Its sales is 100 crores. And if you put machinery cost as 100 crores and add up all the labor cost, all the advertisement cost, all the raw material cost, then that will be way more than 100 crores, right? So the company will immediately go into loss. That is the first problem. The second issue is the machine would be still available for the company to use, but it cannot be shown on the balance sheet because the company is already expensed. The entire balance sheet is already shown as an expense in the income statement. You cannot show it as a balance sheet you cannot show it as an asset on the balance sheet because it was already written off in the income statement. That is the second problem. The third issue is, as the company would go into losses, it wouldn't pay any taxes. So that would result in loss of tax revenue for the government. So that is the reason. I mean, obviously, if the company is in loss, they will not pay tax. It is a loss of revenue for government. So these are the three, problems that will arise if you depreciate or if you put the entire machinery expense in the current year itself. So in order to prevent these things from happening, the expense of buying a machine is divided into the estimated life of an asset. And each year a part of the expense is shown on the P&L statement, and the remaining amount is kept with the company as an asset and is shown on the asset portion of the balance sheet. That is nothing but, I'll give you an example. In this example, I have already given 100 crores is the cost of the machinery. Let's assume that that machinery can be used, let's say, for next 5 years. So it can be used for next 5 years. So each year the company would show 20 crore rupees as expense on the income statement, and the correspondingly that 20 crores will be reduced and it will be put on the asset side of the balance sheet. That is in the first year. Here you can see in this year 20 crores is shown as depreciation, and the remaining 80 crores, 20 crores, that is in the first year, it will keep 20 crores in the income statement and it will show 80 crores as asset side on the balance sheet. Next year, it will again show 20 crores in the expense side of the income statement, and on the balance sheet, it will reduce to 60 crores. Next year, it will be 40 crores, 20 crores, 0. So in next 5 years, the entire asset will be consumed. So it will be shown on the expense, equal 20 crores of expense is shown on the income statement, and corresponding reduction will be made on the asset side of the balance sheet as well. So after 5 years, the asset would be consumed and it will disappear from this company. What is amortization? Amortization is also similar, but depreciation is used for the fixed tangible assets. That is land, building, plant, machinery, which we can see, we can touch. That is tangible asset. The same concept for a long-term tangible asset is called depreciation, whereas the depreciation of intangible asset, which is a copyright or patents or brand. So depreciation of intangible assets is known as amortization. Pretty much same, just tangible it is depreciation, intangible it is amortization. That's it. Next we have, after, if you take out that 20 crores from this 80, it will be earnings before interest and tax, which is also known as operating income. So here you can see it is around 60 crores. Next is interest expense. Interest expense is nothing but, obviously, in this example we have taken 100 crores of loan, right? So it is nothing but interest payments on loans that have taken. Many of the best companies, India as well as in the world, have very extremely low debt or even no debt. For example, Hindustan Unilever is considered to be one of the greatest companies in India, and it's a zero debt company. It's a debt-free company, right? So the lower the interest payments, the better it is for the company. So as you can see, here the interest expense is around 20 crores. This is what Warren Buffett says. I do not like debt and do not like to invest in companies that have too much of debt, particularly long-term debt. So with long-term debt, increase in the interest rates can drastically affect company profits and make future cash flows less predictable. Now, the predictability of future cash flows plays a very important role for us. You will understand that by the end of the day, because in valuation, we are going to use this free cash flows or future cash flows that I'll cover going forward. So at this point, I want you to understand one thing. Generally, we always invest in companies with debt-free, which are debt-free, or at least they have low debt. Next is other income. Now, this other income is the recurring. This is not the income from the core operations of the business. These are non-core activities of the business, like rent income, interest income, some dividend income, or some commissions, which is not the core operations of the company. Now, the best thing is this be a very small portion of the net sales, because if this income is very high, then why we are investing in the company is not for its other income. We are investing in for the core income of the company. That company might be generating a lot of other income, but we are not investing for that. So we try to invest in companies where the business is able to generate high, core income. So that is what important for us. So make sure this number is as small as possible while we are investing. And in this example, it is just 5% of total sales. Next is profit before tax. Now we have deducted all the expenses but tax. So this is profit before tax, around 45 crores. Now comes the tax. Now the tax is, each company has to pay, depending upon the revenues. So there is some slabs. So in India, it is around 30%. Around 30% is what the marginal tax rate in India, but it is in between 25 to 35, depending upon the, industry. For example, liquor industry, the tax is little higher. The GST is also little higher. So that is different from, each industry to industry, it varies, but around 30 is what we can consider as the marginal tax rate in India. So if you consider 30% tax from this 45 crores, it is around 13.5 crores. So overall, the profit after tax, now this is the final residual amount that remains with the company after paying all its stakeholders, like after paying all the salaries, all the other expenses like marketing, advertisement, raw material, transportation, after incurring, after paying all the expenses, this is what left as a final residue, which belongs to the shareholders of the company. We are the shareholders, right? We are the owners of the company. So this is the shareholders' money and may be paid out as dividends. Now the management will decide what to do with that 31.5 crores. It can be paid out as dividend. It can be reinvested back into the business, retained into the business. They can pay some borrowings with that company. They can buy back stock. So they can do whatever they want. So sometimes the company, what happens with most of the companies, a part of it is retained back in the business, a part of it is paid as dividends. That is what most of the companies will do in general. So this is the income statement of the company. So here you can see profit and loss statement. So there are many line items, but before looking at the line items, I want you to understand one thing. The three most important components of the income statement are sales, expenses, and the net profits. Sales, expenses, and profits are the three most important line items. Whereas if you look at the balance sheet, what are the three most important components? Assets, liabilities, shareholders' equity. That is the three most important components of balance sheet. Now sales, expenses, and profits, the three most important components of an income statement. For example, if you look at the income statement of Hindustan Unilever, sales increased from 36,128 crores to 36,622. So what is the improvement? Sales increased by around 500 crores. What about the net profits of the company? From 4,490 crores, net profits increased to 5,222 crores. Now let me ask the first question. whether this company is making money or not. Is it making money or not? As you can see, it's a profitable company, right? Here you can see it's a profitable company. So yes, this company is making money. Okay. Did it improve from last year? Compared with the last year, whether the profits improved or not. As you can see, last year 4,400, this year 5,200. So compared with the last year, it improved. Now comes the most important question. Whether the company is making money consistently or not. We want to know whether it is consistently making money or not. Now tell me whether it is consistently making money or not. Just by looking at 2 years of data, you cannot say it is consistently making or it is not consistently making. 2 years of data cannot help you. For that, we need to check at least 5 years of data. So here you can see from 32,000 to almost 40,000, the sales increased from 4,300 crores to 6,600, and you can see consistently increased. So consistency is also there. So Hindustan Unilever is making money, improved from past years, 400 to 6,000. Improvement is also there, and it is consistently making money as well. Each year, the net profits are positive. So every year, consistently, this company is making money. Now, I will ask you the most important question. Whether it is a high growth company, moderate growth company, or a low growth company. What do you think? High growth, moderate growth, or low growth? What do you think? So, I mean, sales growth, first let's look at sales growth. Whether the sales growth is high, moderate, or low. 32,000 to almost 39,860. So if you look at the sales growth, compounded growth is around 3% or 4%. If you calculate the compounded growth, it is around 3% or 4%. Low growth, right? Absolutely low sales growth. What about the net profit growth? From 4,300 crores to 6,000 crores. That is around 5% or 6% compounded growth. CAGR we call it. Compounded annual growth rate is CAGR. So as you can see, sales growth around 4%, net profit growth around 6%. That is not what we are looking for. For example, if you look at net profit growth, for us, net profit growth should be greater than 15%. Here it is not 15%, only 6%. So Hindustan Unilever is consistently making money, but it is not a high growth company. So we will never invest in such companies. We don't invest. And you look at the gross profits of the company, the percentage analysis we are doing, the common form analysis. So as you can see, the gross profits consistently increased every year from 44 crores to 53 crores. Even the net profit margins also increased from 11% to almost 15%. But everything is great. Consistency is very good, but it's a low growth company. Without net profit growth, share price growth will never happen. So that is the reason we don't invest in low growth companies. So in general, we will avoid. It's a good company, but we have to avoid it. So the bottom line is the income statement will tell you how much the company made or lost in a given accounting period. It can be quarter, it can be half yearly, or it can be annual, that is year. Unlike the balance sheet, which is the snapshot of the company's financial health at a precise moment, the income statement records the revenues and the expenses over a set of period. Set of period is quarter, half yearly, or annual. So that is regarding the income statement. We analyze the income statement to understand the growth of the company and the stability, consistency of growth as well. And we like to invest in high growth, stable companies. Now comes cash flow statement. Now, why we have to analyze the cash flow statement of the company? Now, pretty simple. The cash flow statement will help you understand how much cash came into the company and how much cash went out of the company. How much cash came in and how much cash went out. Now, you may wonder, like, why there is a need for such a statement. because this sound pretty similar to the income statement, right? Which shows how much sales came in, how much expenses went out. So after all, if the company is making money, it is making money, right? So why there is a need for cash flow statement? It is because of this accrual accounting. Try to pay attention. This is very important and this can be confusing as well. Now, this is how it will work. A company records sales when a service or a good is provided to the buyer, regardless of whether the buyer pays or not. As long as the company is reasonably certain that the buyer will eventually pay the bill, the company can post the sales to its income statement. So after the delivery of product or goods or services, the company may record it as sales on the income statement, irrespective of whether the cash payment has received or not. As long as the company is certain that eventually that person will pay the bill, we are certain about that, then they can book that sales into the income statement. So on accrual basis, sales are booked at the time of delivery. Once the delivery of the product is done, the sale is booked. On the income statement, they will show sales, they will show expenses, and they will show net profits, irrespective of whether they received cash or not. Now that is what accrual account is all about. So I'll give you a simple example. Let's say there is a business and this business does all cash purchase, that is 80,000 rupees of raw material someone purchased with cash. 80,000 rupees is cash. And that raw material they developed into a finished product and they sold it for 1 lakh rupees in cash. They bought in cash, they sold in cash. So they generated a net profit of 20,000 rupees, which is cash. That can be touched, that can be seen, that can be felt. But obviously, all businesses will not have this cash operations. Very few businesses will have such luxury. Let's assume the same scenario in different setup. Let's assume the same company bought 80,000 rupees of raw material in cash. But when it comes to the sales, they sold it for 1 lakh rupees to the customer, but the customer said like, I need some time. Give me 15 days of time. I will take the product now. After 15 days, I will pay. And you provided the credit. Because for many businesses, if the credit is not provided, then the asset or that inventory will not be sold. So many businesses will provide credit for their customers. So they sold, so cash purchase, credit sale. Now there is a profit. This company booked 1 lakh of sales on the income statement, 80,000 as expenses on the income statement, and showed 20,000 rupees as profit on the income statement because the delivery is done. But you have to understand that 20,000 profit is only paper profit. It is not real profit. Unless and until the cash is received, we cannot consider it as real profit. What if the customer is not able to pay the amount? Then that 1 lakh rupees is gone, this 20,000 rupees is gone, and the biggest risk is 80,000 rupees capital is also gone. So everything is gone. So cash is very important. That is the reason we have to know how much cash is coming into the business, how much cash is going out of the business. Whatever the profits that is shown on the income statement can be only paper profits when the real cash is not received. So we check, we compare the income statement with the cash flow statement of the company to understand the narrative, whether income statement and cash flow statement is narrating the same story or they are narrating different stories. Only then you will understand. So cash flow statement is very important. More than income statement, cash flow statement is important. So the example, let's assume Colgate toothpaste. So Colgate sells a few cases of toothpaste to Investor Dairy General Store. Let's say there is a general store, Investor Dairy. I'll give it a name, Investor Dairy General Stores. So Colgate delivered 1 lakh rupees worth of toothpaste to this general store on 20th February. Date is very important, so please pay attention to the date. It is 20th February. But obviously investor diary is a regular customer who is paying his bills on time, so he's a regular customer. So Colgate provided 60 days of credit, so I don't need to pay the amount upfront. They will provide me 60 days. After 60 days I will pay them the amount. But March 31st rolls around, that is, I have not paid till March 31st. Like I will be paying around in April, on April 20th, I'll be paying the amount, let's assume. But in between there is March 31st, end of the financial year. So Colgate has to close its books. Year end, that annual books will be closed around in March 31st. But I didn't pay the amount, right? But still Colgate will show 1 lakh rupees in sales on the income statement because the delivery is done. Delivery is done and they are pretty sure I will repay the amount. So they will show 1 lakh rupees as sales on the income statement. But since I didn't make the payment, what they will do is they will, they will make a corresponding entry on the balance sheet as accounts receivable. They will show this 1 lakh rupees as account receivable on the balance sheet, but they will they will book 1 lakh rupees of sales and whatever profits also they will book and show it in the current quarter itself. Now what happens, as you can see, a company can show roaring sales growth without receiving a rupee of cash. Without receiving 1 rupee, they can show roaring sales growth. And that is the reason we check the cash flow statement of the company. If the Colgate is producing it and selling the toothpaste faster than its customers are actually paying it, sales growth would be fantastic, but there is no cash flow. Cash flows would be negative. So without cash, company cannot survive. I mean, which company can survive without collecting the cash? Eventually it will go bust. So that is what happens with any company. So that is the reason, along with the profit and loss statement and balance sheet, cash flows generated by business is also very important. They have to be evaluated. In the absence of cash, while there may be profits, but they are more like paper profits. They are not real profits. Now this is what happens with the money in a company. First, whenever you are starting a business, any business, capital is very important, right? And how do you source that capital? 2 ways. Shareholders and bondholders provide capital, that is nothing but equity capital or the debt capital. People who are providing equity capital are called as shareholders of the company, and people who provide debt capital are called as bondholders of the company. So that's how you generate the capital. Once capital is generated, and obviously it will be in the form of cash deposit. So capital or cash. Now what you will do with this cash? You will invest that cash into fixed assets. That is, you buy land, plant, machinery, building, furniture, equipment, vehicles, any software required, laptops, desktop, whatever it is. So you buy all these assets. And once the assets are in place, then you will start the production. That is, you buy the raw material. After buying the raw material, you will convert that raw material into finished product, which is called as inventory. Now you have got inventory. Now you will sell it. Now a part of it can be a credit sale. You sold it in the form of credit, and a part of it can be cash sales. Cash sales is nothing but they paid you the cash, you gave them the product. So cash, if it's a cash sale, then that money will directly go into cash deposits. But what if it's a credit sale? They've asked you like 15 days to pay, or 15 or 2 months or 30 days to pay. Once you receive the cash, only then it will go to cash deposits. Until then, it will be shown as accounts receivable. So products to credit sales to account receivables, once you receive the cash, then you will show it in the cash deposit. So one cycle is complete. You started with cash, you invested in assets, you started production, you sold, then again you received cash. But on that cash, You have to pay taxes. If you are making profits, then you have to pay taxes. A part of it is paid as taxes. A part of it can be paid as dividends to the shareholders. Interest payments. If you have borrowed money, then you have to pay interest to the bondholders. So one cycle is completed. But obviously, with one cycle, a business will not stop. It has to continue, right? So from the cash deposit, you will again reinvest in building more assets, in buying more raw material. The assets will increase, the inventory will increase, sales will increase. So it keeps on. So that's how money will travel in a business. Now these are the cash flows. Cash flows are divided or classified into three categories. Cash flows from financing activities, cash flows from investing activities, and cash flows from operating activities. Now I'll give you a simple. Now what are these cash flow from operating, investing, and financing cash flows? First, cash flows from operating activities. All the cash, the incoming and outgoing cash that is related with the core operations of the business. For example, you are selling a product or a service and receiving cash. Now that is the operating cash flow. So all the cash that come in and go out in the core operations is shown here in the cash flow from operating activities. Now here you can see, you will know by looking at this, operating cash flows, you will know how much cash the company generated from its core business, which is very important. Next is investing cash flows. Buying assets or selling assets is shown here. Now you have to understand one thing. If the company is buying assets, or buying assets is nothing but investing in assets, cash flows will be negative. Why it will be negative? Because when you are buying something, the cash is going out, right? So obviously if you are buying an asset, cash will go out. So negative cash flow is buying assets. But if you are selling assets, what happens when you sell the assets? Cash will come into the company. You receive cash if you sell something. So positive cash flows is selling the assets. Negative cash flows is buying the assets. So all the investment related activities will be shown here. Next is financing cash flows. Cash flows, borrowing money or issuing new equity is shown here. Remember one thing, any transaction with the business owners of the company will be shown in the financing activities. That is taking debt or repaying debt, selling equity or buying back, or paying dividends. Any transaction either with the shareholders of the company or the bondholders of the company will be shown here. Now one more concept that you need to understand, which is free cash flow. Now it represents, free cash flow is very important. You will understand in the valuation. We value company using the free cash flows. So this is the amount of excess cash generated by a company. See, I'll give you a simple, free cash flow is nothing but the cash that can be pulled out of a business without hurting its existing operations. Even if you take out that cash, the business operations will not get disturbed. It will not get affected. And that is the reason it is called as free cash flow. It is free. How do you compute the free cash flow? Very simple. Cash flow from operating activities minus CapEx. CapEx is nothing but all the money that is spent on buying land, building, plant, machinery and all. For future growth is nothing but CapEx. So if you take CapEx from cash flow from operations, you will get this free cash flow. So if a business is continuously running negative operating cash flow for several years, now that is a warning sign. I mean, obviously, if a company is generating a lot of paper profits, but it is not generating any real cash, the cash is not coming into the business, then how will it survive? It is very difficult for the company to survive. You can see this is Kingfisher Airlines. So Kingfisher Airlines had negative operating cash flows for many years. You can see the company went bankrupt around in 2013, but even before it went bankrupt, that company, I mean, the signs are pretty clear from many years before that eventually this company will go bankrupt. So the sensible investors would have never invested or never touched this company with a 10-foot pole because the warning signs are pretty clear. So here you can see net profit, as you can see, is consistently negative. So it's a loss making company. On the top of that, if you look at the cash flows, even the cash flows are consistently negative. So this company is not generating any cash. Cash is not coming into the business. It's a money losing business. So why would anyone invest in such business? At least in sensible investing process, we will never invest in money losing business. We want companies to make consistent profits, and we want to generate cash as well, not paper profits, but real profits. So Vijay Mallya or Kingfisher Airlines was borrowing money to pay interest. Now this is funny. They have borrowed a lot of money, but to pay the interest amount, they don't have any money now. Now what Mallya was doing, he is borrowing more money just to pay the interest expense. But that cannot continue for very long, right? So eventually the bubble burst. The banks and the financial institutions thought, now whatever done is done. Now you pay the amount. If you don't repay the principal amount, we will not provide you any more debt. Now that's when, I mean, the bubble actually burst. So without the infusion of external capital, Mallya was not able to actually run the business. So eventually Kingfisher Airlines went bankrupt. And you know what happens later on? He had to flee UK and all. So that's what happened. So no business can run on the continuous expansion of borrowed money. Borrowed money can help you only for short term. Over a long period of time, eventually the business should generate money. So whenever a business is expanding, it needs cash. And the company is not generating that cash, then the only possible way is you can go and borrow. But whenever you are borrowing the capital or borrowing money, the risk will increase. So borrowing is always very risky. So in general, whenever I see a company expanding, I want the company to expand rapidly. I want the company to expand rapidly, but that rapid expansion should happen from internal cash, the cash that is generated from the core operations of the business. That is what I look for. Companies that depend too much on borrowed funds, I see it with caution, and I'll just ignore those companies. I will never invest in those companies. So this is the cash flow statement of Hindustan Unilever. So here you can see cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Now first, let's look at cash flow from operating activities. There are many line items, right? So will you go through each and every line item? Absolutely not. You don't have to do that. You have to understand why we are analyzing the cash flow statement. First, we want to know whether the cash is coming into the business or going out of the business. So here you can see something called as net cash used or generated from operating activities. So here you can see operating cash flows are positive. So the cash is coming into the business, right? 6,000 crores and 5,000 crores. If you compare it with last year, this year, it is 6,000 crores. So cash is coming into the business. So cash flow from operations are positive. This is very important. Cash flow from operations should be positive. This is nothing but the company is selling products or services and generating cash. So this has to be positive. Next is investing activities. Now what are the investing activities? Here you can see purchase of property, plant and equipment, sale of property, plant and equipment, purchase of some intangible assets, and here you can see purchase of current investments, sale of, these are nothing but fixed assets, fixed deposits or investments in mutual funds or buying some stocks and all. That is the investments. All the investment related activities you will find here. And you see here brackets. Brackets is nothing but the negative amount. So without brackets, it is positive amount. But if you see something in brackets, then that is negative. If it is negative, that is cash is going out of the business. If it is positive, then the cash is coming into the business. Last but not the least, we have cash flow from financing activities. And here you can see dividends paid, dividend distribution tax paid, amounts, deposits. So all the transactions related with, shareholders or bondholders will be shown here. And if you look at, the last 5 years, as you can see, cash flow from operations are consistently positive. So every year, the cash flows are positive. So the cash is coming into the business. And if you convert, now this is what we call as free cash flow to sales. So we check, you will understand what is this free cash flow to sales going forward. So here you can see free cash flow to sales is 13%, 10%, 13, 17. As long as this is more than 5, it is good. Minimum 5% is what we look for. Here it is almost, that is nothing but for every 100 rupees of sales Hindustan Unilever generated, 17% is operating, like 17% this free cash flow to sales. Sorry, this is not free cash flow to sales, I'm wrong. This is operating cash flows, this is free cash flow to sales. So here you can see this is free cash flow to sales. So 10%, 8%, 10.5. So for example, if you look at the current year, for every 100 rupees of sales Hindustan Unilever generated, 14.6 rupees can be taken out from the business. He can put it into his pocket without hurting the business operations. So, and one more thing you can see here, this is the capex of the company. So each year, this is the amount the company is reinvesting for future growth. Buying land, building plant machinery is known as capex. And for example, in the current year, they spent around 895 crores into buying future assets. As you can see, this is the last 5 years data. Now, what is this free cash flow? Free cash flow is nothing but cash flow from operating activities. This 6064 minus 895 will give you the free cash flow, that is 5186. So here you can see in the last 5 years, 3000, around 3000, 3000, 3000, and here it is 5000. So almost 18 to 19,000 crores. So around 18,000 crores of free cash flows this company generated in the last 5 years. 18,000 crores of free cash flows. That 18,000 crores can be utilized in whatever way it is possible, and the business will not be hurt. That 18,000 crores can be paid out as dividends. Entirely it can be paid out as dividends. And this is what we call as free cash flow to sales. This should be minimum 5%, but here, as you can see, it is generating way more than 5%. Now, these are the most important questions we need to ask whenever we are looking at the cash flow statement. First is, what are the major sources of cash? Now, how the company is generating cash? Because cash is king. Without cash, company cannot survive. So the first thing we check is how actually the company is generating cash. What are the major sources of cash? With Hindustan Unilever, you can see cash flow from operating activities, investing activities, and financing activities. So the blue bars are operating activities. So as you can see, the major source of this cash is operating activities. Only operating activities is positive. So what is happening here? Company is generating a lot of cash through operations, and a part of it is reinvested as capex for future growth, and majority of that is paid out as dividends to its shareholders, which is shown in the financing activities. So this should be the ideal scenario. Cash flow from operations should be positive, but investing activities and financing activities should be negative. Why? If the company is investing in future assets, cash is going out, which is a good news. They are buying, more assets. And financing activities, you will find dividends. If the company is borrowing money, then it will be positive, which is not what we want. We don't want the companies to borrow. We want financing activities to be negative. The cash should go out as dividends to us, to the shareholders. So this is the ideal scenario. Financing activities should be negative. Investing activities should be negative, but operating activities should be positive, and that is what happening here. Even for the last 10 years also, the major source of cash is operating activities, and these are negative. You can see, all this is negative, which is good. The next thing that we want to know is, what are the major uses of cash? How the company is utilizing that cash? So here you can see this company invested around 800, 1400, 800. So the company is utilizing a part of it to actually as capex, that is to buy future assets, and the majority of cash is actually utilized to pay dividends. So here you can see dividends paid and tax paid for dividends 3,900, 781. So almost 4,600 crores of dividend this company paid. Actually, it generated around 5,186 crores as free cash flows. Out of that, 895, as you can see, like 890 or 900 is as capex, and around 4,500 it paid as dividends. So as you can see, this company is paying a lot of dividends. This company is utilizing a lot of cash actually in paying dividends. The same thing you will find even in the last 5 years as well. So almost 3,000 to 4,500 crores of dividend this company is paying each year. That is the major use of cash. Next, what is the relationship between the net profits and the cash flow from operations for the last 3 years or 5 years or the last 10 years? This is where we check whether the income statement and the cash flow statement is narrating the same story or not. This is what you can see. So as you can see, cash flow from operations are consistently positive, and even the net profits are also consistently positive. If you look here, they are pretty, it cannot be equal. It cannot be 100. As long as they are more or less similar is what we check for. We check whether they are consistent or not. So in fact, here you can see in 2018 and 2017, cash flow from operations are actually higher than net profits. Blue is net profits, green is cash flow from operations. Here it is almost equal. Here net profits is slightly higher than cash flow from operations. But the thing is whether they are consistent or not, whether they are narrating the same story or not. So here you can see cash flow from operations also positive, net profits are also positive. Even for the last 10 years also, cash flow statement and income statement is narrating the same story. So they are pretty consistent with each other. Next, is cash flow from operations sufficient to cover the capex? Without, if the company cannot cover the capex, then it cannot expand. Simple shortcut. If the free cash flows are positive, that means that company can cover the capex, because after subtracting capex only we get free cash flow. If free cash flow is negative, that means the company cannot cover its capex. So here in this example, Hindustan Unilever is generating, for example, in 2018, 6,000 crores from cash flow from operations. And what is the capex? Only 800 to 900 crores. So obviously that company can easily cover its capex, which is true for the last 5 years as well. So yes, this company can cover its capex. Next, other than capex, is cash being used or generated in the investing activities? So here you can see other than capex. So this is the capex. Other than capex, what the company is using the cash for? As you can see, purchase of current investments, sale of current investments, investing in bank fixed deposits. So they are buying some mutual funds, they are investing in some fixed deposits and all. So that is other than capex. Last but not the least, what are the types of financing cash flows? So for Hindustan Unilever, as you can see, interest paid is very low, around 14.6 crores, which is very low. Increase or decrease of short-term debt and long-term debt is also very low. But the major financing activities of Hindustan Unilever is actually paying dividends. So every year this company is paying at least, on an average, this company paid around 4,000 crores of dividend for the last 3 years or last 5 years. So the major financing cash flows for Hindustan Unilever is dividends. Now that is regarding the Hindustan Unilever, which is pretty simple. What do you think of the cash flow statement? Whether the cash is coming into the business or going out of the business? Obviously the cash is coming into the business, and every other parameter is also very good. Cash is coming in, free cash flows are also very good. The relationship between income statement and cash flow statement is also very good. Whereas if you look at L&T, that is Larsen and Toubro, which is, the construction and infrastructure company, one of the biggest, construction infrastructure company in India. Here you can see cash flow from operating activities, absolutely negative, except 2017, even in 2016 also it is negative, 15 also negative, here 14 also it is negative. So in the last 5 years, only 1 year this company made positive cash flows, remaining year it is negative. And what about the free cash flows? As you can see, free cash flows are also negative. Now, if you look at Hindustan Unilever, in the last 5 years, Hindustan Unilever generated 18,000 crores of free cash flow, whereas L&T lost almost around 40 or 30,000, around 30,000 crores. This company lost around 30,000 crores of, or have generated negative 30,000 crores of free cash flows. Money losing company, or it is just burning cash. So as you can see, free cash flow to sales is also negative. So the cash is not coming into the business, but cash is going out of the business. So let's ask the most important questions for this company. What are the major sources of cash? As you can see, red is nothing but the financing activities. So even in the last 10 years also, the major source of cash is not its operations. Operating activities, the company is always generating negative. You look at the last 10 years, most of the years the company has generated negative cash flows. So the major source of cash is not operations. But for the last 10 years, each and every year this company is borrowing money. So the major source of cash for this company is either borrowing or diluting the shareholders' equity, which is a bad news. So what is the ideal scenario? This has to be positive. These two should be negative. But here, these two are negative. Financing activities is positive, which is not what we look for. So what are the major source of cash for L&T? Debt, borrowings. Next, what are the major uses of cash? For Hindustan Unilever, a part of it is used for capex, and the majority of cash is actually used for paying dividends. We will see what is the major use of cash for L&T. So here you can see, this is L&T. So this company, as you can see, capex, here you can see capex. So 2,000, 2,000, 3,000, this company is investing a lot in capex. They are investing in capex, and they are also investing in some purchase of investments, 7,758 crores. First of all, this company is not generating any cash. Cash flow from operations itself are negative. So they are surviving on borrowing. After you borrow money, you invest 7,700 crores into mutual funds. Why? It makes no sense. And on the top of that, they are generating some dividend income. And the biggest funny part is, or the funniest part is, okay, I'll cover the funniest part later on, but you have to understand, they are investing in capex, and they are investing in some fixed deposits, and some, they are generating some dividend income as well by investing in mutual funds, which they can't, they don't have the luxury to do that. Next, what is the relationship between net profits and cash flow statement, whether they are narrating the same story or different story? As you can see, cash flow from operations is narrating a different story, whereas the income statement is narrating a different story. If you see here, like I said, the funny part, the funniest part of L&T is, here you can see, this company is paying dividends. Look at the borrowings, 12,000 crores, 5,000 crores, 10,000 crores, 11,000 crores, 17,000 crores. So every year this company is borrowing a lot of money, and that is the only source of survival for L&T. They are borrowing a lot of money, they are investing in mutual funds, and they are paying dividends as well. Now tell me, this company is not generating any cash from its operations. then why it is paying dividends? Here you can see 2,300 crores of dividends, 2,000 crores, 1,800 crores, 1,500 crores, 1,400 crores of dividend this company is paying, which is funny. This company doesn't have the luxury to pay dividend. They are not generating any cash, but why it is paying the dividends? You have to understand. They are paying the dividends for this reason. Here you can see income statement is narrating a different story. Cash flow statement is narrating a different story. Cash flows are consistently negative. Even in the last 10 years also you can see many years cash flows are negative, but income or net profits is positive. So here you can see in 2008 net profits were 2,200 crores. Here in 2018 it is 8,000 crores. So consistently every year the net profits are increasing. So it is showing roaring net profit growths, but without collecting any cash. But people or investors are not really concerned about what is happening on the cash flow statement. They are only concerned about what is happening in the net profit. So earnings growth is what they look for, or income statement is what they look for. So generally they are not concerned about cash flows, right? So to cover up that cash, what they are doing, they are paying dividends. So they will be like, we are generating so much of cash, we are generating a lot of net profit, so take dividends. But if you look at the cash flow statement, you will understand L&T cannot pay dividends. They are not eligible. But who check the cash flow statement? Rarely people go and check the cash flow statement, right? So this relationship is absolutely irrelevant, because one, income statement is narrating a different story. Cash flow statement is narrating a different story, which is very risky. Cash flow from operations sufficient to cover the capex? I don't think so. As you can see, free cash flows are absolutely negative. And the thing is, even cash flow from operations are also negative. So when the company is not even generating anything in operations, how will it cover the capex? The capex is covered only by taking debt. This company is borrowing money. Otherwise, it wouldn't have survived. So the answer is no, absolutely not. Other than capex, is cash being used or generating in investing activities? As we have already covered, they are investing into some mutual funds, and they are generating some interest income from fixed deposits. They are generating some dividend income from mutual funds and all. So they are doing whatever they want with that cash. Types of financing cash flows. For example, in Hindustan Unilever, what are the major financing cash flows? Dividends. But whereas if you look at L&T, dividends, actually this company cannot pay dividends, but it is paying. That's a different story altogether. But the major financing cash flows here in L&T is debt or borrowing. So as you can see here, each year this company is paying interest and it is borrowing a lot of money. So in the last 5 years, this company borrowed almost 60,000 crores as debt. So almost 60 to 70,000 crores this company borrowed, and that's how it survived. So as you can see, what is the bottom line? Cash flow statement records all the cash that comes into a company and all the cash that goes out. And this statement ties the income statement and balance sheet together. So the thing is, whenever you are looking at the cash flow statement, we basically try to understand the quality of earnings. See, company can show roaring sales growth, roaring net profit growth without collecting cash, and we don't want that to happen. So that is the reason, along with the net profits, we check the cash flows as well. We want to know whether it is real profits or it is just paper profits. With Hindustan Unilever, whatever the profits the company was generating, it was real profits. But with L&T, most of them are actually paper profits. They are not real profits. Now comes the growth analysis of the company. So obviously, I mean, why we check the income statement of the company? To understand the growth, whether it's a high growth, whether it's a low growth, whether it's a moderate growth and all. But not every growth is equal. There are majorly 4 sources of growth. First is selling more goods or more services. For example, you are analyzing a company, you are looking at the income statement, and let's say the net profit growth is, let's say more than 15% for the last 5 years, let's assume. So you thought, okay, it's a high growth company, but 15% is okay, but what are the sources of growth? Half the company is generating 15%. What is the reason? You have to understand. First, selling more goods or more services, we call it as volume growth. For example, in the first year, let's say a company might be selling soaps. In first year, they sold 1 lakh soaps. Second year, they sold 2 lakh soaps. Next 3 lakhs, next 4 lakhs, next 5 lakhs. So they are increasing the volume, the number of units. So that is the first source of growth, volume growth, or selling more goods or more services. By that they can grow. The second source of growth is by raising prices. You just raise the prices and you grow. For example, if you look at ITC, they are into cigarette business. 80-85% of revenues they are generating from cigarettes. And anything happens on this planet, it can be GST, it can be RERA, it can be earthquake, it can be flood, it can be lockdown, whatever happens on this planet, ITC has only one tool in its toolkit, that is to raise prices. Here you can see in 2005, Gold Flag cigarettes has gone up from 28 rupees to around 30 rupees. That is in 2005. But the same thing in 2017 due to GST, again they raised prices. Due to lockdown, they raised prices. Now whatever happens, they raise prices, and they have got loyal customer base. Loyal, they are loyal to this brand, so they will not leave. Even if they increase the price also, they will not leave. They will still buying the same product. So raising prices is the second source of growth. Third source of growth is like selling new goods or new services. For example, if you look at Apple, initially Apple started as a computer company. Eventually they entered into laptops, phones, watch, iPods, iPads. Now they are into many different segments. So as you can see, they are selling new products, they are launching new products or new services, and they are growing. For example, even if you look at ITC also, initially it was a cigarette business, but today it is not just a cigarette business. ITC is a diversified company today. Today ITC is into FMCG, they are into hotels, they are into paper, they are into stationery, they are into agro products. So as you can see, initially ITC started as a cigarette company, but eventually they expanded into hotels as well. So it's a diversified company now. So by selling new goods or new services, a company can grow, which is the third source of growth. Fourth source of growth is buying another company, or we call it as acquisitions or mergers. Recently, there was a merger between Vodafone and Idea. For example, if you look at Facebook acquired WhatsApp, it acquired Instagram. So as you can see, if you look at Google acquired YouTube. So by acquiring other companies or buying other companies also, we can grow. A company can grow. That is the fourth source of growth. Now the point is, out of these four sources of growth, what source of growth I like the most? For me, the first two is what I generally look for. Raising price is good, volume growth is good. So whenever I am investing, I like to invest in companies that are growing either through volume growth or by raising prices. Some companies have both. They have volume growth as long as pricing power is also available. So it's good. This I would consider as moderate, quality growth. First two are high quality growth. Third, by selling new products, new services, I consider it as moderate quality growth. Why? Because, for example, you are into a shampoo business. Your shampoo business is successful. So you can expand it. You can sell more goods, more services, you can raise prices, you can be successful in that segment. But you want to sell, let's say, toothpaste. Now this is entering into a new market, which is 50-50. The probability is, let's say, 50-50. So you can get successful or you can fail. So by selling new goods, entering into new services, new goods, new products, the company can or cannot be successful. So there is always that uncertainty, right? So that is the reason I would consider it as moderate quality growth. Last is buying another company. I just avoid such companies. If the company's source of growth is only through acquisitions, I'm not interested. I will not buy that company. I want either volume growth or raising prices. Once in a while, entering into new products, new services is also okay for me. But volume growth and pricing power is what I look for. If the company is acquiring a lot, I will just avoid it, no matter how great the growth might be. So, and one more, there is a fifth way of growth as well. I have not covered it here, but there is a fifth way of or fifth source of growth, which is cutting cost. A company can grow its net profits by cutting cost, but I have not provided here because cutting cost cannot happen forever. It is not sustainable. A company can cut cost and grow for, let's say, 2 years or 3 years, but forever it cannot do, right? So it is not sustainable. That is the reason I have not provided. But even cutting cost is also not high quality growth. I mean, being cost conscious is good. I mean, every company has to be cost conscious. Now, unwanted expenses should be controlled. That is very good. But only by cutting cost, you cannot grow forever. That strategy will not work in long term. So these are the source of growth. And when I look for growth, this is what I look for. As you can see, revenue growth is consistent. Net profit growth is also consistent. As you can see, all the positive numbers. Sales growth should be positive. Net profit should be positive. So these are the kind of numbers I look for. If the numbers look like this, I just avoid that company. As you can see, revenue growth is negative. Earnings growth is also negative. Unitech, MTNL, Videocon, as you can see, erratic growth rate. This is what we call it as consistent growth companies or stable growth companies. Now, these are stable growth companies, positive. Mostly all the numbers are positive. Now, these are erratic growth companies, negative. Everything is negative, loss-making companies. So we generally avoid these companies. That is regarding the growth and source of growth. Now comes the most important part. Now, once we are done with this profitability analysis, what we will do is we will apply whatever we have learned so far. We are going to apply it on real companies. So this is once we apply it on real companies, we will take a break. We will take the lunch break of 1 hour, and then we will join back. So profitability analysis, as you already know, what are the most important things that we look for in a company? I'll cover. Financial health is one. Growth, right? Growth is what we look for. Quality of earnings is what we check. And then comes the profitability. We always invest in high profitability companies, right? So far we have done financial health, that is balance sheet. Growth, that is income statement. Quality of earnings, that is cash flow statement. So far we have covered that. Now let's look at profitability. And in profitability, there is high quality profitability and high quantity profitability as well. So profitability has got two sides, high quality profitability and high quantity profitability. So first, let's start with high quality. How to know whether the company is generating high quality profitability or not? For that, we use something called as DuPont analysis. Now, what is this DuPont analysis? Remember one thing, every number that you see has a story behind it. Every number that you see has a story behind it, and every story that you narrate in terms of investing should be supported by a number. So that is what investing is all about. For example, you see 19% here. Bajaj Auto return on equity, you can see 19.25. So in general, 19.25% return on equity is good. As long as it is more than 15%, we are happy. But how do you compute that 19.25% return on equity? The simple formula is return on equity. Formula is very simple. Net profits divided by book value. Book value is nothing but shareholder funds and all. I have already covered it. In the balance sheet, I showed you net worth, right? This is the net worth. This is the net profits. Net profits you will find in the income statement. For example, let's say net profits is, let's assume, for example, a company is generating a net profits of 192 crores. and let's say its book value is 1000 crores. Now, what is the return on equity here? 19.2%. That is the return on equity. And if you look at here, 19.2%. But the thing is, where is the story? Just you divide net profit by book value, there is no story. You are not understanding whether, we will not be able to understand whether it's a high quality growth or low quality growth and all. The same return on equity can be computed using DuPont analysis, that is net margins multiplied by asset turnover ratio multiplied by financial leverage will give you a return on equity. That is nothing but, instead of using this formula, you can use net profit margins into asset turnover ratio into financial leverage. Even this also will give you the same return on equity. Now what happens here? You have a story here. You can check which key parameter is actually helping this return on equity. What is the key driver? We can understand what is the key driver for the return on equity with the help of DuPont analysis. So for example, if you can, with the help of this DuPont analysis, we can analyze the business model of a company as well. First, let's look at automotive industry. We have Bajaj Auto, Hero MotoCorp, Maruti Suzuki. Maruti Suzuki is 4-wheeler. Bajaj has 2-wheeler and 3-wheeler. Hero MotoCorp is only 2-wheeler company. Okay, this is only 2-wheeler. This is 2-wheeler and 3-wheeler. This is 4-wheeler, but more or less they're all from automobile industry. So first, let's look at Bajaj Auto. If you look at the return on equity 19, 21, 27, 25, so consistently it is generating more than 15% return on equity, which is good. Next, Hero MotoCorp is also consistently generating more than 15, right? But if you closely observe, for Bajaj Auto, the net margins are very high. 15%, 16%, 20% and all. But check Hero MotoCorp, net margins are not that high. 11%, 11%, 10%, 8%, 8%. So 8-9% net margins, 15-16% net margins. So they are both in the auto industry, but Bajaj, the key driver for Bajaj is actually margins. Whereas if you look at Hero MotoCorp, it is turnover based business. You can see the asset turnover 1.86, 1.86, 2.2, 2.5. What about the asset turnover of Bajaj? 1, 1, 1.3, 1.4. Here you can see 2.2, 2.58. So even though they are in the same industry, Bajaj Auto is a margin business. Hero MotoCorp is volume business, turnover, volume. So so Hero MotoCorp is not into premium market. It is more into value for money market. Whereas Bajaj is more into little bit of premium market. So that is what you can understand. But both, now what happens is net margins into asset turnover will give you the return on assets of the company. You have to understand one thing, along with return on equity, we check the return on assets of the company as well. And this return on assets should be minimum 8%. If it is not 8%, then we will not invest in that company. So for us, minimum return on assets that we look for is 8%. So Bajaj is also generating more than 8% return on assets. Hero MotoCorp is also generating more than 8%. In fact, not more than 8%, but 21, 22, 23, 24%. But the reason is very different. Bajaj is a margin business. Hero MotoCorp is a volume business. And you add leverage. Because of this leverage, they are able to generate a little higher return on equity. So leverage is helping. So leverage can help a company. Leverage is nothing but the borrowings or the liabilities. So the liabilities or the borrowings can help a company to boost its return on equity, which can be dangerous at times. Why it is dangerous, I will show you going forward. Whereas if you look at Maruti Margins are around 9%, 10%. So moderate margins. Asset turnover is 1.3 to 1.31, 1.3. This is a four-wheeler vehicle. 1.3 is not a joke. 1.3 is very high because the ticket size is very high. For example, if you want to buy a car, minimum 6 lakhs or 5 lakhs is what the starting range. So it's a very big ticket size, right? So 1.3 is very high in terms of turnover. So Maruti is also a turnover business, not margin business, but they are also into value for money market. So that is also in more of a volume business. But as you can see, they are also generating more than 8% return on assets. The return on equity is also more than 15%, which is good. Hindustan Unilever, you can see very rarely you will find such companies. Margins are very high. Turnover is also very high. So look at the return on assets. Absolutely top notch. And look at return on equity. 66, 63, 108, 101, 134. Profitability is very high. More than 100% return on equity this company is generating. But the thing is, it's a low growth company. It is generating high profits, but it is not reinvesting any of it because there is no growth. So it's a mature company. So that is the reason, even though it's a high profitable company, we avoid because of its low growth rate. Next, we have Reliance Power. Margins, you can see 10%, 10%, 8%. So high margins, right? 20, 40, 70, high margins. But the thing is, there is absolutely no volume. No one is buying their products, to put it simply. So here you can see 0.05, 0.04 net margins. Sorry, asset turnover. So that is the reason, if you compute, if you multiply margins into turnover, you will get return on assets. This has to be minimum 8%. But here you can see 1%, 1%, 1.4%, 1.6%. Very low, right? So even if you add leverage, it is still 4%, 5%, 4%. So as you can see, return on equity is very low. So we will avoid such companies. Very low profitable companies, we will avoid. Now comes L&T. Now let's look at L&T. Net margins, as you can see, moderate. Not low, not high. They are moderate, around 7, 6, 5, 5, 6, 7 and all. What about asset turnover? Asset turnover, as you can see, is also low. So 0.52, 0.48 and all. So what about return on assets? Low, lower than 8%. So lower than 8%, right? 2%, 3% is not we are looking for. Minimum 8 to 10% is what we look for. So this company is not generating enough return on assets. But if you just focus on return on equity, 15%, 13%, 12%, but at least in the here you can see 15%, 15%, 17%, 26%, 20, 21. So if you take the last 10-year average, it is more than 15%. So that is the biggest risk. So if you compute return on equity just by taking net profits by book value and you get a 15%, this 15% can be high quality return on equity or it can be low quality return on equity. How will you know it? Because there is no story behind it. That is just a number. But here, with the help of DuPont analysis, we are able to understand how the company is generating that return on equity. We are able to compute or understand what is the key driver. And for L&T, what is the key driver? The key driver is its financial leverage. You can see here, return on assets is very low. But even that 3.44% of return on assets were boosted to 15% return on equity with the help of financial leverage. Financial leverage should be less than 4, right? And here you can see 4.4, 4.2, 4.4, 4.76, 4.5. Consistently every year it is more than 4. So which is risky, right? So even though L&T is generating 15% return on equity, it is still considered to be low quality profitability. Hindustan Unilever, high quality profitability. Reliance Power, low quality profitability. Bajaj, high quality profitability. Hero MotoCorp, high quality profitability. Maruti Suzuki, high quality profitability, because the key drivers is either net margins or turnover. So as long as the key drivers for the return on equity is either net margins or asset turnover, it is well and good. But if the key driver is financial leverage, then it's a low quality, return on equity. We will not invest even if it is more than 15% also. So far we have covered high quality profitability. Now let's look at high quantity profitability. High quantity. How do we measure that? We use this formula. Free cash flow to sales. We use free cash flow to sales to evaluate the quantity of profitability. So for example, let's look at the same companies. Bajaj Auto, you can see cash flow from operations. This is capex. Owner's earnings is nothing but free cash flows. Free cash flows are also called as owner's earnings. So with Bajaj Auto, you can see owner's earnings are consistently positive every year. And free cash flow to sales is 16, 14, 15, 8. As you can see, minimum 5% is what we look for. And I don't look at the current year. What I do is I take the last 5 years average or last 10 years average, and I want that average to be more than 5%. So with Bajaj Auto, as you can see, it is clearly more than 5%. So Bajaj Auto was generating high quality profitability and it is generating high quantity profitability as well. Whereas if you look at Hero MotoCorp, as you can see, its free cash flows are very high, and you can see free cash flow to sales is also very good, more than 5%. Maruti Suzuki, as you can see, Maruti Suzuki also generating high free cash flow to sales, more than 5%. So high quantity profitability these companies are generating. Hindustan Unilever, you can see 14, 11, 10, high quantity. What about L&T? Now you might be thinking I have some grudge on L&T. No, I have no personal grudge on L&T. I'm just giving you the facts. That's the fact. So as you can see, L&T's owners' earnings are negative. As we have already covered in the cash flow statement, it's a company with negative cash flows, right? Negative free cash flows. So for that reason, its free cash flows are negative. So low quantity profitability, right? What about Unitech? Now you can see Unitech cash flow from operations itself is negative here. As you can see, negative. But if you focus on the free cash flow to sales, 32%, 20%, 81%, 33%. How is it possible? The reason is, here you can see this company is liquidating its assets. So 1300, you can see here, if this number is negative, that means that company liquidated the assets. Sorry, if this number is positive, then it means the company has liquidated. So here you can see capex. So basically this company is liquidating the assets, and that is the reason these numbers are very high. 33%. Why? Because instead of reinvesting in capex, this company sold its assets and generated 138 crores. Here you can see, instead of reinvesting, this company sold and generated 251 crores. Here this company generated 301 crores, around 301 crores of profit. So basically it is liquidating. So don't consider this company as high quantity profitability. No, that profitability is actually generated by liquidating the assets. Now comes the most important thing, profitability matrix, that is high quality profitability plus high quantity profitability. By using this, we understand this profitability matrix of a company. So this is the profitability matrix. There are 4 types of stocks. Now this is the most important concept that I want you to understand, my dear friends. This is very, very, very important. There are 4 types of companies: great companies, emerging companies, declining companies, and worst companies. Okay, we can't write here. Worst companies. 4 types. Let me repeat: great companies, emerging companies, declining companies, and worst companies. How do we differentiate that? Very simple. If a company is consistently generating more than 15% return on equity, and more than 5% free cash flow to sales, then it is considered to be a great company. So high quality profitability, high quantity profitability if a company is generating, it is called as great company. Generally, these great companies are very low risky companies, absolutely very low. Then comes emerging companies. That is, in this emerging companies, the return on equity is more than 15%, but free cash flow to sales is less than 5% because they are investing a lot of cash into capex. They are investing a lot of money for future growth, to buy land, building, plant, machinery and all. So they are investing for future assets. So future growth, I will invest in such companies as well, because they are emerging companies. They are, they are in their young high growth phase. So they might not generate high quantity profitability, that is high free cash flows now, but since they are generating high return on equity, on that incremental capex also they are generating high profitability. So the value will be created. So eventually, after the company has grown to a certain extent, it will start generating positive or high cash flows. So this is emerging businesses. This is declining companies. That is, return on equity is less than 15%, but free cash flow to sales is more than 5%. Why? Because they are liquidating assets. They are selling off. They are dying down. They are not generating any profits. They are just selling their assets and they are generating cash flows. So eventually the company will die down. Last but not the least is worst company. Return on equity is less than 15%. Free cash flow to sale is less than 5%. Na gar ka na ghat ka kind of companies. So in which company we place more emphasis or we try to invest more? This is where we invest in great companies and in emerging companies. So yes, I invest in emerging companies as well. So if I am getting a great company at favorable price, I'm happy. But emerging companies also I will invest. So as long as the return on equity is more than 15, but if the free cash flow sales is low, I will check the growth rate of the company. The growth rate is 20%, 25%, 30%. So company is generating high profitability and it is generating that growth also by investing this free cash flows. So I am fine. So if the free cash flows is less than 5% also, I am fine. But I will not invest in declining companies. No. For me, return on equity has to be 15%. So here 15% is not achieved. Here also not achieved. So I will not invest in worst companies. I will not invest in declining companies. This is where I try to allocate my money. And this is the profitability matrix of Bajaj Auto. Free cash flow to sales is more than 5%. Return on equity is more than 15%. High quality profitability, high quantity profitability. So in profitability matrix, which company can we consider it as? Obviously, it's a great company, right? Return on equity is more than 15%, free cash flow to sales is more than 5%. So it falls into the profitability matrix of a great company. What happens if you invest in great companies? So, the current share price are much higher. These are little older slides. So as you can see here, in 2008, the share price was around 300 rupees. In 2018, when I was looking at this slide, it was around 3,000 rupees. Current share price are very different. So here you can see 10-year CAGR is around 15%. Maruti Suzuki, as you can see, it falls. Free cash flow to sales more than 5%. Return on equity more than 15%. So great company. As you can see, from 430 to 6,754, 10-year CAGR around 15% compounded return. Hindustan Unilever, as you can see, it's a great company. From 132 rupees, 1962, 10-year stock price CAGR is around 22%. So here you can see it is 22%. Next is L&T. So here we can see free cash flow to sales is negative. Return on equity is positive. Now in general, you can consider that in general, see, return on equity is 15, free cash flow to sales is negative. So in this 4 matrix, where do you think it will fall out of this, four, great company, emerging company, declining company, or, worst company, where it will fall? In general, you might be thinking like it may fall under emerging companies, right? Return on equity is greater than 15%, free cash flow is less than 5%. So it will be an emerging company. But as you can see, I have considered it as bad company. Why bad company? Why not emerging company? Even though it is generating 15% return on equity, that 15% is low quality profitability. What is the key driver? The key driver was financial leverage. The only way L&T was able to boost that return on equity beyond 15 is by borrowing money. So, which is a low quality profitability, right? So that is the reason, even though it is more than 15, I will still consider it as bad company and I will avoid it. This is what happened with L&T. So just 7% CAGR is what it generated in the last 10 years. I mean, if you consider the current scenario, it generated even less than that. Unitech, free cash flow to sales is negative, return on equity is also negative. So it is a worst company. What happens if you invest in worst companies? This is why I will always suggest you to never invest in money losing companies, never invest in worst companies, because this is what happens. In 2008, it was trading around 422 rupees. Here you can see 0.5, 522 rupees to 0.5. Almost everything. Shareholders have lost 99.99% in this company. They have lost everything. Asian Paints is a great company. High quality profitability, high quantity profitability. So what happens if you invest in great companies? 39 rupees to 1000. Actually, 1000 is not the price, but 10 years CAGR is around 29%. Page Industries, one more high quality, great company, 271 to almost 35,000 or 40,000 current share price, 42% CAGR, 42%. Pidilite Industries is also a great company. So what happens if you invest in great companies? 34% CAGR. GMR Infra, worst company, low quality profitability, low quantity profitability. What happens? From 125 rupees, it dropped to around 17 rupees. Stock price CAGR, you can see negative. It generated negative returns. Reliance Power, absolutely low quality company, low quality profitability, low quantity profitability. From 277 rupees, the share price dropped to around 2 rupees. So almost everything, right? Almost 98% of money they lost, the investors. So as you can see in CAGR terms, it is negative 34%. So as you can see, here you can see the companies have lost. Given these four matrix, where we have to invest, if you want to make consistent money or if you want to create huge wealth in the stock market, this is the hunting ground. I mean, this is low risky, absolutely low risky. Here we have a moderate level of risk, but return will be very high. Very high return you can generate by investing. 100 baggers you will find here. If you want to invest 1 lakh and turn that 1 lakh into 1 crore, you go for emerging companies. That is where you will find, such, 10 baggers, 20 baggers, 50 baggers, 100 baggers, you will mostly find in emerging company space. But this is where I generally invest, either in great companies or emerging companies. So that is regarding the profitability matrix. And one more concept I need to cover is financial fakery. Yesterday, this topic is also mentioned in the details of the contents to be covered. So last topic, the conceptual last topic, then we will cover, then we'll go through the Excel sheet and all. So obviously we have to avoid companies that cook their books, fudging books. I'll give you a practical example of my own. Around in 2017, I was analyzing a stock and I got pretty excited by looking at this stock because it was a very high growth company, high growth, and it's very low debt company, debt to equity ratio was almost zero. Net margins are also very high. return on equity is also more than 35%. So I felt like, such extraordinary growth rates, extraordinary margins, extraordinary profitability. The stock was trading around 4 times earnings or 5 times, 4P or 5P. So I thought like it was trading at, at dead cheap prices. So I thought it will be a multi-bagger, but before investing in a stock, I check its annual report. So why investors lose money in the stock market? Because 99% of the investors doesn't read the annual report. They doesn't read the annual reports, and that is the reason they lose money. Because the red flags, you will find many red flags if you can go through the annual reports. So I'll just share some of the scariest things that I found in the annual report of this company. So first is auditor's opinion. Significant misstatement of financials is possible. So here you can see, this is the auditor's opinion. A material weaknesses was identified, and material misstatement is what they mentioned here, material misstatements. So the auditors of the company are generally, auditors will not talk badly about a company, but as you can see here, they mentioned that material weakness is found, material misstatement is found. That is, whatever numbers posted by the company, they cannot be trusted. In plain language, the numbers posted by the company cannot be trusted. They are misstated. The auditors gave an opinion like that, so we better trust them. The second red flag is qualified opinion of the author. In general, qualified is a good term, right? In general, is a qualified investor, is a qualified teacher, is a qualified doctor. So generally we take this qualified as a good term, but when it comes to auditing and investing, qualified opinion is not good. So if you find a qualified opinion from the auditor, that means there is something serious issue with their accounting. Whether they might be deviating the accounts, or there is some errors, there is something wrong. So you should avoid investing in such companies no matter what. If you find a qualified opinion from auditors, you have to avoid that companies. And what is the audited opinion on what they have given the auditor qualified opinion? Here you can see qualified opinion on the adequacy and operative effectiveness of internal financial controls over financial reporting. So they are mentioning like why they have provided that qualified opinion, because they think that they are not maintaining internal financial controls efficiently, and the numbers are significantly misstated. So we are highlighting this, we are qualifying this. So you better check this before investing, is what auditor is telling us. So we shouldn't invest in such companies. Next is they are consistently breaking all the rules in the book. They are consistent rule breakers. Now, for example, they have entered into a related party transaction without taking the prior approval of the audit committee. Whenever the management is, making related party transactions, they have to take the permission of the audit committee. And here they have not taken any permission. They have done the transaction, and after transaction, they said, going forward, the company will take suitable steps to obtain prior. The transaction is already done. So what steps you will take after that? So they just said, we are sorry, going forward, we will not continue. That's what they said. Next, the company didn't file MGT 10 pursuant. So basically, one of the promoters sold 2.24% of his equity shares. Now, whenever the promoter is selling the shares, he have to file that MGT 10. But here he didn't file anything. Again, they gave the same response. Going forward, we will not continue the same mistake. Next, Companies Act 2013 has not been compliant. Again, they said we will not continue going forward. They said that one of the promoters sold 16,50,000 shares, 16.5 lakh shares, and those shares are not reflected either in the promoters category or they are not in the public category. Where they have gone? The promoter is in the process of taking up the same with the concern for necessary corrective measures. They are consistently breaking all the rules, as many rules as possible, and they are giving very funny reasons as well. The only reason is going forward, we will not continue. They are recognizing revenues on expired contracts. I mean, I've seen companies that recognizes revenues aggressively, which is fine. They sometimes, give some credits, they extend the credits and all, they provide some discounts and all to generate, additional sales. But this company is basically broken all the rules. They are recognizing revenues on expired contracts. The contracts have expired, but still they are generating revenues from expired contracts. So here you can see in respect of expired contracts under renewal, revenue is recognized based on the erstwhile contracts or provisionally agreed terms and conditions. The contracts have expired, so they cannot make any money on expired contracts, but still they are booking sales on past agreements, which is great. Only this company can do that. Again, the promoter shares are not reflected either in promoter category nor the public category. Next, this is very significant, like 99.6% of revenues are not audited by this auditor. So basically the auditor gave a qualified opinion, right? See, whatever is the numbers, I am not trusting the numbers. You also don't trust the numbers, is what auditor told us. But 99.6% of the revenues are actually not audited by that auditor. So this is what he said. We did not audit the financial statements of 5 subsidiaries whose financial assets reflect around 842 crores of sales. That is 99.6%. And I've read the annual report, and they didn't mention who actually audited that 99.6%. They have to mention, and they have to provide a report from that auditor as well. So I mean, I'm not sure who is auditing the revenues. They have not provided anything. They didn't mention the name of the auditor. But obviously, whenever I'm actually analyzing a company, I go through the past interviews of the management. If I can find any, I like to go through their interviews as well. So randomly, while I was analyzing this company, I happened to watch one of their interview, and this is randomly, I happened to watch it randomly, and I found this randomly. So let me share it with you in this video. It's a small video of 20 seconds. So in this video, the CEO will share the name of the auditor. So you pay attention, because he will tell you the name of the auditor.
Okay. What about there were also some bit of concerns in terms of auditors. Just wanted to clarify. So Deloitte is the auditor for your India business. Who's auditing your overseas operations, because majority of your business comes in from there?
Venkatraman Associate, Venkatraman Associate, Venkatraman Associate, Venkatraman Associate, Venkatraman Associate is out of New Jersey, is auditing our US books. There is an auditor for Dubai. So each auditor auditor the local thing, and we have a plan to have one auditor, a global auditor for all our subsidiaries in the very near future. We are looking at it.
So I hope you got the name of the auditor. So Venkatraman Associates, right? So Venkatraman Associates is the auditor that is auditing their foreign books. I want to show you something. This is the shareholding of the promoters. But before we look at the shareholding of the promoters, I want to show you something. By the way, this company is 8K Miles. The CEO, this is Suresh Venkatachari, CEO and Managing Director of 8K Miles, software. So this company is 8K Miles. Suresh Venkatachari, CEO of the company. RS Ramani, CFO of the company. MV Bhaskar is one of the promoters. These three are the promoters. Now, I am not really sure whether I am right or whether I am wrong. I am not really sure. I am not certain. But I have this doubt, a small doubt. And I'll show you what is that doubt. You can see Venkat here, Venkat, R.S. Raman, you can see Raman here. Now you add up these two numbers. That is Venkat Raman Associates. Venkat Raman. I'm not sure whether I'm right or I'm not. I mean, I'm wrong. I'm not really sure. But after seeing all the red flags and after hearing the name of the auditor, what I have understood is they are auditing their own books. They are writing their own exam and they are correcting their own paper. Obviously, you will be state first. If you are correcting your own exam paper, then you will give 100 out of 100, right? That is what happening here. So Venkat Raman Associate is their own. I mean, they are auditing their own books and they are posting whatever numbers they want. Will and their will and their wish. Whatever they want, they are posting. So I'm not really sure whether I am right or not, but looking at all the red flags, I think Venkat Raman Associates is their own company. And if you look at the promoters, shareholding of promoters, here you can see 55% is owned by the CEO, 7% by CFO, 0.54 from some other promoter. And out of this 55%, 14.5 lakh shares is pledged. Ramani pledged 2.5 lakhs. That is the beginning of the year. But by the end of the year, the pledge of Suresh Venkatachari increased from 14.5 lakhs to 19 lakhs. And R.S. Ramani sold from 7%, only 1.5% he held by the end of the year. He sold 5.5%. Majority of stake he sold. Whereas MV Bhaskar 0.54 he had. By the end of the year, only 0.04 he had. 0.5. He also sold more than 95% of his holding within 1 year. Ramani and the other promoter Bhaskar is selling shares like anything. They are selling their entire quantity. And for CEO, his pledge is increasing. Now, I have an issue with promoters pledging their shares. That is, this pledge is nothing but you pledge your shares with a financial institution like bank or, like any financial institution. It can be anyone, or you can go to someone and you can pledge the shares and you can borrow some money. In case if you are not repaying your principal amount, then that shares will be sold in the market by him, which will play a significant role. Because if significant amount of shares are sold in the market, then the share price will crash. The investors will affect, right? So the point is, pledging the shares is an indirect way of selling the shares. If the promoter is selling the shares, then people will notice it, right? We all will notice it. Everyone will get to know. But if we go and pledge the shares, and if it didn't repay, they will sell it off, which is an indirect way of selling shares. So that is also a red flag. So I will never invest in a company where the promoters or the executives are selling their shares in large quantities. Now, when the owner is selling his shares, why would I buy it? I mean, it makes no sense. So as you can see, during the current year, the company, now someone asked, like not in this interview, in one of other interviews that I watched, someone asked the CEO, the Suresh Venkatachari, someone asked him like, why your CFO is selling shares like crazy? What happened to him? Like from 7% he reduced it to 1%. Someone asked. The CEO replied that our CFO want to get into philanthropy. He want to do some charitable, he want to do some charity. So that is the reason he sold majority of his stake. Now he want to retire in his life. He want to do some charity. That is the reason he sold. You know what he did with that money? You can see here, during the current year ended, the company obtained unsecured loan of 37 crores, 37.5 crores and 55 lakhs from R.S. Ramani and from Suresh Venkatachari. The thing is, end of the year, this CFO RS Ramani provided 37.5 crores of debt to this company. According to him, that is the charity. So he's selling his shares, he is selling for charitable purpose. But let me tell you what happened here. CS Ramani sold his shares in this stock and gave a loan of 37.5 crores to 8K Miles. Now what 8K Miles have done? They have taken that money, and you can see here RS Ramani loans taken from RS Ramani is 37.5 crores. CEO is 55 lakhs. Now what happened to that money? Loan or advance is given. Now this company provided loan of 106 crores to subsidiary of 8K Miles Media Group. Last year also they provided around 36 crores. So what happened is that subsidiary of 8K Miles Media Group is in US. So simply they siphoned money from India to US. CFO sold his shares around 38 crores, gave it as a loan to this company. This company took that money, gave it as a loan to 8K Miles, some media group in US. From India, the money has gone to US. Done deal. Simply they are siphoning funds in the most white collared way. And what happened with that money? Now we can take a movie. Lot of things happened with that money, but the end game is like, as you can see, there are a lot of suspicious things happening in this company. So how to identify the financial fakery? First is account receivable. As you can see, accounts receivables increased significantly from 13 crores to 252 crores. Significant. As you can see in percentage terms also, it significantly increased. So short-term borrowings, as you can see, long-term borrowings. So here you can see declining cash flows. The first red flag is declining cash flows, and you can see here total shareholder funds as a percentage, it reduced from 62 to 71, 71 to 59. So shareholder funds also reduced. And if you look at the, let's compare net profits and cash flows. Cash flow from operations in the last 5-6 years is 150 crores, whereas net profits is 422 crores. This company generated 422 crores in net profits, but collected only 150 crores of cash. Now what happened to around remaining 300 crores? That is all paper profits. So this company is not collecting cash. It is only providing that, credit and, increasing its sales and net profits. So all of that is paper profit, not real profit. So there are so many other major issues with this stock. The CFO sold his stake, board revised its dividend policy, cash on the balance sheet reduced, goodwill is almost 70% of the total assets. Companies negative, free cash flows are also negative, cash flows are also negative, and they are issuing shares and taking debt. So what is the source of, cash for this company? Financing activities. Day sales, that is debtor days. We call it as day sales outstanding. Even that days also increasing. Little allowance for, credit loss. Okay, this is one more significant thing in shareholder information. So you will find every company will provide the top shareholders of the company. Now in that top shareholders, one of the investor has more than 5% of shareholding in this company. He is not promoter. He is some private retail investor who is having 5% of holding in that company. But in the notes, his name is not mentioned. So generally the company will mention it twice. One in the top shareholders, other time it will mention the notes. It mentioned in top shareholders, but in notes that name is removed. So that is also something suspicious. So there are many red flags that you will find. So eventually what happens if you invest in such companies? When I wanted to invest, it was trading around 900 or something around like that. Today 8K Miles you will not find. If you go and search also on Google, you will not find, because they changed the name of the company. Company's name can be changed, right? From 8K Miles they changed it to something else. The funny thing is, initially it was not 8K miles. I don't remember its name. Its name was some different. It had a different name. From that different name, they changed it to 8K miles. They have done this. Now there was a lot of bad news, bad coverage on 8K miles, right? So they changed the name to something else now. You will find it, but it is not with the same name. It with a different name. From 980 rupees, the last time I checked, it was trading around 25 rupees. 980 to 25. That is what happens if you invest in such finance companies which are practicing that financial fakery. So that is what happens. I don't remember the current name. I don't remember. You will find it on Google. If you search, you will find the new name. So you can check its current share price. So generally, it's better you avoid such companies. When you find such red flags, it's better you avoid. Now the thing is, now let's apply it practically. Let's apply it practically. So 1 second, let me share the screen. So I hope so. Chalo. So I hope you still remember. First, what we do is we go to screener.in. So let me 1 second. So we go to screener.in and we search for screener.in/Excel. So that's the URL we search for. Screener.in/Excel. Now, once you visit that URL, now first you have to log in. If you don't log in and all, this page will not show up. So here you can see I have already logged in. As you can see, I have already logged in as Investor Diary. So all you need to do is just click on choose file. So I'll just choose the file. So this is the file. So as you can see, I have selected the file. Now click on upload. So you only need to upload the file once. I'm just showing you a tutorial. So I have already uploaded very many years back, but still I'm just showing you as an example. So click, as you can see, Excel customization saved. And now you don't need to upload it again and again once it is done. Now let me export some companies. Let's look at some, Infosys, an IT company. So all you need to do is visit the company, click on export to Excel. So as you can see here, it is exporting to Excel. So let's say Infosys, Vodafone, Idea, export to Excel. Next we have Indian Energy Exchange. I'll analyze 5 companies for you. Indian Energy Exchange, export to Excel. Then we have ITC, Indian Tobacco Company. Just click on export to Excel. 4 companies done. 1 more company let me do. Okay, 2 more companies I will do. CEAT. CEAT is a tire company. So export to Excel. How many? 5. Okay, 5 companies we have exported. So let's do Tata Elxsi also. Let's do. So Tata Elxsi is also an IT company, but mid-cap IT company. So far, 6 companies we have exported. Now let me open the files. And let's cover whatever let's try to analyze whatever we have covered so far. So let me open the files first. This is Infosys, Vodafone Idea, Indian Energy Exchange, ITC, CEAT, Tata Elxsi. So 6 files we have. So first let's look at Infosys. So this is Infosys. So as you can see, version 3 stock analysis Excel sheet, Infosys. First we started with balance sheet analysis, right? So first thing that we want to check is whether the company can meet its long-term obligations or not, whether it can meet its short-term obligations or not. First, let's know that. You'll find an Excel sheet, you'll find a worksheet called as financial health. Click on financial health. Now, as you can see here, financial leverage is less than 4, debt to equity ratio is less than 1. So as you can see, this company can meet its long-term obligations. What about short-term obligations? Look at interest coverage ratio. Interest coverage ratio should be greater than 8. Here it is 148. So obviously liquidity position of the company is also very strong. So Infosys can meet its long-term obligations as well as short-term obligations. So financial health is pretty strong, right? So financial health is done. What else? Now let's look at the income statement. So this is the income statement of the company. So here you can see, first let's look at the sales growth. So 40,000 crores in 2013, Infosys was generating around 40,000 crores of sales. Trailing is nothing but the last 12 months, the last 4 quarters. This is till March 2022. Trailing is nothing but the last 4 quarters, the recent 12 months. So from 40,000 crores, sales increased to 1,28,000 crores. And the best thing is, every year consistently the sales increased. Not even with a single year of drop. Consistent sales growth. And look at the net profit growth. From 9,000 crores, it increased to 22,000 crores. Consistently, every year it increased except for 2019. In 2019 also the drop was not that big. 16,000 to 15,400. Only 500 crores of drop. And again, eventually that, from 15 it increased to 22. So pretty stable company, right? Consistent sales growth, consistent net profit growth. Now my question, whether the company is making money or not? Yes, it is making money. Is it making money consistently? Yes, it is making money consistently every year. Now comes the most important question. Is it a high growth company, moderate growth company, or a low growth company? You see a worksheet called as growth here. Just click on that. This is the growth worksheet. So sales growth is not bad. 13, 12, 12, 13. Okay, sales growth is good. But what about net profit growth? Net profit growth is low. 9, 10-year CAGR is 9. 3-year CAGR is okay, 12%, but 5 years is also 9, 7 years. So more or less around 10% growth rate. Average, last 10-year average growth is around 10%. So what is the minimum criteria that we look for? 15% is what we need. So Infosys, financial health is strong, but growth is very weak. So it's a low growth company. So that is the red flag. But chalo, let's look at cash flow statement as well. So this is the cash flow statement. You might be looking at this ash symbols and seeing there might be some error. No, the only thing is the space is not enough. So what you can do is you can just drag it. If you drag it, that space will be enough, or you can just double tap, the numbers will show up. So here you can see cash flow from operations are consistently positive every year. Each and every year consistently they are positive, right? So cash is coming into the business. And even free cash flows, you can see free cash flows are also consistently positive every year. And if you look at what are the major source of cash, here you can see some of the important questions to ask. What are the major sources of cash? Here you can see blue, cash flow from operations. So cash flow from operations, there is a drop down here. So cash flow from operations is the major source of cash. Is CFFO covered to CapEx? As you can see, this is the CapEx and this is the cash flows. For example, if you look at 2022, 23,885 crores of cash this company generated. And what is the CapEx required? 3,000 crores. So obviously this company can, cover its CapEx. So yes, relationship between net profit and CFFO, whether it is consistent or inconsistent, as you can see, they are in line with each other. Net profits and cash flows are in line with each other. So income statement and cash flow statement is narrating the same story. So even cash flows, quality of earnings is also very good. What about the profitability? So as you can see here, return on capital employed is absolutely more than 15% every year. And here you can see return on equity is also more than 15%. But is it high quality profitability or not? So let's look at the major drivers. What is the major driver? So here you can see it is margin based, margin based profitability. And here I have provided, you can see here, almost like, asset turnover is very low, but margins are very high. So return on assets are also more than 8%. Financial leverage is also very low. Return on equity is also very good. So as you can see, high quality profitability. Now, what about high quantity profitability? Here you can see, this is the last 10 years of free cash flow to sales. So generally I take a margin. So here you can say I take an average of last 5 years. So free cash flow to sales is more than 5%. Return on equity is more than 15%. So what is Infosys? Is it a great company, emerging company, declining company, or a worst company? What company is it? Obviously it is a great company, right? So what that is what here also you have a drop down. So as you can see, it's a great company. So chalo, it's a great company. But the thing is, do we invest in Infosys? It's a great company. Financial health is strong, but will I ever invest in Infosys? Absolutely not. Why? Because it's a low growth company and I will not invest in low growth companies. So that is regarding Infosys. And what about the valuation and all? After post lunch, we will cover the valuation. So this is where we do the valuation of the company, but don't worry, I will cover the valuation post lunch. So at this point, we have only covered till, profitability. Now let's look at ITC or Indian Energy Exchange. Chalo, this is Indian Energy Exchange. So here you can see balance sheet, financial health first, whether this company can meet its long-term obligations. So as you can see here, financial leverage less than 4. Now, to be honest, you don't even need to check the number. Just by looking at the colors, you will understand. If it is in green, that means it is good. If it is in red, that means it's bad. So all the three green flags, you can see all the cells are highlighted in green. That itself is a sign that the company's financial health is strong. So it can meet its long-term obligations. It can meet its short-term obligations as well. Financial health is strong. This is the income statement. 133, 170, 250, 430. So consistently every year, sales also increase from 138 to 433, which is good. Net profits also increased from 66 crores to 307 crores. There was only 1 year of drop, that is from 92 to 90. It is not really a drop. It was same. Those 2 years, the net profits were same, but eventually from that 90 today it is 300. So every year consistent growth is there. So is it making money, my dear friends? Yes. Is it consistently making money? Yes. Is it a high growth company, moderate growth company, low growth company? That for that we need to check the growth worksheet. So as you can see here, sales growth is very high and net profit growth is also very high. So for IEX, financial health is strong, growth is also very high. What about the cash flow statement? Cash flow from operations are also positive. Free cash flows are also positive. The major source of cash is blue. That is cash flow from operations. And what is the relationship between net profits and cash flows? As you can see here, in 2022, only 303 crores of net profits were provided. This company mentioned, but cash flows were 788 crores. So you can see a very big blue line. That is cash that came into the business is significantly higher than the net profits. But even in the 10 years also, you can see they are in line with each other. Net profits and income statement, cash flow statement, narrating the same story. What about profitability? As you can see, return on capital employed is very high. What about the quality of profitability? As you can see, margins are very high. So margins are helping this company. Even the turnover is very low. With the help of margin, this company is able to generate high return on assets and high return on equity. So high quality profitability. What is the key driver for return on equity? Margins of the company. Next, what about, this is a cash machine, my dear friends. Cash machine. As you can see, free cash flow to sales is 74%. What is our requirement? 5% is the requirement, but this company generated 74%, 74.4%. And return on equity is also more than 15%. So what is it? It's a great company. So it's a great company. Financial health is strong. Growth is very good. Profitability is also very good. And what about the profitability matrix? It's a great company. Should we invest in this or not? So at this point, we have reached only to this extent. Post lunch, let's value this company as well. So that is regarding with Infosys. We are anyway not going to invest because it's a low growth company, but we will still value it. But with IEX, it's a high growth company. There is a possibility we can invest in this company if it is undervalued. Next we have, okay, ITC. So ITC, now just by looking at the colors, you can analyze the financial health. Just go to financial health analysis. As you can see, it's a debt-free company, my dear friend. Debt-free, absolute debt-free. Debt to equity ratio is 0. So without debt, there is no long-term obligations, right? So this company can meet its long-term and short-term obligations. What about the income statement? From 31 crores, sales increased to 60 crores. And net profits, you can see from 7,000 crores, it increased to around 15,000 crores. So this company is making money and it is making money consistently. But the question is the growth. Is it a high growth company, moderate growth company, low growth company? Go to growth worksheet. Absolute red flags. Very simple. If it is so simple, I mean, it is a no-brainer. We don't need to think much. All red flags. So sales growth is very low. Even the net profit growth is very low. So it's a low growth company. We will not invest in low growth companies. But chalo, as analysis part, just let's look at some other, in general, we will not analyze in general. But since I am helping you understand the subject, I am taking you through all the worksheet. In general, we will not go through all the worksheets. Here the company has failed. So there is no point of going through financial, profitability and all. But, just as a learning purpose, we are doing this. So this is the cash flow statement. Again, if you just double tap, that numbers will show up. So as you can see here, cash flow from operation activity, cash flows are consistently positive. Free cash flows are also positive. What is the major source of cash? Blue. What is blue? Operating activities. So this company's major source of cash is operating activities. What about whether cash flows and net profits are in line with each other? You can see here. They are in line with each other. They are narrating the same story. What about the profitability? High profitability is there. And margin. What is the key driver? As you can see, margins are very high. Turnover is very low. But still, because of high margins, it is able to generate high return on equity. So high quality profitability. What about the quantity? As you can see, high quantity profitability is also there. So profitability matrix, ITC falls under which matrix? Obviously, great company, right? So it's a great company. Chalo. Next we have whether we will invest in ITC. It's a great company. Whether we should invest in it? No. Why? Because it's a low growth company. That is the reason we avoid. Next we have Vodafone Idea. Vodafone Idea, just look at financial health. Boom. Negative. Its book value is negative. So bankruptcy risk is there. Everything is negative. So that is the reason you can see all the cells are highlighted in red. Let me show you something. This is the balance sheet of the company. Let's assume you are running this company. So if you are a shareholder, that means you are the owner of the company, but you are not running it. some CEO, some manager is running the company, but let's assume you are running this company from today onwards, and I have given you these numbers. Today, you have 2,13,000 crores of borrowings, 2,13,000 crores of debt on the balance sheet. Now you have to repay that debt. Okay, there is a lot of debt. So you asked your, you have a team. You called your team for the meeting and you asked, like, we have 2 lakh crores of debt. How many reserves we have? They told you that reserves are negative 94,000 crores and equity share capital is 32,000. So reserves, what is book value? If you add up these two things, that is the net worth of the company. So if you add that with this, this is the net worth, this is the book value. So with this company, book value itself is negative. So there is no assets. So obviously this 2 lakh crores cannot be repaid. It is impossible. Assets are negative. On the top of that, you have 2 lakh crores of debt. So can this company pay its long-term obligations? No. Short-term obligations? No. What is the only source of bailout? Some company should buy this company and they have to pay the debt. That's the only source. Otherwise, this company, it is very difficult to survive. So I'm not sure whether, but recently there was a bidding for Vodafone Idea. I think Reliance Jio and some other company wanted to buy it. I'm not really sure, but current scenario, financial health is pretty weak. Just by looking at this, our analysis is done. In general, we will not go forward. We will not waste our time, my dear friends. We have limited time. So we don't want to waste time on unnecessary stocks. So just by looking at these three cells, we have understood financial health is weak. In general, we will not invest. But let's look at some other, just as we are learning the concepts, we are looking at all these things. Sales growth, as you can see, from 22,000 crores, it increased to 38,000. Chalo, sales growth is not bad. But what about net profits? 1,000, 1,900, till here it is good. 1,000 to 3,100, till that point it's great. But what happened after that? You can see here, loss. Let me show you how much this company lost in the last how many 6 years, around 6 or 7 years. 1,93,000 or 94,000 crores. 1,94,000 crores this company lost in the last 4 years. Now, why do you want to invest in that company? Now, questions. Is it making money? No. Is it consistently making money? Absolutely not. It is consistently losing money. And don't even ask about the growth rates. They are pretty erratic. Positive, negative, positive, negative. So it's an erratic growth company. So we will not invest in erratic growth companies. So cash flows, you can see. These are the cash flows. So cash flows are sometimes, free cash flows are positive, negative, but at least cash flow from operating activities are positive. So if you ask me, like, what is the major source of cash? Mostly, majority of the cash is actually generated from operations, but sometimes you can see red. Financing activities is also, so the company is borrowing money as well. Now you can see cash flows are very high, but I'm not trusting these cash flows because it's a loss-making company. So actually, if we go and check the annual report, you will absolutely find the line items. You might be seeing that the cash flows are very positive and all, but no, there is something that we are missing here. You go and check the annual report, you will find, but I will not waste all of that time. For me, it is unnecessary. If I go and check the annual report, I'll find the reason why the cash flows are so high. But I have limited time. I will not waste my time on this company. I wouldn't have reached here because my job is done here itself. But just I'm looking here. So don't waste your time and check like what is happening. Not worth it. So here next we can see return on capital employed is, sorry, this is Infosys. No. We have to check Vodafone Idea. So this is Vodafone Idea. So here you can see this is the profitability, absolute red flags. So return on equity is not even 15%. So what is the key driver? Who cares about the key driver? It is not even generating 15%. What about cash flows? Negative. So free cash flow to sales is negative. Return on equity is negative. So where it falls, Vodafone Idea, worst company, right? So here it says great company. There is a drop down here. Click on that drop down. So you will find these options. Click on worst company. So Vodafone Idea is a worst company. So we will not invest in worst companies, right? But how much time it would have taken us to understand it's a worst company? 1 or 2 seconds. Just by looking at the financial health only, we understood it's a gone case. All it takes is like 1 or 2 seconds to know whether we can make money in that stock or not. Next, we have CEAT. CEAT is a tire manufacturing company. So it's a tire company. Financial health. Now here we have got some confusion, my dear friends. With CEAT, financial leverage and debt to equity ratio is good. Less than 1, less than 4. So this company can meet its long-term obligations. But what about the liquidity position? Only 1. So that is the reason I have selected this company. So here interest coverage ratio is not very high, less than 8. Whereas financial leverage and debt to equity ratio are favorable. So what do you think? The financial health is strong, average, or weak? You cannot say it as strong because interest coverage ratio is very low. And not just in the current year, if you look at the past few years also, past 10 years also, interest coverage ratio is always less than 8. So 1, it is not a strong financial health company. Is it a weak financial health company? Should we disregard or should we discard the company? Not so, because at least the long-term liabilities this company can pay, right? So this CEAT is a company with average financial health. Not great, not bad, but average. So we have not made our decision yet. In general, I will not like, because it is only 1. 1 is not enough, but chalo, let's look at some other factors also. Income statement, let's look at the income statement. 4,000 to 10,000. So chalo, sales growth is 4,000 to 10,000, not bad. But if you look at the net profit growth, as you can see, this is a cyclical company, my dear friends. So 120, 270, 300, 400, 360, 230. You can see from 430 directly to 230, because it's a cyclical company. So the margins will drop. So there will be a lot of ups and downs in the margins. So 1, 2, 3, 4, 5. So as you can see, there are 5 red flags. 5 cells are red. So you can consider it as cyclical company. If there are any negative years, then you can consider it as erratic growth company. But according to me, it's a cyclical growth. It is making money. Every year it made money. So whether CEAT making money, yes, it is making money. Is it consistently making money? No, there is some cyclical nature, but it is still making money. This is not loss-making company. Whereas Vodafone Idea was a loss-making company, but this is not a loss-making company. It's a cyclical company. Few years the margins are high, few years the margins are low. So based on that, based on the margins, the net profits will fluctuate. And currently it is at the bottom of the cycle. So what is its price? 90. It's a bottom of the cycle, but share price increase. That's something irrelevant happened. So as you can see, it's a cyclical company. Generally, we don't invest in cyclical companies. But chalo, let's look at the growth. As you can see, growth is pretty erratic, negative, erratic, but you can't trust these numbers because there is a lot of cyclicality. How can you trust these numbers? So don't even check the growth rate for cyclical companies because it's irrelevant. And as you can see, cash flows are also free cash flows are slightly negative, but I'll show you in the valuations, but I don't think Okay, major source of cash is it's cash flow from operations. Okay, net profit and cash flows are also very good. Profitability, as you can see, till 2017 it was good. For the last 5 years it was gone case. Till here you can see, here you can see financial leverage. For the first 1 year, it was only financial leverage that was helping. Next, margins improved. So these 3 years here you can see margins, turnover. So what changed from, okay, return on assets dropped. So margins also dropped. So margins dropped, turnover dropped. So return on equity also dropped. So for the last 5 years, this company is not generating much return on equity, and in the current year it is only 2.2%. What about cash flows? Even the cash flows are also negative for the past few years. So what is this considering the profitability matrix, where it is falling? Low quality profitability, low quantity profitability, right? So worst company, CEAT falls under the profitability matrix of worst company. So what we'll do? We will avoid CEAT. Last but not the least, I think CEAT is done, Vodafone Idea is done, ITC is done, Indian Energy Exchange, Infosys is done. Okay, Tata Elxsi we have. So now I will not analyze, you analyze. I think you already got some idea on what to look for. So first let me check the financial health. So what do you think? Whether the company can meet its long-term obligations and short-term obligations or not? You know the answer. I will not tell you yes or no. You know the answer. Regarding the financial health, strong average week. What do you think? What about the income statement? Every year, consistently, sales, increased consistently every year. 605 to 2,638. Consistently every year. What about net profits? From 21, it increased to 621. There was only one drop. Around in 2020, there was a drop. So this is where I invested actually. So around in 2020, around at this price I invested 630 or 640, something around like that. But except that 1 year, you can see consistently every year consistently the profits have increased. So is it making money? Yes, it is making money. Is it consistently making money? Yes, it is consistently making money. What about the growth? High, low, moderate? What do you think is the growth? Absolutely high growth company. High growth company, right? Okay, I should not say whether it is high growth or low growth. You should say it. Okay. So what about the cash flows? Look at these numbers. Cash is coming in or going out. What about free cash flows? You can see here, this is the free cash flows. And you can see what is the major source of cash. As you know, is it operations or is it borrowings? You can see blue. Whether cash flows and income statement, net profits are in line with each other or not. Here you can see they are in line with each other. Profitability. So as you can see, consistently every year, except 2013 it was like 14.5. But if you ignore that year, from 14 to 22, consistently every year it was more than 15%. What about in 2013, margins were very low. So asset turnover was more or less the same, but margins were very low. That is the reason the return on equities was bad. But from 2014, it was a different story altogether. So margins are very high. You can see margins improved significantly from 9%. So as you can see with Tata Elxsi, there is a shift in the business model. If you carefully observe, initially it was a low margin business, but high volume business. They were into high volume, low margin business. But slowly they transformed, and they are still transforming into a high margin business. So let me show you. Focus on these numbers. Till here, 9% was the net margin, 2% was the asset turnover. So return on assets was good. Return on equity was also good. But next year you can see margins improved, turnover dropped, margins improved, turnover dropped. Margins improved, turnover dropped. Improved, improved. You can see drop here. Improved, improved, improved. So from almost 2%, 2 asset turnover, now the asset turnover is only 1.1. But from 9%, margins increased to 22%. So there was a shift in the business model. Previously, it was a volume business. Now they are more a margin business. And you can see return on equity is consistently above 15%. So high quality profitability is there. And what about the free cash flows to sales? More than 5%. Obviously, you can see return on free cash flow to sales is more than 5%. Return on equity is also more than 15%. So is it a great company? Yes, it's a great company, right? And you know what happened? Like this is where I invested around at 250 rupees. Current, this is where I invested. Where okay, around this price I invested, and you can see current share price is 8,690 rupees. So let's see how much the share price multiplied. So 13.81 times. So it's a almost 13-14 bagger in the last two years or 2.5 years, let's say. So that is what happens if you invest in high quality stocks. So far what we have covered is the quality side of the company. So I hope you understood the point. Quality side is done. Now let's look at the price. So we will take a break of 1 hour. So we'll have a lunch break of 1 hour. Then we will start with valuation. So far what we have done, what we have covered is only the quality part. As you already know, we are value investors. So for us, value investing is all about you should know how to value a stock, right? So that you will learn post lunch. So what we will do is we are not closing the call. We are not closing the call. So what we will do is, let me show you something. The call will be on. So all I'll do is like 1 hour timer. Let's look for 1 hour timer. So let's run this timer for 1 hour. So exactly you will also know. So when I am going to start. So by the end of this timer, we will start the session. I hope you can see the timer. So yes. So the timer I have started. So I will not close the call. The call will be on. So after 59 minutes or after 1 hour, let's meet. So chalo. check, check, check. Check, check, check. Okay. Chalo, check, check, check. Hope you can hear me, right? So guys, can you hear me? Please raise your hands if you can hear me. Yes, there is a change of costume. So yeah, now it is black. So chalo. Thank you, thank you. So now let's continue where we have stopped. So far we have covered till the profitability. So what we have covered so far is financial health, growth of the company, earnings quality, profitability of the company. So this is what we consider as the quality. So generally we invest in high quality companies. That is what we have covered. But as you already know that we are value investors. So for us, what is the most important thing is to obviously know the value of the company. That is the end game. So why we have done financial health analysis, growth analysis, quality analysis, profitability analysis? We have done that so that we can estimate the value of the stock. So this is all the raw material. Remember one thing, all of this is the raw material to generate or to estimate the value of the stock. So how we are going to convert this raw material into value per share, that I will cover going forward. So before that, so there are two ways you can value a stock. One is relative valuation and the other is intrinsic valuation. So first let's start with relative valuation, then we move on to intrinsic valuation. And don't worry, you are not computing any ratios. Everything will be done by the Excel sheet itself. So just try to understand the concept. So first once you understand the concept, then you will all obviously know like how to understand or how to estimate the value of a stock. So first let's start with relative valuation, and under relative valuation we use many metrics. For example, it can be cash returns, it can be earnings yield, price to earnings ratio. As you already know, we use price to earnings ratio in almost every weekly mentoring program. We discuss about PE ratio, price to sales ratio, and price to book ratio. So these are there is one more thing, PEG ratio. So these are the things that we use to check the relative valuation or to estimate the value of a company using relative parameters. So I'll give you an overview of what are these ratios and how it is going to helpful. So first is, as the name suggests, relative valuation is nothing but we compare the value of, let's say you are analyzing an IT company, let's say Infosys, we have Infosys, right? So let's assume that we are analyzing Infosys. So while estimating its value, you can check its current, let's assume PE ratio, its current PE ratio with the market PE ratio, that is Sensex or Nifty. You can compare the Infosys PE ratio with Sensex or Nifty PE ratio, and you can see which is cheap, which is expensive. Or else you can compare it with industry PE ratio. You can take the PE ratio of the IT industry, you can compare it with Infosys, you can do that. Or else you can compare it with the Infosys itself, last 5-year average PE ratio or last 10-year average PE ratio. You can compare the current PE is higher than or lower than the last 5-year average or the 10-year average. So in these three ways, you can basically do the relative valuation. So obviously by looking at the slide, you won't understand much. So I'll take you through the Excel sheet itself. So this is Infosys. I hope, okay, one second, let me share the screen. So this is Infosys. I hope you can see the screen. So to what extent we have covered so far? So till profitability analysis we have covered. So now let's look at the relative valuation. If you look here, there is something called as a relative valuation. Just click on that. It will take you here. So as you can see, earnings yield, cash return, price to earnings ratio, price to sales ratio, and price to book ratio. So these are the 5 metrics that we use to do the relative valuation of a stock. But you have to understand one thing, why we are doing the relative valuation. So this is very important. Pay attention. So this is going to help you. You have to understand the concepts. Without understanding the concept, you cannot value a stock. So why relative valuation is helpful? So this is the concept. You have to understand the total return. How much total return you can generate by investing in a stock is what drives our investment. So based on the estimated total return, we invest. And total return is nothing but speculative return plus investment return. Speculative return plus investment return. How you will estimate the investment return of a stock? That we will cover later on. But at this point, what we are trying to analyze is how to estimate the speculative return of a stock. So by using these metrics, we estimate the speculative return of a stock. And out of these 5 metrics that you see here, which is important? Are they equally important? No, they are not equally important. We place more emphasis on the price to earnings ratio. This is very important. Price to earnings ratio is more important for us than all these ratios. The remaining ratios are basically supporting ratios. And here you already know we never invest in a stock if the PE ratio is more than 20. Now, what is the current PE ratio of Infosys? As you can see, it is 29. So in general, we will never invest if the PE ratio is 29. And here you can see 3-year average is 27, 5-year average is 23, and 10-year average is around 21. And you can see a sad face here. So just by looking at the sad faces, you can understand whether it is cheap or expensive. So here the PE ratio itself is expensive, and all the supporting ratios, that is price to sales ratio is also expensive, price to book ratio is also expensive, and you can see earnings yield and cash return is also expensive. That is the reason you see sad faces here. So what is it? First we check the PE ratio. PE ratio, you should find a smiley here. I'm just simplifying the thing. So if you find a smiley here, that means it is cheap. With Infosys, there is no smiley. So as you can see, all the smileys you see, they are, what they indicate is the stock is expensive. So if the on relative valuation basis, if it is considered to be expensive, then speculative return will be negative. Speculative return of a stock will be negative. What about the remaining stocks? For example, this is Tata Elxsi. If you look at Tata Elxsi, as you can see, with Tata Elxsi also, the speculative return is negative. As you can see, first let's look at the price to earnings ratio. Now, when I purchased Tata Elxsi around in 2020, look at the PE ratio. It was around 15. I bought it at 18 PE, then I bought it at 16 PE, then I bought it at 14 PE. So my average PE is around 15 or 16. So around this price I bought it, around 15 PE. And what is the current PE? You can see 87 times earnings. It's a good company, but will I pay 87 times earnings? There is no way. More than 20, I never pay. So as you can see, it is expensive based on the PE ratio, based on the price to sales ratio, price to book also it is expensive. Even earnings based valuations like earnings yield and cash return also it is expensive. So speculative return is negative for Tata Elxsi as well. What else we have? ITC. Let's check the speculative return of ITC. Even for ITC also you can see speculative return is negative, because all the smileys you can see they are sad faces. If you look at the PE ratio, current PE is 24, which is pretty higher than all the historical averages. Now I have already covered, like we use market PE, we use industry PE, and we can use the PE ratios of last 5 year, PE ratio of the same company for last 5 year or 10-year average. Now out of these 3 options available, I always go with, I will never use market PE. For me, Sensex PE, Nifty PE doesn't matter. Industry PE also I will not, place too much emphasis on the industry PE, because even though they might be in the same industry, their business models can be very different. Their tax rates can be very different. Their capital structure can be different. Their depreciating policies can be different. So you cannot, just because they are in the same company, you cannot, just estimate as if they are same. They are not apples to apples. Some companies drive their business through margins. Some companies drive their business through volume. So you cannot compare them. They are two different things. Their growth rates will be very different. So a high growth company and a low growth company, you cannot compare them just by looking at the PE ratio. So that is the reason what I do is I compare the current PE with the same company's last 5-year and last 10-year PE ratio to know whether it is expensive or it is cheap. So Tata Elxsi also, ITC also, it is expensive. Indian Energy Exchange, if you look at Indian Energy Exchange, as you can see, even Indian Energy Exchange is also pretty expensive. All the smileys are showing sad faces. So, okay, let me download one company where the P ratio or, the speculative return will be cheap. Let's take a stock from our top 15 list. So, okay, Sri Jagdamba Polymers, let's pick. Sri Jagdamba Polymers. As you can see, it is trading at 13 times earnings. So let's export Sri Jagdamba Polymers. This is in the top 15 stocks. So let's pick it. It is downloading. So let me open the file. So this is the Jagdamba Polymers. So as you can see, the financial health is good. You know, this is the income statement from 74, it increased to 369, from 3, it increased to 51. Growth, as you can see, it's a high growth company. Profitability, you can see. So this is the profitability. From 14, it increased to almost 32 for the last 6-7 years. It is very good. And even if you look at the return on equity, so this company changed its business model significantly. Previously, it was more of a volume business. Margins were very low. But here you can see the margins improved significantly and the asset turnover is more or less the same. There is no change in the asset turnover. But as you can see, this company significantly improved its efficiency in the last few years because of its improvement in the margins. So as you can see, from 23, it increased to almost 30 or 27. So chalo, let's look at the relative valuation. So even this company also relative valuation, it seems to be not so great. So as you can see, earnings yield is very good. Historical PE ratios, as you can see, it is higher than its historical averages. So shall we discard it? No, generally I won't do that. So for me, this has to be less than 20. So even the Excel sheet is telling me like it's bad in terms of, you know, relative valuation, but I don't really care. This is why I've taken this company, because Excel sheet will not drive you. You have to drive the investment. If you just take Excel sheet at face value, you will go and invest in bad companies thinking that they are great companies. You will invest in great companies, but at, you know, bad prices. So you have to drive. So the concept is, as long as the PE ratio is less than 20, we give it a benefit of doubt. We don't discard it that easily. So here you can see it is showing me a sad face, but still, since its PE ratio is less than 20, I'll still give it a chance. I'll not discard it right away. I'll not consider it that the speculative return is negative. So let me export one more company. Let's say Chaman Lal Sethia. So Chaman Lal Sethia, as you can see, is trading around 8 times earnings. So let me open the file. So this is Chaman Lal Sethia. So if you look at the relative valuation, so here you can see, based on the price to earnings ratio, Chaman Lal Sethia is cheap. As you can see, there is a smiley face. But price to sales ratio, just 0.1 difference. As you can see, 0.4, 0.6, 0.5. Here it is 0.59. So because of that very small difference, there is a sad face here. Price to book ratio, it is cheap. Earnings yield, it is cheap. So there are few cells which are showing sad faces. Few cells are showing smiley faces. Now what you will consider in general? You will invest, or at least you will try to analyze it, or you will discard it right away. Remember one thing, the only parameter that is worth, placing more emphasis is the price to earnings ratio. The remaining all are the supporting ratios. So if all these cells are green, then that's great. But only if the P ratio is green, I will take it forward. I'll move forward. So with Chaman Lal Sethia, you can see price to earnings ratio is, cheaper than, based on the price to earnings ratio, it is cheaper. So we still consider there is a chance. So there is a benefit of doubt, it might be undervalued. So half to value, I'll take it forward. So at this point, what we have understood is, out of these 5 things that you see here, price to earnings ratio is important. So remember that. Now comes Now that is regarding the relative valuation. Now what about the intrinsic valuation? Now this is very important. Have to estimate the value of a stock, that is the intrinsic value. Now pay attention, this is going to be very important. Intrinsic value or value per share is nothing but the present value of all the future cash flows discounted at a particular discount rate. So it is nothing but what is the total cash that a company can generate in its lifetime, discounted to its present value. So I'll give you a small example to understand this concept. Let's assume that there is a business. Let's assume there is a petrol pump, nearby petrol pump. It is for sale and you want to buy it. So you want to buy this petrol pump and you will decide the price now. At what price you will buy it? I'll give you some data of this petrol pump. So for every year, this petrol pump will help you earn 1 lakh rupees. 1 lakh rupees per year. Net profits. I mean, after all the expenses, 1 lakh rupees you can take home. And you will get 1 lakh rupees for the next 10 years. For the next 10 years, you will get that 1 lakh rupees. And in the 11th year, you will sell this business. 11th year, you will sell this business and you will get 5 lakh rupees. The liquidation value we call it. So first 1 to 10 years, you will make 1 lakh rupees per year. 11th year, you will liquidate that petrol pump and you will generate 5 lakh rupees. Now I'll ask you a very simple question. At what price you will buy this petrol pump? Give me a price. Is it 50 lakh rupees? Is it 25 lakh rupees? Is it 5 lakh rupees? 7 lakh rupees? What is your price? And there is no right answer, my dear friends. There is no such thing as right answer. Just give me your answer. What is your, how much payment you will make? 1 to 10 years, 1 lakh rupees per year. 11th year, 5 lakh rupees you will get. So what will be your value for this, or at what price you will buy it? So generally I ask this question almost like in every, almost every workshop, every webinar I ask this question. So there is 7 lakhs, 5 lakhs, 5 lakhs, 7.5 lakhs. So as you can see, 5 lakhs, 7 lakhs, 7.5 lakhs. Lower price after taking price trend, 2 lakhs, 2 lakhs, 2 lakhs. So Kapil, chat is disabled, but still you have mentioned the chat is disabled in the Q&A box. So you can put it in the Q&A box as well. So 2.5 lakhs. Sunil Kamath, if the chat is disabled, then how I can read your message? Q&A box is open, my dear friend. You can put your queries in the Q&A box. 5 lakhs, 5 lakhs, 10 lakhs. So as you can see, most of you are putting your numbers between 5 lakhs, 7 lakhs, 3 lakhs and all. So like I said, there is no right answer, but I'll give you have to get to that point, have to decide. So year 1 to year 10, that is the first 10 years, you will make 1 lakh rupees, right? And on the 11th year, you will make 5 lakh rupees. So what does that mean? 1 lakh into 10 years is 10 lakh rupees. And you add this 5 lakh rupees for that. So overall, it is 15 lakh rupees. So what is the total cash that will be collected from this business in next 10-11 years is 15 lakh rupees. Now that is the value of the business. Here I'm not considering the discount rate and all, just to keep it simplified. So I'm not considering any discount rate. Without discount rate, 15 lakh rupees is considered to be the value of this asset, because that is the cash you are generating in the next 10 years. Now, if you buy this asset paying 20 lakhs or 25 lakhs, then obviously that is not going to help you, because You pay 20 lakhs or 25 lakhs, but you receive only 15 lakhs in return. So you are losing your money, right? So you consider this as overvalued. So expensive price. What if you can buy it at 12 lakhs? Even 12 lakhs is also cheap. You will get 15 lakh rupees and you want to pay 12 lakh rupees. But the thing is, what is the certainty? What is the certainty that you will definitely make 1 lakh rupees per year for next 10 years? What if after 4 years or 5 years, there is a competitor? Someone else also, launched a new petrol pump and he is offering some discount also, let's assume. So your business will be disturbed, right? So then you will not be able to generate 1 lakh rupees. Your earnings may drop. So there is risk associated. So 12 lakh rupees is also a reasonable amount, but there is risk. So someone mentioned 2 lakh rupees. Actually, 5 or 6 people mentioned 2 lakh rupees. If you want to pay 2 lakh rupees, it's fine. But the thing is, whether he will sell it for 2 lakh rupees is the question, because he also knows that you will make 15 lakh rupees in next 10 years. He may not sell at 2 lakh rupees, but if you can find the opportunity, then great. Why 2 lakh rupees? Why not 10,000 rupees? I mean, if you can buy it at 10,000 rupees, no one is luckier than you, right? So anything, 1,000 rupees also you can pay if he is willing to sell it for you. So what is the reasonable price? There is no, what is the right price? There is no right price. There is only reasonable price. Someone said 7 lakh rupees, which is good. Someone said 5 lakh rupees. As long as you are maintaining that adequate margin of safety, it is good. For example, if you want to buy at 7 lakh rupees, that means you have incorporated more than 50% margin of safety, 50% discount. So I will cover that. What should be the discount rate? What should be the margin of safety and all I will cover that. I'm just giving you this example so that you will get the point. I just want you to understand the concept, how we are going to value a stock. So these are the 4 parameters. You need 4 things to value a stock. First is initial cash flow. You need an initial cash flow. That is the first thing. Next, you need a growth rate. First year you take an initial cash flow, you apply a growth rate for the next 10 years. So you need a growth rate. Next is discount rate. What is discount rate? I'll cover that. So, okay, I'll cover it now itself. Discount rate is nothing but, for example, if you are receiving 100 rupees today, its value is 100 rupees. But the value of 100 rupees that you are going to receive after 3 years or 5 years, its value is not 100 rupees. Its value is less than 100 rupees. If you receive it today, its value is 100%. But if you are going to receive that same money after 2 years or 3 years, its value is not equal. Because now why it is not equal? It's because of the opportunity cost plus risk premium. So discount rate is nothing but the opportunity cost and the risk premium. For example, you are getting 100 rupees today itself. So if someone paid you 100 rupees, it's done. You can invest this 100 rupees somewhere and you can generate return. But if you are receiving the same 100 rupees after 2 years, that means for next 2 years, you will not receive any returns. If you receive it today, you will invest and you will generate some rate of return. So you are losing that opportunity to invest and generate that income, right? Which is called as opportunity cost. You had that opportunity cost. And the risk is, what if after 2 years, he might not be in a position to pay you that amount? What if the promise was not kept? What if he simply forgot that he had to pay you? So there is a risk associated whether you will receive it or not. There is that uncertainty, right? So have to compute the discount rate. It is nothing but opportunity cost in India is nothing but 10-year government bond yield, which is 6.5% around, something like that. And the risk premium in India is around 6%. So the discount rate in India is around 12%. Around 12% is the discount rate. Now let me tell you what is this discount rate. It is nothing but, let's say you have invested 100 rupees into a bank fixed deposit. Okay, bank fixed deposit. So what is the rate of interest? Around 6%. So after, let's assume, to make it simple, let's assume you are investing and you are generating, let's say 10% return on that. After 1 year, your capital will increase to 110 rupees, right? 10% more. After 1 year, your capital, this 100 rupees will increase to 110 rupees. After 2 years, 10% on 110 rupees is 121. So on so forth. Every year you add 10% to that number. 100, 110, 121. Discount rate is nothing but the reverse interest rate. So, for example, if you are going to receive 121 rupees after 2 years, then today its worth is only 100 rupees. After 1 year, if you are going to receive 110 rupees, then today its worth is only 100 rupees because of the risk and the opportunity cost. So the future cash flow is always less than present cash flow. So when we are estimating the cash flows for next 10 years in the petrol pump example, first year you generated 1 lakh rupees. First year you generated 1 lakh rupees. So 1 lakh. This 1 lakh is equal to 1 lakh. But the fifth year you generated 1 lakh rupees, right? That 1 lakh rupees is not equal to 1 lakh rupees. You have to discount it at this 12%. Now, how to discount that and all, I'll cover that going forward. I just want you to understand the simple concept. So, initial cash flows, growth rate, discount rate, and stable growth rate. These are the 4 things or the 4, variables that is required to estimate the value of the stock. Like I said, you are not going to compute any of that. It is already available in the Excel sheet itself. So this is the DCF valuation or discounted cash flow model. So one second, it is Infosys. So this is Infosys. So here you can see, like I said, 4 parameters are required. First is initial cash flow. Next is growth rate. Next is discount rate. Next is terminal growth rate. That's it. And most of the time you are not changing any numbers as well. The Excel sheet itself is computing. I just want you to understand what is happening. First, initial cash flow. Initial cash flow is nothing but, if you click on this, you just click on this. So here you can see, like I already mentioned, we use free cash flows. So we take the current year's cash flow as the benchmark and we apply a growth rate to that and we estimate the cash flows for the next 10 years. So first, let's look at that. How to get that initial number, that is the current number. Generally, I take the last 3 years free cash flows average. So 6,000, 18,000, 20,000. So that is the last 3 years average free cash flow for Infosys. But sometimes I do adjust. Now, who will adjust this? You have to adjust it. Initial cash flow, you have to adjust. Based on your understanding, make sure that it is the most realistic number. So don't try to tell some fairy tales here. So behind every number, there is a story, and every story that you narrate should be supported by a number. So here it says 15,000 rupees. But you can see, since I have taken the last 3 years average, there is a very low number here. So what I can do is, instead of taking 3 years average, I can take this 2 years average as well. If I take 2 years average, it is around 19,000. Or if I didn't change anything, it will be 15,000. But again, is it realistic or not is what matters. Getting the right number is not what matters, because you cannot get it right end of the day. So chalo, let's take only 2 years average to make it more, realistic. So 19,000. So I have adjusted. So in general, if you are not adjusting also, don't worry. 15,000. Let's put it at 15,000. So last 3 years average we have taken. That is the first assumption which is done. And in this case, I am not adjusting anything. I have not adjusted any number. Next is the growth rate. Now you don't need to compute any growth rate. Here you can see the next growth rate for the next 10 years is computed by the Excel sheet itself. But I want you to understand how how the Excel sheet is computing that growth rate. Growth is a function of how much profitability that the company is generating multiplied by retained earnings or the reinvestment. So growth is nothing but, so growth is a function of return on equity multiplied by reinvestment. That is how you compute the growth rate of the company. So here you can see return on equity is taken from here. So you can see this cell 29.3, 25, 25, 23, 24. So 29, if you think it is little higher, you can choose 24.4 as well, or else you can leave it at 29.3, because anyway they are close to each other, right? So first I will let's value it without changing any numbers. Then next value with changing some numbers. So I'm not changing 29. I'm just taking this number. So the Excel sheet have taken that. As you can see, profitability, that cell, Excel sheet has taken that. Next, reinvestment. How the Excel sheet is computing reinvestment. Now, how you will compute the reinvestment of a company? Have to know that if earnings per share, for example, if the earnings per share of a company is, let's say, 10, and out of that 10 rupees, 4 rupees is, let's assume, provided as dividends. Then what is the reinvestment? 6 rupees is the reinvestment in the company. So how you will know that? Excel sheet, go to income statement. So if you click here, as you can see here, this is the dividend payout ratio. Here you can see the dividend payout ratio. For example, in March 2022, out of every 100 rupees that the company earned, out of 100 rupees or out of 100% that the company generated, 58.8% is paid out as dividend. If 58.8% is paid out as dividend, what is the retained earnings? What is the amount that is reinvested into the business? 100 minus 58.8. So pretty simple, 41.2%. So 41.2% is reinvested, remaining is paid out as dividend. What about the previous year? More or less the same. Here it is 44%. So almost 56% is reinvested. So you can see each year it will not be same. There will be some ups and downs here as well. But whenever I am taking the dividend, here you can see I will take the current year number. Mostly the Excel sheet will take the current year number, and you have to decide whether that current year is realistic or not. 58, 59, 44, 59, 59. So as you can see, for the last 5 years, except this year, the remaining years it is almost 59 only. So that is the most realistic number. But for suppose if these numbers are very low or very high and this number is completely unrealistic, then what I'll do is I'll take a 5-year number, 7-year number, 10-year number, average number, 10-year average, 7-year average, 5-year average, depending upon what I would think is the realistic number. Based on that I'll decide. But here 58 is realistic, so let's not change that number. So based on that, 29.34 into 41, that is the return on equity, this is reinvested. 29 into 41 is the growth rate of the company, around 12%. So the first 5 years the company will grow at the same 12% only. But you can see here, no company can generate 29% return on equity forever. No company can generate. Eventually the competition will intensify. Any industry for that matter, eventually the competition will intensify and the returns will slowly come down, and they will come down towards 15%. 15% is the cost of capital or the cost of equity in India. 15% is the cost of equity in India. So what I am assuming is current next 5 years it will generate the same return on equity. After that, slowly it will move towards the cost of capital, cost of equity, and forever it will generate that cost of equity is what I am assuming. And even the dividends also, the company might be reinvesting 40% at this point, but no company will be able to generate 40% forever. So there will be a time where that reinvestment will also slow down. Most of the companies will get mature and most of the earnings will be paid out as dividends. So after 10 years, I am only estimating 25% this company will reinvest, 75% it has to pay out as dividend. So here the company will mature, right? And slowly the numbers are moving towards the 15%. And you don't make any adjustments here, only yellow cells. If you want to make any adjustments, only in the yellow cells, because each and every cell that you see here is driven by a formula. They are not just random numbers. Here you can see there are all formulas. So don't adjust any of these numbers. Just let it be. If you want to change anything, only yellow cells you have to change. So growth rate is done. What about the discount rate? Like I've already covered, discount rate. These are the parameters that we use to estimate the discount rate based on the size of the company. Financial health is strong. Earnings growth, if it is consistent. Economic moat, no moat, good moat, or emerging moat, whatever it is. Management quality high, complexity low. So basically, as you can see here, it is 12%. Don't complicate things, just keep it at 12%. 12% will work for all the companies that we invest in. If a company pass our 2-minute test, just put it at 12%. Don't change anything. Next is terminal growth rate. Now this terminal growth rate is nothing but for the first 10 years. Here you can see these are the free cash flows. So we have taken 15,000 as the initial cash flow, and we have applied 12% growth rate for the next 5 years. So that 15,000 ended up as 16,000, 18,000, 21,000, 23,000, 26,000 for the first 5 years. After that, slowly the company will go as a mature company, and eventually it will become a mature company. So for the first 10 years, these are the free cash flows. But if you sit down and will you calculate, because in theory, a companies can survive for next 500 years or next 5,000 years. In theory, a company can live forever, right? So will you sit down and estimate the free cash flows for next 50 years, 100 years, 200 years? I mean, it's not going to help you. So for that reason only, we will only estimate for the next 10 years. Only 10 years we estimate. After that, what we use is, there is something called as terminal growth rate. So after that, what we do is, we take this 10th year and we give it a stable growth rate. That stable growth rate is called as terminal growth rate. For example, that 37,000 is the 10th year, right? So on the 11th year to infinity, 11th year to infinity, we capture in one single number by taking a terminal growth rate, and this terminal growth rate should be less than economy growth rate. Because if you put 8%, 9%, 10% terminal growth rate, no matter how great the growth can be. Currently, the growth of the company might be 50%, but don't put terminal growth rate more than 4%. That is the stable growth rate forever. 11th year to eternity. So make sure that number is less than 4. It should be less than the economy growth rate, and economy growth is less than 4. So here you can see for all the companies, I put it at 3.75, less than 4. So what happens is, 10th year free cash flow is taken at 3.7% forever, divided by discount rate minus terminal growth rate. So there is a formula for that. I don't want to complicate it. So here you can see this is the terminal year free cash flow. 39. I mean, from 11th year to eternity. As you can see, this is the terminal value. For the first 10 years, if you add up all these numbers, its value is, it is present value here. So 1,52,000 is the terminal value of this company. So present value, we are discounting it at 12%. So what we are doing is, we are discounting all these cash flows at 12%. So here you can see present value of all this cash is 2,96,000 crores. That is around 3 lakh crores. What is the current market cap? 6,52,000 crores. So as you can see, So let's convert that into a number. Share price is 1,550 rupees. Value per share is 705 rupees. So only 45%. So the current value is only 45% of the share price. But let's increase or let's make some adjustments. Instead of taking 3 years cash flows, I'll take only 2 years cash flows. It is 19,000, right? So as you can see here, value increased to 907. So, but here, as you can see, 29%. Let's put it at 29. Otherwise, the value will drop. So even after I make the adjustments, also this company is still overvalued. So let's do the same thing with Tata Elxsi. So you check, this is the DCF valuation. First check whether the initial cash flow is consistent or not. That is the most important thing. I have given the hyperlinks. Just click on that blue thing. So you can see 166, 364, 311. So this last 2 years, if you compare it with this year, here it is very low. So instead of taking 3 years average, what I'll do is I'll take only 2 years average. You can take 2 years average, or you can directly take the current year average, the current year number, or you can take the last 5 years. Like I said, there is no right answer, there is no wrong answer. You have to decide. Whatever you think is the realistic number, you have to take that. Now it is around 338, which is closer to this number, right? So initial cash flows I have adjusted. Next, what about the growth rate? As you can see, 17.8 is the growth rate, but is it consistent or not? Let's check that. So return on equity, here you can see 34, it is taken. The current number is around 34. 10-year average is around 30. So not very far from the average, right? So let me put it at 34 itself. So I'll not change that number. Next we have this, okay, 40, okay, this we have to change. So as you can see here, current year, the dividend payout is 48%. Last year it is 81%. Before that it is 40%. But here you can see it is 37. So each year the number is very different. So what I am going to do is, let me see what happens if I take the 5-year average. Based on the 5-year average, I will decide whether to continue with the same number or whether to take the 5-year average. So I'm taking 5-year average. It is 45, 45, 48, not much different. So let me put it the same number. So 17.8 is consistent. So let's not change that number. Discount rate 12, discount rate never change. Terminal growth rate 3.75, don't change that number. And based on that, the value is 1,435 rupees. Now you may ask me, like, share price is 8,690 rupees. Value per share is 1,435 rupees. Now, is it realistic? Like, is it really possible? Yes, it is possible. The currently Tata Elxsi is extremely overvalued. Now, when I valued it around in 2020, share price was around 650. So I'll just directly put the numbers, how it looked like. So share price was around 645 or something like that. Whereas the value per share was around 978 or something like that. So this is what, these are the numbers in 2020. And now what happened? Intrinsic value improved. As you can see, intrinsic value increased to 1400. But what happened to share price? From 600 rupees, it went to almost 9,000 rupees today. That is the reason it is extremely overvalued. If you look at ITC, so just look at the DCF initial cash flow, 11,000 is okay because there is a number, or what you can do is you can directly take the current year number as well. Guys, if you are not understanding or if you have some confusion, don't change the numbers. You adjust the numbers only when you have full clarity what you are doing. Initial cash flows, these are all the free cash flows we have. And this is the number that is going to be shown here. That is the initial cash flow. So whatever the number you keep here, it will end up there. That is the initial cash flow. Based on that number, we are going to estimate the value. So this number is very important. So don't adjust. If you want to adjust, make sure you understand what you are doing. So I am assuming that I can take 3 years average, or I can directly take this number. So what I am doing is I am directly taking this number. So that is the initial cash flow. What about the growth rate? As you can see, growth is only 1.71. Very low growth. Let me check what is happening here. So return on equity around 24 is taken. This number is taken, but 10-year average is also around 25 only. So this number is consistent. We don't have to change this number. But I am pretty sure that I think this number should be changed, because 7% of reinvestment is not justified. Let me check. So as you can see, so only for the last 2 years, this company paid a lot of dividends. So as you can see, this company paid a lot of dividends only in the last 2-3 years. But if you look at the historical averages, most of the time it used to pay only 50% of only 50% as dividends. So what I am going to do is, I am not going to take this current number. I'll take, for me, I think 10-year average is going to make more sense. So I'm just going to take the 10-year average around 67%. So what I'm going to do is, I'm going to put this 67.6% over there. So not 67 for sorry. So what I'm going to do is 1 minus this number. 100% minus this number is the reinvestment rate. That is 32.4. So just put 32.4 here. So I have adjusted this number. And now you can see the growth increased to almost 8%. From 1%, previously it was only 1%. Now it is around 8%. Still it is a low growth company only. So discount rate we are not changing. So remember, discount rate you will not change. Terminal growth rate you will not change. If you want to adjust, you can only adjust the number here, or you can adjust it here. If you want to adjust the growth rate, don't put 15% or 16% directly here. It should be supported by return on equity and the dividend payout ratio. So you need to edit only these two numbers if you want to change, or else you just leave it like that. So based on that, you can see the value per share is around 176, and share price is 303. So that, okay, last but not the least, we have Indian Energy Exchange. So Indian Energy Exchange, okay, this is going to be very important. Please pay attention. So this is Indian Energy Exchange. We have the Excel sheet by default taken the last 3 years average, 100, 200, 700. Now you see 390 is the 3-year average. So isn't it unrealistic? A bit of it is unrealistic. So what I will do is, the current value is around 113 rupees, right? Now if you directly go and take this number, that is 778 rupees, see what happens. The value will increase to 226 rupees. But hold on, my dear friends. Whenever you are doing that, just imagine, whenever we are using or we are adjusting the numbers for ITC or something like that, you see the numbers are not very different. They are almost a slight 10%, 20% increase was there. So I was okay taking 2 years average, 3 years average, or I'm okay even taking the current average as well. But with Indian Energy Exchange, that was not the case. You have to understand, this is more than 300% increase in 1 year. Whether that will be sustainable or not is the question. 300% increase. For example, if this was around, let's say 280 to, let's say 350. If this number is 350, then I could have taken that 350 number without any hesitation. But that is not the case. There is 300% improvement. If you consider here, almost 600% improvement was there. So in that scenario, don't just directly go and take the current number, seeing that, okay, this is a very high, there is a big number, let me take that. No, you have to understand whether the next year the company will be able to achieve that or not. So in this case, I will not adjust. I will take the 3-year average only, because there is lot of difference, 100 to 300 to 700 or 800. So I have to take the 3-year average. So I have to take out that ups and downs. So for me, in this case, only 3-year average will be taken. So as you can see, 113 will be the value. If you take 700 or 800, it will be 200. And the current PE ratio of this stock is how much? 46. At 46 PE, it cannot be undervalued. So you have to understand that. So now this is DCF valuation. Next we have Dhandho valuation. Now what is Dhandho valuation? The same concept by taking different growth rates. So here I have assumed some aggressive growth rates. Here I have assumed some very conservative growth rates. So based on that, the same cash flows and all, based on that, discount rate will be 12. Initial cash flow will be the same. Only the growth rates will be different. Here for the first 3 years, 15% growth will be taken. 4 to 6 years, 10% will be taken. 7 to 10, 5% growth will be taken. Here 1, 2, 3, 20, 4 to 6, 15, 7 to 10, 10. So worst case, best case valuation. So based on the worst case, best case also, as you can see, 93, 151. Total returns, as you already know, with Indian Energy Exchange, speculative return is negative. Investment return is around, 13 plus 2. So, but speculative return is, since it is negative, total return is just 6.21. So obviously you already know, if the total return is less than 15, we never invest if it is, less than 15. For us, minimum is 15%. So let me take a company. 1 second. Or we have, okay, Heranba. Let's check Heranba. So let me open the file. So this is Heranba. So as you can see, this is the Heranba, total returns. So this is what we look for. Investment return should be positive. Speculative return should be positive. Total return should be positive. Obviously, if investment return and speculative return is positive, by default, total return will be positive. But the thing is, if this is negative, let's assume speculative return is negative, but total return is, let's say, 18%. Will you invest in that stock? No. For us, both investment and speculative return should be positive, and it should be more than 15%. And comes multi-bagger gains. So multi-bagger gains I'll cover after a while. So I hope. Now let's look at actually the intrinsic values. People ask me like how you are computing the intrinsic values. So 1 second. This is Heranba Industries, my dear friend. So there is not much data you can see here. 2011 to 2017 data is not available. So here you can see it is 10. The current year cash flow is 10, but is it realistic? Now you can see some negative years here. Like I have already covered this. If you go and check the profitability of the company, you can see this company is consistently generating high profitability, high return on equity as well. And what is the major, key driver? Profitability. As you can see, the margins are improving significantly every year. Consistently, the margins are improving. And because of that, return on equity is also improving. So if you look at this company, what is the profitability matrix Heranba Industries falls in? Free cash flow to sales is not 5%, but return on equity is consistently more than 15% every year. So is it a great company? No, it is not a great company. So it is good ROE, but bad free cash flow. That is emerging. Blue matrix, emerging company. So I invest in emerging companies as well. So this is the DCF valuation. But the thing is, here you can see we have to adjust some numbers here definitely, because 36, 14 and it is 10. Why? Because there is a number, there is a negative number here. So what we are going to do is, instead of taking 3 years average, let's take only 2 years average. So that is around. So as you can see, these are the intrinsic values here. Weighted average intrinsic value is what we take. So we take DCF, we take Dhandho valuation, we take total returns valuation, PEG valuations. So they are, I mean, there is a lot of, definitely you can ask me like why you are not showing us all of that, because as you can see, a lot of things happen here. So this is how we calculate all these things. So here you can see there are so many boxes. So you can see all of this will be done. So it will be very complex. So even if I try to explain also, it will confuse you. So instead of confusing you, what I want you to do is just try to understand the concept. Let the Excel sheet do its job. So have to get the entry prices and the exit prices. So first you go to the weighted average intrinsic value. So first, before that, let me explain this. 1 second, let me share this PPT. So 1 second, my dear friends. So this is what you need to understand. So the concept of margin of safety. So what is margin of safety? You have estimated the value per share. You can use DCF valuation, best case, worst case valuation. We use total return valuation. We use PEG ratio valuation. We use based on the weighted averages. We take the valuation. I'll go there, but before we go there, I want you to understand this. What is margin of safety? So margin of safety is a simple concept. That is, let's assume that you want to build a bridge. Let's assume that you want to build a bridge. Let's say you are an architect. So you got a project to build the bridge, and that bridge should carry, let's say 30 tons of truck, or 3 tons, or whatever it is, 30,000 kgs of truck. Now, will you build that bridge which can exactly carry 30,000 kgs, or you will build a bridge that can carry little more than 30,000, 35,000, 40,000? What you will do? Exactly 30,000 you will build, or little more than that? Obviously, margin of safety. You will not build 30, 35, 40, 45, depending upon what is your tolerance level. Let's say you have a very important business meeting at 9 a.m. in the morning. Will you reach the location exactly 8:59? No, you will try to be there at least 5 minutes or 10 minutes before the event, right? So the same thing we apply in all aspects of our life. For example, you want to wake up at 7 o'clock. You will keep your alarm at maybe 6:45 or 6:50. So that is what margin of safety is all about. So it is nothing but, if the value of stock is 100 rupees, you will not buy it at 100 rupees, because without margin of safety, you will not be, I mean, without discount, what if the value that you have estimated is wrong? What you have made a mistake in terms of growth? What if the discount rate is wrong? What if the terminal, obviously discount rate, terminal growth rate will not be wrong. I'm just giving an example. What if the initial cash flows that you have estimated is unrealistic? What if the growth that you have estimated is unrealistic? So we are all humans. We might, there is a chance that we might make some errors while computing the, the estimating the value per share. So as an insurance to protect us from this human errors, we apply a margin of safety. So if the value per share is 100 rupees, we will not pay 100 rupees. Okay, we will buy it at a discount to that intrinsic value. But the question is, what should be that discount rate? Should it be 50%? For example, let's say if the value per share, is, let's assume 100 rupees, that is value per share. We will not buy it at 100 rupees because at 100 rupees it is fairly valued. And what if you are mistaken, what you have done some human errors? So that also we have to incorporate. So what should be the discount? Let's say 50% discount. You put margin of safety at 50%. So only if that stock is trading at 50 rupees, you will buy it. Otherwise, you will not buy it. So that is the margin of safety. For example, if your margin of safety is 30%, this value, to that you will put 30% discount, which is 70 rupees. You will purchase only at 70 rupees. But anyway, I'm giving you all the theories. What should be the practical, implementation of the intrinsic value? Don't worry, that is already provided in the Excel sheet itself. So here you can see the entry price. So here you can see this is the entry price. So how the weighted average intrinsic value is computed? We take the weighted average of these 5 values. The Excel sheet will compute different values: DCF value, total return value, PEG value, best case, worst case value, and it will take a weighted average value for you. So if we are wrong in terms of DCF valuation, our entire valuation will not go wrong. If you are wrong, let's say in Dhandho valuation, DCF valuation will help you. If you are wrong both in these two valuations, total return valuation will help you. So since we are using many valuation metrics, you cannot go wrong. Or if you are wrong in one place, the others will help you average out. So we take average intrinsic value. Here you can see with Hiranbai it is 643 rupees. That is the value per share. And what is the share price? 567 rupees. Now if you take 50% margin of safety, if you apply or incorporate 50% margin of safety while purchasing this stock, then as you can see, you will only buy when the stock is trading at 321 rupees. But let me ask you the same question. What should be the margin of safety? Remember this, it is different for different companies. Margin of safety cannot be same for every companies. If it's a high risky company, then margin of safety should be very high, 60%, 70%. With few companies, 90% of margin of safety is needed. With few very high risky companies. But for a very low risky company, where the business operations are pretty intact, everything is in place, financial health is great, growth is great, profitability is good, economic moats is good, when everything is great, for those companies, margin of safeties can be low. I mean, margin of safety can be minimal. So in our process, what are the kind of companies we invest in? Whether we invest in high risky companies or low risky companies. With our process, in the sensible investing process, we only invest in high quality, low risky companies. So by default, 30%, 50% or 60% margin of safety is not required. So what we will do is, we will not apply single margin of safety. So you can see here the entry prices. So for the first entry price, I take 10% margin of safety. That is the first entry price. 643 rupees, I will only incorporate 10% discount. 579, that will be my first entry price. So here you can see current share price is 567. So entry 1 is triggered, right? So what I will do is, I will purchase Hiranbai Industries because it's a high quality company and its price is also favorable, and entry 1 is triggered. I will purchase it. Now phase 2 is 514. What is phase 2? 20% margin of safety. So whenever Herenba will hit 514 rupees, I will purchase it again, some more quantity. Phase 3, 25% margin of safety. 482 rupees is the phase 3 entry price. At phase 3 also I will buy a part of it. So this is why we are purchasing it 3 times, because we want to take advantage of the dropping share price. If you are waiting for 482 rupees, what if the stock goes to 490 and it reverts back to 2000 rupees? You will lose the opportunity, right? So I don't want to lose the opportunity. So I will incorporate only 10% margin of safety and I grab the opportunity first. I'll just grab the opportunity and I'll wait for the second entry and third entry to scale up my investment. So first I will not invest large amounts. At 10% margin of safety, I will only invest around 2.5%. Then 2.5, then 2.5. I'll cover that in the portfolio management part. So entry prices are computed. Entry 1, 10% margin of safety. Entry 2, 20% margin of safety. Entry 3, 25% margin of safety. What about the exit prices? Now the similar concept for entry prices also we are using the intrinsic value. For exit prices also we are using the same intrinsic value, but with a twist. So what we do is, for the exit price, we take the maximum intrinsic value. Out of all these numbers, what is the maximum intrinsic value of this company based on all these numbers, worst case, best case, PEG, DCF and all? What is the best case? 1731 is the maximum intrinsic value. So there is a possibility that this could be the value per share. So there is a probability, but while buying, we will not consider that. While selling, we want to make some speculative return as well. So we want to sell at the maximum point. So that is why we will not take 220 or 800 rupees as the intrinsic value when we are selling. When we are selling, we take the maximum. What is the maximum intrinsic value can be possible? That is what we look for. Here it is 1731. We will not sell it at 1731. The Excel sheet itself will compute. As you can see, there are formulas. So the Excel sheet will by default will take the highest number from here, and to that it will add 25% premium. So we will not sell exactly at 1731. The first exit price is at 25% premium to that number. Reverse margin of safety. While buying, we want 25% discount, but while selling, we want 25% premium. So we want to get as much as possible. That is the first exit price. Second exit price is 35% premium to this value. Third entry price is 50% premium to this maximum value. So that is how we determine the entry prices and the exit price of a stock. But you are not doing anything, my dear friends. Don't try to adjust anything. Please don't adjust any numbers here. Just try to understand the concept. Even here also you should not adjust any number. Dhanda also you can adjust these growth rates. Only yellow cells you find here, you can only adjust yellow cells. You cannot touch any other cells. And you touch that yellow cells only if you know what you are doing. Otherwise you just ignore, just follow the Excel sheet. So as you can see, this is how the entry prices and the exit prices are computed, and total return, half total, this multi-bagger gain, how it is computed. Multi-bagger gain is nothing but the difference between the current share price and the phase 3 exit price. So if you purchase it at the current share price to phase 3 exit price, what is the difference? So that is how the multi-bagger gains is computed. So what we have, okay. Now you might be thinking, okay, I have to check a lot of things, like there are so many things I have to check. I'm getting confused. Like I thought initially it is very easy to use the Excel sheet, but after going through full day workshop, I feel like I'm kind of confused. I'm not able to do what I mean, if I have to go through all this worksheet, it is pretty difficult for me. If you are thinking that, don't worry. You don't need to do any of this. I mean, obviously I want to teach you, so I have taken you through all these worksheets, but in general, you don't need to do any of this. Let me show you something. To simplify your job, so pretty much to simplify your job, we have developed something called as the 2-minute test. So from morning to till now, I have not taken you through the 2-minute test. So initially, when you were initially in the weekly mentoring also, or during the webinars also, I would only show you the 2-minute test, because 2-minute test is more than enough. So whatever I have shown you so far, all that snapshot you will find in the 2-minute test itself. So for majority of companies, I don't check all the financial health, income statement, growth. None of that is required, my dear friends. Let me show you. Indian Energy Exchange. I will go with the same order. Now here the numbers might be different, different order, but I'll go with the same order. First, we started with financial health analysis, right? Financial health analysis, what are the 3 important things we look for? Financial leverage less than 4, debt to equity less than 1, interest coverage ratio greater than 8. Here you can see 6th checklist. Financial health. Financial health numbers are already provided here. You don't need to specially go and check financial health here. The same numbers you will find in the 2-minute test itself. So first, let's look at the financial health of Indian Energy Exchange. 2.41, good. Almost debt-free company. 0.01, almost debt-free. Interest coverage ratio 206. So what do you think? Financial health is strong, average or weak? Obviously it is strong. That is the first thing. Second, profitability. Is it making money? You don't need to go to the income statement. Look here. Has the company ever made any profit? That's the question I asked here. So 6992, yes, this company is making money. Is it consistently making money? Yes, it is consistently making money. What about the growth rate? You don't need to go and check the growth worksheet. No. Look at the growth here. This is the growth numbers we have provided here. All these are growths. So net profit CAGR 3 year is 22%, 5 year is 22%, 7 year is 19%, 10 year is 18%. So you don't need to go and check the growth worksheet. Here itself that number is provided. So as you can see, yes, it is making money. It is consistently making money. And it is a high growth company as well. So Indian Energy Exchange is a high growth, stable company with strong financial health. Till that point we have covered here. Now what about the cash flows? Cash is coming into the business or going out of the business. So for that purpose only I have taken, here you can see this is the cash flow from operations, my dear friends. Cash flow from operations are consistently positive, right? Net profits are also positive. Cash flows are also positive. So net profits and cash flows are narrating the same story or different story? Same story. If these numbers are positive, these numbers are negative, then it's like narrating a different story. And free cash flows are also provided here itself. Does the firm generate free cash flow? As you can see here, these are all free cash flows. And here I have provided free cash flow to sales also here I have provided. So first, financial health, strong. Growth, consistent and high growth. What about profitability? What about cash flows? Cash flows are positive, free cash flows are positive, and they are in line with each other. Okay. Quality of earnings is also very good. Done. What about the profitability? Return on equity you can see here. Return on equity is consistently more than 15%. But now you can ask me here, Vishnu, okay, 30, 40, 50% is here. But what is the key driver? How to know the key driver? Is it net margin? Is it volume, that is asset turnover, or is it financial leverage? Have to know. See, looking at this free cash flow to sales, since it is more than 5% here, we can conclude that it is a high quantity profitability company. Profitability is high quantity. But have to know, just by the looking at this return on equity number, have to know whether it is high quality profitability or not. Very simple, my dear friends. Financial leverage is given here. as long as financial leverage is less than 4, that return on equity either generated through net margins or through asset turnover. Anything is fine, right? Whether it is volume or whether it is margin, anything is fine as long as it is not the debt. So here you can see financial leverage is less than 4. So we are happy. So this is high quality profitability. Here you will not know whether it is margin or whether it is asset turnover, but it doesn't matter because financial leverage is anyway low, right? So even that is also done. Profitability, high quality profitability is there, high quantity profitability is there. Now what about growth matrix? That also you can compute here itself. So return on equity is more than 15%. Free cash flow to sales is more than 5%. So it's a great company. So based on the profitability matrix also, it is green matrix, right? Great company. Till profitability we have done without going to any other worksheet, without touching any worksheet. All of this analysis we have done just in the 2-minute test itself. So this is what I have covered in the morning. Till morning, that is what I have covered. What I have covered later on, whether it is a good buy or not. So first we check the relative valuation, and I clearly mentioned that we check price to earnings, price to sales, price to book, earnings yield and all, but we place more emphasis on the price to earnings ratio. All the remaining ratios are just supporting ratios. What is the most important ratio for us? Most important ratio is the price to earnings ratio. And that is the reason I have provided the price to earnings ratio in the 2-minute test. So here you can see the current PE ratio, 3-year average is provided, 5-year average is provided, 10-year average is provided, and last 10 years of PE ratios are also provided. But this was, this company got listed only in 2018. So before that, PE ratios are not available. So as you can see, 10-year PE ratios will be provided, current PE will be provided, 3-year average, 5-year average, 10-year average will be provided. So relative valuation to know the speculative return also you can do that. So what is the speculative return of this stock? Is it positive or negative? Obviously PE ratio is 46. What do you mean? Speculative return is negative. Now, once we are done with this, if you are satisfied here, because we are not checking any other worksheet, we are only considering these numbers, and only with these numbers we have done the entire analysis. Now, if this PE ratio is, let's say, okay, let's suppose this is 12, here it is 12, right? Now Herenbai Industries, why I'm not taking is most of the data is not available for this company. So let's look at some company with some data. So for example, this company here you can see, this is Sri Jagdamba Polymers. So as you can see, profitable, all of that, as you can see, this company free cash flow to sales is 0.77. Everything similar to Indian Energy Exchange. The only difference is, since its free cash flow to sales is less than 5%, this is not a great company. What company it is? Return on equity more than 15%. High quality profitability. Why? Financial leverage is less than 4. So it is high quality profitability. What about the quantity? It is not high quantity profitability. So in which matrix it will fall? Green matrix, blue matrix, that is chalo. Great company, emerging company, declining company, or worst company. Where it will fall? Obviously, it will fall into emerging company, blue matrix. So even Shamalal Setia also fall into blue matrix only. So Indian Energy Exchange. So once you are satisfied with the 2-minute test, once you think that everything is great, now I can continue forward and check the entry price and all. To be honest, if you are a beginner, if you are a out and out beginner, don't even do any adjustments. I have just shown you how to make the adjustments. In DCF, this number you can adjust. Just go to initial cash flows, look at these numbers. If you want to adjust, you can adjust, or else do nothing. You can adjust the growth rate. If you want to adjust the growth rates, you can adjust, or else if you don't understand what you are doing, then don't do nothing. Most of the time, do nothing is the policy. Excel sheet will compute. Let the Excel sheet compute it. Total returns. So as you can see, the speculative return is negative here. If it is negative, then it is gone. Multi-bagger gains should be more than 200%. So intrinsic value here, as you can see, the intrinsic value is 96, share price is 159. Entry prices are not triggered. But let's say if the share price is, let's say, 80 rupees, first entry price would have triggered. So if the share price is 65 rupees, all the entry price would have triggered. So that is how you value a company. So next we have 2-minute test is also done. I hope you understood the 2-minute test. I hope you understood, because 2-minute test is considered to be the heart of the sensible investing process, my dear friends. You have to understand 2-minute test. Just by looking at this sheet, you can do complete analysis of a stock, even without going to any other Excel, any other worksheet. Just by looking at this sheet, you can do everything. Okay, so this is very important. So next we have portfolio. So what we have covered so far, see, people are obsessed with picking the right stocks. So whatever we have covered so far is all about picking the right stocks. Have to pick the right stocks is what we have covered. But picking the right stocks is not 100% of investing. So if you want to be a successful investor, you should know 2 things. First is picking the right stocks, which is important. Obviously, we all have to pick the right stocks, but that is only 10% of investing. Whatever we have covered so far is only 10% of investing. What I am going to cover now is the remaining 90%. So pay attention. This 90% is nothing but portfolio management. If you invest 100% or entire capital into a single stock, then the risk is 100%. If you invest in 2 stocks, risk will be distributed 50-50. 4 stocks, 25-25-25. So as the number of stocks increase in your portfolio, the risk will mitigate, the risk will reduce. So that is the objective. We have to invest in an optimum portfolio where the return will be maximized and the risk will be minimized. So that is what we want to do. So you can be the best analyst on this planet, but you cannot take the risk out. Future is always uncertain. Risk is inevitable. You might be investing in a stock with 100% conviction, but that company might go through multiple risks. There can be a fire accident in the plant, earthquake, bomb blast. I always cover this, how you will control all this risk? By having an adequate or diversified portfolio. So now I am going to cover the portfolio part. So far, whatever we have covered is just, only 10% of investing. This is the 90%. So how many stocks to have in a portfolio? So generally people ask me, like, they are curious to know, like, how many stocks to have in a portfolio and all. But there are so many theories. There is no straight answer. Investing is confusing because there is no right answer. There is no straight answer for anything. For example, if you 2 + 2, 4, it's a straight answer. But how many stocks to have? There is no straight answer. But we try to find something, more logical, more scientific that we can use. So I'll give you all the logical conclusions why we are doing this. So first, there is an old proverb which says, don't put all your eggs in one basket. Whereas Andrew Carnegie says, concentrate your energies, your thoughts, and your capital. The wise man puts all his eggs all his eggs into one basket and watch that basket. Someone says, never put all your eggs into one basket. Whereas someone says, concentrate, put all your eggs into one basket and watch it very carefully. Now, which should I choose? The first or the second? So I thought of taking the help of some successful investors, successful authors, so that obviously their insights can help me. So in the 5th chapter of The Intelligent Investor, written by obviously Benjamin Graham, the father of value investing, this is what he said. There should be adequate, though not excessive diversification. This might mean a minimum of 10 different issues and a maximum of about 30. So what Benjamin Graham mentioned is, you can have a portfolio anywhere between 10 to 30. That is according to Benjamin Graham. Okay. According to Warren Buffett, when wide diversification is only required when investors do not know what they are doing. Diversification is a protection against ignorance. It makes little sense if you know what you are doing. So according to Warren Buffett, wide diversification, having 50 stocks, 70 stocks, 100 stocks in a portfolio doesn't make any sense if you know what you are doing. That many stocks are not required. And the problem is, if you have 100 stocks, risk is very low. But the thing is, return will be compromised. So you will only generate mostly market return. So what Warren Buffett suggests is a focused portfolio. This is what Warren Buffett suggests, focus investing. So we focus, this is what he always says, we focus on investing in a few outstanding companies. We are focus investors. Now, what exactly is this focus investing? Choose a few stocks that are likely to produce above average returns over a long period of time. Concentrate the bulk of your investments in these stocks and have the fortitude to hold steady during any short-term market gyrations. Now, let me explain. This is going to help you in your portfolio management, and this is 90% of investing. Picking the right stock is just 10%. This is the 90%. So first, choose a few stocks. How you are going to choose those stocks? Now, that is the last topic for today. How to generate multi-bagger ideas, we have not covered it yet. That is going to be the last topic for today. So how to choose few stocks? The next topic is that. Likely to produce above average returns. That is nothing but company generating high return on equity, high return on capital employed consistently for a long period of time. So choose a company with strong financial health, high growth, profitability, and invest in that stock. Hold for a long period of time, irrespective of what is happening in the short term. That is what focus investing is all about. But these are the questions. How do I identify those few above average stocks? Don't worry. Next topic is how to identify the multi-bagger stocks. I'll cover there. But these are the most important questions. How many is few? Because here you can choose a few stocks. Like Warren Buffett already mentioned, wide diversification is not required. So 30, 50, 100 stocks is not required. Few is enough. But what is that few? How many is few? What do you mean by concentrate? How long should I hold? You know, it should be 5 years, 15 years, or 50 years. How long? What should be that holding period? So first, let's start with how many is a few? How many number of stocks to have in a portfolio? So let's start with the number of stocks. Seth Klarman, one more great author. This is what he said, 10 to 15. According to Benjamin Graham, 10 to 30. According to Seth Klarman, 10 to 15. So better off knowing a lot about a few investments than knowing a little about each of great many holdings. More critical than determining the exact number is understanding the general concept behind it. Focus investing falls apart if it is applied to a large portfolio with dozens of stocks. So 10 to 15, I'll give my number. So just I'm giving you Seth Klarman's number, but my number is little different. My approach is little different, which I'll cover going forward. So here you understand one thing, 10 to 15 stocks is what you have to hold. So just remember that. We will revisit that again. Next, what do you mean by concentrate? Phil Fisher, I have already covered, in all my webinars. Phil Fisher was mentioned. Because of Phil Fisher, I have done that multi-bagger study. So Phil Fisher was also known for his focus portfolios. He always said he preferred owning a small number of outstanding companies that he understood well to owning a large number of companies which he doesn't understand. As a general rule, Fisher limited his portfolios to fewer than 10. Philip Fisher would invest in less than 10 stocks. The first 3 or 4 stocks actually contain 75% of his total investment. Only 3 or 4 stocks is 75%. That means he would have invested almost 20% into each stock. 20% into each stock, but we don't do that. You shouldn't do that, absolutely. So this is what is it. Buying a company without having sufficient knowledge of it may be even dangerous than having inadequate diversification. But remember one thing, until and unless you have minimum 15 years of experience, 15 years of investing experience, never invest below 10 stocks. I don't have 15 years of experience, so even I don't permit myself to invest below 15 stocks. Sorry, below 10 stocks. So by default, like I said, it should be 10 to 15. Like Seth Klarman said, 10 to 15 is minimum. But initially, if you have a smaller capital, what I would suggest is start with a 5-stock portfolio. But that 5-stock portfolio is not permanent. Eventually, you will add the capital. You will slowly increase the number. Okay. But initially, you start with 5-stock portfolio. But as the capital increases, you will increase the number of stocks. Next, this is what Warren Buffett do. He would invest 10% of his capital into each stock. So he will have 10 stocks in a portfolio. Last but not least, how long should I hold? Now, this is what Warren Buffett said. Warren Buffett would probably say anything less than 5 years is a fool's theory. The goal is not zero turnover. Zero turnover is again foolish. If you have some good opportunities, you have to take advantage of that. So we should be thinking of a turnover rate between 10 to 20%. A 10% rate says that we hold a stock for 10 years. 20% implies we hold a stock for 5 years. But in our sensible investing process, we try to hold for 2 years. If the stock is performing, we may continue to hold it. But 2 years is minimum is what we fix. So after 2 years also you can sell, 1.5 years. End of the day, it depends upon how you are going to utilize that funds. If you sell it, you have a very good opportunity elsewhere. You sell it, you reinvest. It is not just holding a stock. Opportunity cost also there. If there is a good opportunity out there, if you are not investing and holding the same stock, you will miss out that opportunity, right? So depending on that, we will decide. But for us, how long it is? For us, it is 2 years is what we generally take. So in summary, this is the process of investing actions. Choose a few stocks, that is 10 to 15 stocks. Good companies like high growth, high profitability, financial health, 10 to 15 high quality stocks. Choose them and they have to be trading at favorable price as well. Allocate your investments appropriately. Okay, so appropriately place the investments. As long as things don't deteriorate, just leave the portfolio intact, hold it for long term, at least two years minimum. So that is what they mentioned. But I have to cover something else here because this is what I generally cover. That is the general, theory of what people will tell you, like hold 10 to 15 stocks, hold it for long term, buy high quality companies. Okay, anyone can read a book and he can learn that. But practical approach, how do you actually practically approach? Like how do you kind of, implement it? So I will never have a number in my mind. I will never invest in number of stocks. For me, number is irrelevant. So what I will do is, first I will go through the 2-minute test. Let's say the company has passed the 2-minute test. Then I check for the favorable price. If it is trading at a favorable price, then I will check for that company. If it is, let's say it is triggered at entry 1. At entry 1, I will invest 2.5% of my capital. Let's say if I have roughly I'm saying, let's say I have 1 crore rupees capital. Let's say if I have 1 crore, what I will do is I will invest 2.5 lakhs at entry 1. At entry 2, I will invest again 2.5 lakhs. Entry 3, I will invest 2.5 lakhs. So what I am doing is I invest a maximum of 7.5% in a single stock. That is the maximum. I will not invest more than 7.5%. That 7.5% also I will not invest at once. 2.5, 2.5, 2.5. But for suppose, since most of you are joining, like with most of the companies that we suggest, they are directly at, almost at, triggered entry 3. Third entry price is triggered. Then there is no, it makes no sense to buy 2.5, 2.5. You have to buy it at once. In generally going forward, whenever you are following some companies, you are waiting for some companies to get into buying zone. Then it will start with entry 1, right? Then you at entry 1, you will invest 2.5%. At entry 2, you invest 2.5. At entry 3, you invest 2.5. So with that, you will invest 7.5% of your capital into single stock. So this is what I generally do. Minimum 5% to a maximum of 7.5%. So what happens here with this 5% to 7.5% is considered to be the core investment for me. For example, I invested 2.5 lakhs into a stock. It triggered, let's say 100, 90, 85, or let's say 75. Let's say this is 100, 80, 75. Let's say I'm just giving an example. These are the entry 1, entry 2, entry 3. At 100 rupees, I invested 2.5 lakhs. And I'm waiting for entry 2. But the stock came to 85 and it went to 250 rupees. It never touched entry 2, but I was having 2.5 lakhs there. So this is why I am investing at entry 1, entry 2, and entry 3, because some 90% of the time, entry 1, if it is triggered, entry 2 will be triggered. 95% of the time. With almost 70% of the stocks, if entry 1 is triggered, entry 3 will also be triggered. Eventually, sooner or later, it will be triggered. But 95% of the time, if entry 1 is triggered, entry 2 will also be triggered. Without triggering entry 3, it may go up. So entry 1, entry 2, I have already invested 5% of my capital over there. So it is considered to be my core portfolio holding. But the stock that I have invested only 2.5% is not considered to be my core portfolio holding. I invested to secure the opportunity, but without triggering entry 2, it is going up. I'll not consider it as my core portfolio holding. If at all I have to sell any stock going forward, if there is any new opportunity available, this non-core holding will be the first stock I will sell, because it is not my core portfolio holding. Minimum 5% I have to invest in a stock. If I am investing only 2.5 in stocks, first I will sell them, not immediately. If it is going up, let it go up. So the point is very simple, my dear friends. You have to understand. People generally ask me, Vishnu, share prices go up and down. Why you are not really concerned about all these things? We never see you worried about any share price, because if the share price go down, I am happy. If the share price go up, I am happy. Because of this, I invest at first entry price. I want it to go down, because I invest only 2.5% over there. I want the stock to go down. 2, again 2.5. Entry 3, again 2.5. So by this time, I have seen stock price going down 30, 40, 50%. Even if it goes down 10% or 20%, I will not be bothered. I have seen, dude, from 100, if it can go to 70 rupees, from 70, it can go to 50, it can go to 65. How am I bothered? So I am already done with that. Mentally, I am already done. For example, I invested here. The stock price is going up, but I want it to go down so that I can purchase here. irrespective of whether it is going up or it is going down, I am happy, right? If it is going up, I am making money, not a lot of money, but at least I am making money. If it is going down, I will get an opportunity to buy. So in both sides, the market is crashing or market is peaking, I have some good news with me every day. So irrespective, I am at advantage. I have got all the advantage. So that is how I place myself. So no matter what, if you apply this, in downside you will be protected, in upside you will be benefited. Now comes the same thing happens during the selling as well. So I sell in similar fashion. Now the thing is, how many sectors to have in a portfolio? If you have 7.5% maximum, then by default, you can have a maximum of how many stocks? Around 13 stocks, 12 to 13 stocks you can have. If I invest 7.5% into all the stocks, 13 stocks I can have, around 13 or 14 stocks I can have. That is the maximum. Or if I invest 5% into all the stocks, then I can have 20 stocks in my portfolio. So I will never invest actually in a number of stocks. I never think like, okay, I'll invest in 15 stocks. Okay, I'll invest in 17 stocks. No, it is completely based on the opportunities available. So the entire mix, 5%, if I invest in each stock, I may end up with 20 stocks. If I invest 7.5 in all the stocks, I may end up with 13 or 14 stocks. But in general, what happens is I will have around 15 to 17 stocks in my portfolio. 15, 16, 14, depends. 17, 18, sometimes 19, sometimes 16, it depends. But I will not check the number of stocks. For me, it is all percentage of what is the percentage of allocation. Now comes the industries or the sectors. You need to have 5 sectors in your portfolio by default. Minimum 5. Maximum it's your wish, but minimum 5. Why? Because let's say you have 15 stocks in your portfolio. 7 stocks from IT, the remaining 8 from finance sector. Even though you have 15 stocks in your portfolio, it is equal to having only 2 stocks. Yes, even though if you have 15 stocks, it is equal to having only 2 stocks. Why? Because if something happens to IT industry, you are gone. Your 50% of portfolio is gone. If something happens to finance, the remaining 50 is gone. If 2 sectors didn't perform, 100% of your portfolio is gone. So it is not the number of stocks. Number of stocks along with the segregation of portfolios. Sectors. So you need to have a minimum 5 sectors in your portfolio. So for example, I have alcohol, you can have chemicals, IT, pharmaceuticals, finance. 5, minimum 5 is done. Then you can add more, you can add metals, or there are many sectors, right? But try to maintain at least 5 sectors in your portfolio. That is going to help you. So something bad happens to a particular sector, it will not affect you tremendously. If you have only 2 sectors or 3 sectors, then if something happens, the portfolio will suffer. So portfolio should not suffer. It should rally irrespective of whatever is happening in the market. That will only happen when you have, stocks with multiple sectors, different sectors. If you have, I mean, some or the other sectors will always be booming. That booming sector, if you have in your portfolio, it will help the portfolio to outperform the market. So that is regarding the portfolio management. Now, so far we have covered everything, but how to generate the multi-bagger stock investment idea. So that is the last topic for the day. And obviously I've already covered it. So how to generate the multi-bagger stock investment ideas. So before we go and generate the multi-bagger ideas, what are the kind of stocks we look for? This is basically the summary of everything that we have done so far. First, financial health should be strong. Next, growth should be high. it should be stable, it should be high. Next, profitability should be high. Quality and quantity, both it has to be high. So this is the quality part. Next, valuation, it should be favorable. And we generate, and here we have cash flows as well. Cash flow should be positive, free cash flow should be positive, and all of that we have covered throughout the day. And I hope you already got that point. So based on these parameters only, we will generate the stock investment ideas. So that, you know, those key principles, key parameters is what drives the stock investment ideas for us. So this is how we generate the stock investment ideas, and all the sources, all the links to generate stock investment ideas are already provided in the Excel sheet itself. So just go to 2-minute test, stock ideas worksheet. You can see there is a worksheet called as stock ideas in our Excel sheet. Just go to stock ideas Excel sheet, stock ideas worksheet. If you scroll down, this is the first way of generating ideas. Alembic, Dhanuka, Kaplan Point Lab, there are many companies. So what I have done, I have gone through all the companies in India. Almost like 6,000 companies I have gone. So this is, I've shown this many times, I guess. So this is the list of all the companies in India. So I've gone through all those companies and I have shortlisted the potential multi-bagger stocks. And these are the potential multi-bagger stocks. Now, if people ask me, can I directly go and invest in these stocks, since you said like these are all potential multi-bagger stocks? What is potential multi-bagger? High growth, financial health, profitability. That is potential multi-bagger. So based on the quality I have shortlisted, price you have to check. For example, P&G Hygiene. For example, let's look at P&G Hygiene. If you click, it will redirect you here. This is a very good company. Quality, top notch. Growth, high growth company, high profitable company. Financial health, great. This can be a potential multi-bagger stock, but it will be a multi-bagger only if the price is right. Quality combined with price will give you multi-bagger returns. I have given you the idea, but you have to check whether it is the right price or not. It is trading at 80 times earnings. Obviously, 80 times earnings is not the right price. So what you will do, you will not invest. You will let it be in the watch list. There will be a time when P&G Hygiene or Dabur India or Britannia or any other company in this list, there will be a time when they will get undervalued, then you can invest. So this is the first way to generate ideas. For example, if you look at Kaplan Point Labs, you can see the current PE ratio is 19.7. So it's a high quality company and it is trading at 19.7 PE ratio. So you can see it might be in the buying zone. You export it to Excel, you check the total returns, you check the valuation, the entry price and all, then you will know whether you can invest or not. So that is the first way to generate ideas. The next way to generate ideas is you go to screener, you input that, parameters and all. Let me show you. Just click on that. It will take you here. So this is multi-bagger ideas. 66 ideas showed up today. And this 66 number will keep on changing. So it's a pretty dynamic list, A particular company, if its fundamentals improve, it will be added to the list automatically. And if a particular company it is deteriorating, it will be kicked out of the list again automatically, done by screener. We are not doing anything manually. And if you click here, get updates by email, so without even coming here, you will directly get all the email notifications. So just click here and you will receive email notifications whenever a new stocks added to the list. 66 stocks showed up, but half. Now comes the most important 20 parameters. So look at, actually you are not inputting anything. So don't ask me, please put those parameters into the chat box and all. Please don't ask me that, because you are not inputting anything. Just click on that link, it will be directly available. So you don't need to do anything manually. Everything is automated. So what you will do, you will go to the Excel sheet, click on this link. So just do that. It will directly redirect you here, but you should know how we are generating these ideas, like what went behind, like what are the ideas that showed up. First is a debt to equity ratio less than 1. So what we are doing here, financial health. So we want companies with strong financial health, right? Debt to equity ratio less than 1. If you scroll down here, so there is, okay, debt to equity ratio less than 1. For why we have inputted that criteria, financial health should be strong, right? Next, profit growth 5 years should be greater than 15%. Profit growth 10 years should be greater than 15%. So high growth is what we invest in, but stable growth is also important, right? So high growth, stable companies, 5-year average, 10-year average, when you take that average number, you will understand good and bad will be averaged out, right? So then you will understand whether it is consistent or not. So 1 year, 2 years, we don't check. 5 year, 10 years will give you the consistency. So next is operating cash flows, 3 years, 5 years, 10 years, last year, preceding year should be greater than 0. Why greater than 0? Because I want the cash to come into the business. If it is positive, I cannot put it as 100 crores, 200 crores or 500 crores. Numbers will not help you. Never look at the numbers. As long as it is greater than 0, it is positive. I want positive cash flows. I want cash to come into the business. So I put it as 0. So the cash flows will be positive. Next, free cash flow, same thing. Cash flows and free cash flows also 5 years, 10 years greater than 0. Next, return on assets 3 years, return on assets 5 years greater than 8%. Why? Along with return on equity, we check return on assets as well to know the quality of profitability. If the return on assets is less than 8, then it is not high quality profitability. So I hope you still remember, return on assets should be more than 8%. Only then it is considered as high quality profitability, and for that only I have incorporated that as well. Next, average return on capital employed 20%, 5 year, 3 year, 5 year, 10 year, 20%. If you want, you can reduce that to 50% also, 15% also. In general, to reduce the number of stocks, I put it at 20%. But if you wish, you can keep it at 15%. The number of stocks will increase. If you wish, you can do that as well. Next, pledge percentage of the promoter should be less than 10%. What is that? Pledge is nothing but the promoters or the founders of the company will, pledge their shares with some financial institution and borrow money. If the promoters are not repaying the amount, then who will be at, obviously the lenders will sell it off. If they pledged 50%, 60%, 90% or 100% of their holding, for example, let's assume promoter has 50% partnership in the company, 50% holding the promoter has, and he pledged 100% of his holding. What if the lender sells all the stake? 50% of the company, just imagine selling in the market. The share price will be will drop by 50, 60, 70%, which is a very big risk, right? So I don't want that to happen. So that is the reason, as long as promoter pledge is less than 10%, I am okay. Less than 10 is fine with me. More than 10, I can't take it, because let's say he went and pledged 10%. Even if the lender is trying to sell that 10% also, it may not affect the company significantly, right? So that is what. Next is change in promoter holding 3 years should not be more than 15%. So I don't like promoters or the top executives selling the company in large quantities. So if in the last 3 years, if the promoter sold more than 15% of his ownership, I have no interest in buying that company, because when the owner is selling his stock, why should I invest in that stock? It makes no sense, So I generally don't invest if the promoter of the company is selling the stake in that company. So next, current assets greater than current liability, contingent liabilities. Now, contingent liabilities is nothing but these are unexpected liabilities, uncertain. For example, there is a legal dispute happening, or there is some tax which has to be paid. I mean, it is not yet decided whether the company should pay that tax or not. They have some legal disputes. We don't know who will win. If the company wins the case, well and good. Otherwise, the company has to pay, let's say, 200 crores of fine. So in such scenarios, they are all contingent liabilities. We can't say whether that contingent liability of 100 crores, 500 crores, 1000 crores, whether the company has to pay or it doesn't pay, it doesn't have to pay, is only decided by time. So there is some uncertainty. So what I do is, current assets should be able to cover those contingent liabilities, because I don't want to take that mental pressure of whether it can meet it or not. So contingent liability X, current assets is more than X, I'm fine. I will not even consider that. Next is market cap. Market cap is debatable. You can choose market cap more than 1000 crores, greater than 300 crores, greater than 100 crores, greater than 5000 crores. Market cap is you decide. I will not give you any market cap related number. So you can adjust that number. For example, if you are not comfortable with 500 crores, what you do is just input 1000 crores. If you input 1000 crores, as you can see, 10 stocks, 12 stocks reduced from here, which is fine, but I am fine. I'm okay with 500 crores. So I sometimes I put 300 crores as well. So anything is fine. Market cap, don't place too much emphasis on market cap. So 66 showed up in the list, but 66 out of 66 are not in the buying zone. So we are not going to invest in every stock. So what we are going to do is, as you can see here, if you double tap here, it will give you in the ascending order. So we only invest, or we try to analyze the stock if the P ratio is less than 20. So as you can see here, till here, the P ratio is less than 20. First 26 stocks. So we only invest, or we consider that to be the buying zone. So that's how you can generate ideas, but you have to understand one thing. Just because a stock is in the list doesn't mean that it's a high quality company. No, some companies are cyclical companies. Just because of the averages, they come and sit in this list. For example, if you look at Bansal Engineering, I get many queries regarding Bansal Engineering. So it is trading at 5p. It seems to be undervalued, and all people ask me. So if you go and check the profit and loss statement, this is the operating profits of the company, operating profit margins. Here you can see operating profit margins are very low. 10-year average is not even around 6% or 7%. But if you check the last 1-2 years, the margins dramatically increased to 35, 33, 28. Now that is the reason this particular stock ended up in the list, because all the averages got skewed by these big numbers here. So that's the reason Bansal Engineering ended up in our high quality list, but it is not a high quality stock, because these margins will not sustain. So eventually, when the stock go and hit 6% margins, the net profits will drop, the share price will drop, investors will lose a lot of money. So there will be a lot of cyclical companies in this list. So you have to go through the stocks. You have to perform whatever we have performed so far till morning, financial health, profitability and all. Obviously, we only check the 2-minute test. So remember one thing, pay attention. This is very important. If a company doesn't pass our 2-minute test, now people generally ask me, for example, this is Vodafone Idea. People call me and say like, Vishnu, this company passed the test. What makes you think the company passed it? You see all the red flags here. They tell me like they call out this. There is a buy here. So it says buy. Excel sheet cannot think, my dear friends. If Excel sheet has brains, then Excel sheet will be richer than Warren Buffett. Warren Buffett wouldn't be in the list of Forbes list. Warren Buffett wouldn't be there. Excel sheet will be there if it has brain. Excel sheet doesn't have brain. It cannot think. So don't expect an Excel sheet to think. It cannot give you any solutions. It can only give you the raw data. You have to analyze. You have to make the decision. So there is a drop down here. So if you click on that drop down, buy, sell, hold, avoid. Based on that, you decide. For example, Vodafone Idea. Will you invest in such companies? Absolutely not. So you better avoid such companies. IEX, for example. IEX is a very good company. As you can see, 2-minute test, it's a very good company, but this is not the right price to buy that stock. So what you will do? At this point, you will avoid. You will keep it in your watch list. Once the company enters that favorable zone or the buying zone, then what we will do, we'll go and we'll buy the stock. So that's how you do it. So that's how we generate ideas. And one more way to generate ideas is obviously IPO stocks. So if you click here, you will get the list of all the IPO stocks. So as you can see here, this is the list of all the IPO stocks. But again, we are not applying for any IPOs because generally an IPO is always overvalued. Any IPO for that matter, it is overvalued. For example, people were asking me this LIC India IPO was a very big headache for me. Because every once in a while, I mean, every single day I used to get 20 to 25 minimum 20 to 25 people would ask me like, should I invest in LIC India? Should I invest? LIC India IPO, when it was launched, when it got listed at 200 P. The price to earnings ratio of LIC was 200. 200. People were asking me, should I buy it? I never invest if the P ratio is more than 20. Why would I invest in LIC India if it is 200? And you know what happened next? Everyone who invested lost their money and they were asking me again, the same question repeated. Should I hold LIC India? Previously, they were asking me, should I buy? I said, no, don't buy. Now they are asking me, should I hold? When I asked you not to buy, why you have bought it and why you are asking me whether I should hold it? Now you do whatever you want to do. I will not give you any advice because anyway, you are not going to follow it. But the thing is, you have to hold it. In case if you have LIC India, then all the more power to you. Just hold it and pray that eventually the price that you have paid will come. So IPOs are generally overvalued. So we buy them when they are undervalued. This is the hunting ground. So you just follow the companies, you check whether if there is any undervalued stock here. Based on that, you make the investment decisions. So I think we have covered everything. So the last thing that I will obviously take you through is our website, theinvestordiary.in. So this is where you have to, okay, it is asking me to log in. 1 second, let me log in. So more or less I've completed, but there are few things that you need to know because which cannot be, there are few things I cannot cover live. It can only be covered through videos. So what are those? Let me cover. But before that, let me log in here. Give me a second. It is asking me to log in. So we are almost done. So what the summary is very simple, my dear friends. So what most people think is they are always more obsessed with, picking the right stocks and all, but they place very little emphasis on the portfolio management. Investing is all about how you allocate your money, how you manage your stocks. It's not about how you pick the stocks. You can pick average stocks and you can make a lot of money if you know how to manage a portfolio. Because end of the day, it's not just buying the stock, it is holding that stock and it is selling at the right price also. So all of that will help you make money in the stock market. Picking the right stock is only, you are like, you know how to enter, but what if you don't know when to exit? It is not going to help you. So learning 50% of investing will not help you. Along with, buying, you should know holding and you should know selling as well. So logins, 1 second, let me log in. I'm assuming that you guys have started watching the video course. So that is what I'm going to show you once again. So let me share the screen 1 second. So this is our website, as you already know. Go to my account, making yourself rich, golden offer. And obviously, you know that the content is classified into 7 levels. But due to time constraints, level 1, level 2 is not covered in the, full day workshop, because we don't have that much of time. Single day is not enough. So actually, to cover the entire concept, I require 4 days. 4 days, 4 full day workshops is required. So, but it is very difficult. So I have to compress it into a single day. So level 3 is done. But in level 3, in today's session, what we have covered is that first part is not covered. What is covered is understanding the balance sheet. This is covered. But again, there is lot to learn. Balance sheet analysis of 35 companies. So what I have showed today is just shortcuts. I have given you all the shortcuts. So if you want candid details, lengthy explanation on each and every cell, each and every worksheet, if you want me to go through all those things, then you should watch level 3, income statement, cash flow statement, and all profitability matrix. So generating stock investment ideas. So there is a lot of concepts that we cover here as well. So today what I have shown you is a shortcut. Full day workshop, we have very little time, so we cannot explain in candid detail. So I've shown you all the shortcuts. But if you are interested, you can go and watch the videos. The biggest shortcut I have taken is valuation, because it will take me 2 days to explain in detail. It will take me minimum 2 full days just to cover valuation part. But obviously we don't have that much of time, so I have to rush through valuation as well. But if you are really interested to learn, to understand the nitty-gritty details of, valuation, then you have to go through. Valuation is a very big concept, my dear friends. When not to buy, you have to learn before you learn when to buy. When not to sell, you have to learn to know when to sell. So today we have not covered when not to sell, when not to buy, we have not covered, but you already have got the video access. You can go and watch that. Level 7, only 2-minute test and portfolio management is covered. Automations is absolutely impossible. Live session automations is impossible to teach, because there are so many tools that need to be installed. I have to log into so many things. So it's very difficult. So get email notifications when the target price is triggered. Have to set up that. It's a process. You have to install a free plugin into your Google spreadsheet. So once you install that plugin, then that plugin will do all the job for you. So next, create a real-time portfolio tracker. That will take 39 minutes. Obviously, if I have to do everything. Next, monitoring stocks. Have to set up Google Alerts, BSC Alerts. BSC Alerts and Google Alerts is going to help you. You don't need to read any newspaper and all. I never read any newspapers. Not really helpful. BSC Alerts, Google Alerts, more than enough. So there are so many concepts here as well. So you can watch them. So I'm sure you guys are watching the course. If not, please try to complete the course, video course, as soon as possible. So chalo, if you have any questions, okay, it's already 4. But okay, if you have any questions, there are almost 3,000 questions in the Q&A box. So obviously we don't have time to answer 3,000 questions, but I'll try to answer as many questions as possible. Give me a second. So chalo, let me try to answer some questions here. But I'm pretty sure I'm not able to answer all the questions. 3,000 questions, impossible. So what I'll do is, who is the speaker in the TED Talk? Simon Sinek. Simon Sinek is the author, the person that you have seen. Please share the list of top 15 list. You can just mention that with Raju, customer support. So he will share. He'll share the list with you. You have said ITC, Infosys, TCS have low growth. Ignore these companies, but they are present in multi-bagger watch list. Yes, ITC, Infosys, TCS is in the multi-bagger list of stocks, but you have to understand that list was few years back. So I'm not even checking that list anymore. I'm not making any changes in that list. So I'm pretty much using the screener only to generate ideas these days. So like I said, you have to ignore, but anyway, they are overvalued as well. So anyway, ignore. Tata Steel is a bad company. So anyway, we'll not invest in Tata Steel. NMDC will not tick a single box. Growth, it is not ticking. It's a cyclical company. Cash flows, profitability, NMDC will not work. How can SIP in our stock? Decide. Generally the way that we SIP is basically we buy one stock every month. We try to put, let's say 5,000 rupees, let's assume. So what we do is we invest 5,000 rupees every month into new stock. So by the end of 1 year, we have a portfolio. After 1 year, what we do is we will not invest in new stocks. We continue investing in the existing portfolio. In the same stocks, we try to invest. Have to exit is already covered, my dear friend. We apply a premium to the exit, to the highest intrinsic value, and exit price is already covered in the intrinsic values worksheet. You will find the exit prices. So that's where that's how you will exit. Give me the names of the stocks in what you invest. Yeah, you can just text Raju. He will provide the stock list with you. Have to get access to your Excel. You just go to Acha. Okay. I have to cover this. So the point is, most of you are from Golden. People who have a part of our sensible investing family, but there are few people who are not a part of sensible investing family, who are here for new. So let me give you a brief. So we have a video course, we have Excel sheet, I conduct weekly mentoring programs. So don't worry, my team will get back to you how to get the Excel, how to get the course and all. My team will get back to you if you are new here. But most of them are not new. Most of them are old students only. But some of you are new. So don't worry, my team will contact you. Don't worry. Okay, after the completion of course, do we have any other class there? We have weekly mentoring program every week. So full day workshop scheduled every 6 months. So this workshop I do only once in a 6 months. Repco debt to equity ratio. Repco's debt to equity ratio is more because it's a financial company, my dear friend. So yeah, for financial companies, you just ignore the debt to equity ratio and financial leverage. Remaining everything is same. That don't worry, Bijoy, I'll cover that in the weekly mentoring sessions. Can you please provide the link again? What link? What link you mean, my dear Rana Keshav Sharan? You're asking me some link. What is the link, my dear friend? Rakesh Shinde. For people who are new here, I mean, who are not a part of our sensible investing family, so you will get an invitation to join our sensible investing family in next half an hour or next one hour, or by the end of this session you will get a link. Okay, I'll do one thing. For people who are interested to join our sensible investing program, you can I'll just put this link in the chat box so that if you are interested, you can join. So I'm placing the link in the chat box. Is it visible? Please raise your hand if the link is visible. Okay, for people who are new here, you can just enroll. Excel sheet, video course, weekly mentoring, all of that will be provided if you enroll with that link. So just do that. And we are providing some additional discount today because most of you already made the payment to attend this, full day workshop as well. So that is the reason we are providing some additional discount as well today. Only for you that discount is available since you have already made the payment. Can't find the format in Screener as you show in your video. Rakesh, I mean, do you have our Excel sheet? You have to first upload my Excel sheet. Only then you will get the list in our format. Will we get new list tomorrow? Not tomorrow. Tomorrow there is no session. This Friday you will get the new list. So the updated list you will receive mostly next Friday. If price go below third entry point, what to do? Then you just hold it. You do nothing. So if the price goes below third entry point, so what you do is basically, if you have additional money, then you can invest. If not, just hold it. That's it. You don't do much. Veera Pratap, where are you from? I'm from Hyderabad, my dear friend. Where we can get Simon Sinek video to watch again? Simon Sinek video, just you can just search on YouTube. It's a YouTube video, my dear. So just go to YouTube and you can search it. You will find it. Swing trading intraday, I will not do, my dear friend. Sandeep Roy, when to exit? Don't worry, I'll let you know when to exit. So yes, I will inform you. Alsman score, Petrosky score, we don't check in our process. Turnaround, we don't invest. Turnaround, seldom turnaround. So I am not able to create account for a DMAT with the link. You can have an account. Okay, you have Axis Bank. Fine, you can use your Axis Bank account. No issue. NREL, it's an anonymous. NREL 100% pledge? No. No. NMDC is not ticking all the boxes, my dear friend. Abhay is asking me. I don't think profitability it will be, I mean, profitability it will pass. It won't pass the profitability test. Dinesh Tripathi, please share your Excel. Excel is already shared with you. If you are a part of Golden, if you're already a part of our Sensible Investing family, it is shared with you. But in case if you are new, if you just made the payment for attending the workshop, then I have provided the link in the chat box. So if you are interested, you can enroll with our Golden program. But if you are, one second. But if you are confused, like what is the Golden program and all, don't worry, my team will get in touch with you. You can discuss it with them. I'm a fresher. I want to know, I buy 500 shares of Rail Vikas, but only 300 got executed. What about rest? What order is it? Is it immediate or is it day? What is the validity that you have mentioned? Is it day or is it immediate? If you mention immediate, then 300 you have got, the 200 would have cancelled if the order doesn't get executed immediately. So my suggestion is you put it as day. If you put the validity as day, 300 you might have received immediately. The remaining 200 you would have received, later on. And you place the order in NSE. The second point, because the liquidity is much higher. On the top of that, you place market order. If you place limit order, then you will get limited number of shares. So you place market order, NSE, and you place the validity type as day, then most probably you will the quantity will trigger, not an issue. Commercial paper is nothing but a bond paper, debentures and all. It's like a bond. Tata Steel, avoid, my dear friend. No. Cyclical stocks, we generally don't invest, but Kalyani and BK are not cyclical. I mean, they are metals, but they are not cyclical. You can go and check their Excel sheet. They are not cyclical. Please repeat when to buy a stock and when to sell a stock. So when to buy is pretty simple, my dear friends. I think I have already covered. 1 second. So when to buy, I hope you can see the Excel. So this is where you will buy. So first 2-minute test, the company should pass our 2-minute test. So if once the 2-minute test is done, in the 2-minute test itself, you will check the P ratio as well. If the P ratio is also good, then you will come and you will check the total returns. Total returns is good. Multi-bagger gains is also good. Then you will go and check the intrinsic value. And with Heron Buy, as you can see, entry 1 triggered. So you can invest in this stock. Now you can invest at 500 rupees. You can invest at 480 also. It's your wish how you will do. And this is where you will sell. So this is where you will buy. This is where you will sell. So that is how you will decide basically. Recession is coming as increased rate of interest. What do you think? Now, the thing is, recession, we are not really sure, but what if there is an increase in the interest rate? If the interest rates go up, one thing is for certain. If the interest rates go up, discount rates will also go up. When the discount rate go up, the value per share will drop. So what is the direct effect of interest rate on the valuation? Interest rates go up, valuation drop. Interest rates drop, valuation go up. So that is how it is going to affect. anytime in the history, whenever the interest rates are going up, the share prices will not perform. Only when the interest rates go down, the share price will shoot up. Any multi-bagger stock list for month of August list, I will provide it next week. Kashika Gupta, shall we exit from not so good stock and enter into monthly list? Okay, you can do that, obviously. IEX is a good company, but Reshal, IEX is a good company, but not trading at favorable price. So you better avoid it. Okay, now comes all the stock questions. So no, we cannot go through all these stocks. In past, I have bought IEX at 218 rupees. Okay, 218 rupees, you bought it. What is the current share price? Let me check the current share price. ₹218 you bought it. Current share price is 160 rupees. So you have to hold it, my dear friend. You have no other option because you will lose your money, right? So you just stay invested. You cannot sell it off at loss. Honeywell is overvalued. Stylum Metallic, avoid. So what is standalone and what is consolidated statement? So standalone is nothing but one business segment. For example, I'll give you. If you look at ITC, go and check the standalone numbers of ITC. Standalone numbers are its cigarette business. But ITC is not just into cigarette now. They are into hotels, they are into paper, they are into stationery, they are into FMCG. So all these segments, they have added up eventually. Now, standalone is only cigarette business. But consolidated is all these companies, all the subsidiaries together is known as consolidated. So that's the difference. When we are analyzing a company, we look for consolidated number, not standalone numbers. We want consolidated numbers. We want overall company performance. For example, if you are looking at Reliance Industries, standalone numbers will be its oil and gas numbers. But consolidated numbers, you have Reliance Fresh, Reliance Trends, you have Reliance Jio, Reliance Marts, and along with the oil and gas. So we want to know all these things. They are into retail, they are into telecom, they are into oil and gas. That is all consolidated. We want to know all these numbers, right? So that is what consolidated is all about. So we would like to check consolidated numbers. Can Yes Bank take a U-turn? I'm not sure. Rarely U-turns happen actually. Rarely. Manappuram, you have to hold. There is no point in exiting. You have to hold. Yes, I will tell you when to exit as well, the 15 stocks. Okay, all the stock related questions only I can see. Yes, Deepanjan Banerjee. The next session will be on industry analysis, economic mode analysis only. So that is the reason I have not covered industry analysis and economic mode analysis, management analysis. I thought of discussing that in today's session, but I thought next week also weekly mentoring session, we are going to discuss the same things. So if I discuss industry analysis today and industry analysis next week also, then it will be pretty boring to you and for me also. So that is the reason today we have not covered industry analysis, economic mode analysis, management analysis, because next sessions we are going to cover those. So that is the reason I have removed those from this today's session. Sendil Kumar, no courses available in my account. Please contact the customer support. He will help you find the courses. Or if you are not finding, maybe there is some status issue, so he'll change the status and you will get the videos. Have to compare quarter to quarter report. For example, there is a, we have it in the worksheet itself. There is a worksheet called as quarters. In our Excel sheet only you will find a worksheet. From there you can do it. I already started. Ishar Ahmad. Yeah, you already started with 15. Then you can just hold it. Yes, it is necessary to know about a management, but again, there are some shortcuts. Don't worry. Like I said, management analysis next week's we are going to cover that. Next week, we will get monthly list also, and we will cover industry analysis also. So the list will be shared in first 5 minutes. So after that, we will cover the industry analysis. What is the meaning of equity shares? Preferential allotment, is it bad? No, preferential allotment is nothing but it depends, like what is the preference. So they are basically distributed by the company itself. So it's a preferential allotment. The company is allotting shares to someone. It can be to employees, or sometimes for mergers or acquisitions also they can do that. So it depends, like as the name suggests, it's a preferential allotment. So there is a preference to make that allotment, and who is doing that? The management is doing that. Is it good or is it bad? We cannot generalize whether it is good or bad. We have to see like what transaction they are doing with that. Only then we can say whether it is good or bad. Self-sustainable growth rate in the Excel sheet is nothing but that is the internal strength of that business. So that business is able to generate such growth rate, but it is generating this growth rate. So you can compare it. What is its worth, or what is its capacity, and what it is actually generating. So if it is worth is 20%, and if it is generating 25% in return in growth, then that's a very good company. It is actually performing better than what it can do. But if it can, the self-sustainable growth rate of, let's say, 25%, but it is only generating 10%, then it's basically they are lazy fellows. They are not utilizing their potential. In Philatex India, entry 1, 2, 3 is not finding, then you might it depends on, once check the cash flow statement. DCF, you see whether the initial cash flow is positive or not. You try to check that, then you will find it. Course link, I lost the mobile. Course link, you would have already received the mail, my dear. So, or else you can just contact the customer support. So customer support will help you find the course. So chalo guys, we have almost 4,000 questions unanswered, 4,500 questions. So I think, sir, most of the names in the induction link are failed. No, they are not failed, but the thing is, most of them are financial stocks. So for financial stocks, it's little different. So that, don't worry, I'll cover in our weekly mentoring sessions. I'll cover that. So chalo guys, it's already 4:30. So next week I'll share the top 15 list with you, and once I've shared the top 15 list, the topic for next week will be industry analysis. How to analyze the industry. So chalo guys, it's already 4:30. We have started at 9:30. So chalo, see you soon. See you next week, 9 p.m. Friday 9 p.m. Chalo, good evening.